will be delivered to us through a global lens by Mr. Arpinder Singh of EY. And then the talk and estate planning, estate and succession planning by Mr. Lohia, whole-time director of Merino Industries. I think we will have so much to think about and take away from this session as well today. It's heartening to see that the organizers have put together such a balanced and thoughtful agenda. In closing, I'd once again like to thank the organizers for putting together such a wonderful event and for inviting me to be a part of this esteemed gathering and giving me an opportunity to speak to you and present my thoughts. Many congratulations once again to all the winners of the Future of Family Office Awards that will be presented this evening, and my compliments to the nominees as well. And I hope you have a very, very enjoyable day ahead. And thank you so much for your time and for your attendance and for listening.
Thank you so much, Sanjay, for setting the tone of the conference. I think summarizing on the learnings of the day one would surely be of benefit. Thank you so much for joining us for the grand opening of the Day 2 Family Office Summit.
Thank you, Sharon.
Thank you. Okay, so with this, we now move on to our keynote session. I'm very delighted to welcome our keynote on the Future Family Office Investment, Ms. Monica Garware, who's the Vice Chairman and Joint Managing Director, Garware High-Tech Films Limited. She has been having more than 3 decades of hands-on business experience, and she's very passionate about investments, especially equities, and is hands-on with the family office. A very warm welcome to you, Monica.
Thank you, Franklin Templeton, for this honor. My heartfelt gratitude to Transformance Forum for organizing this wonderful, informative event. And thank you, everyone in the audience here, entrepreneurs, bankers, finance professionals, and investors, all of you who have gathered here to kick off this Day 2 of the conference. I look forward to the sharing of ideas and information and the opportunities for collective growth that this day is sure to bring. Now, courtesy of the introduction that just preceded me, I'm sure you can all imagine why this topic, the future of family offices, is of particular interest to me and one I have been paying close attention to. So today, I aim to share my thoughts, gleaned from my cumulative experience, ideas, and understanding in this sector, to provide some value, some points to ponder, and some inspiration to our audience gathered here today. I'd like to begin by quoting eminent Indian lawyer Mrs. Zia Modi, whose words are perfect for prefacing my talk today. In quotes, as recently as a decade ago, it was commonplace to find ultra-high net worth individuals and well-known business families with no comprehensive plan for their personal wealth, often with unfortunate consequences. Thankfully, the tide is now shifting. Family offices, a better organized and concerted view of building and preserving their assets. There are, if you will, 2 broad themes when we speak about family offices in general, especially from a future perspective. One is the increasing need for family offices as a service in India, and the second is the viability or the attractiveness of India as an investment destination to deploy the funds that family offices cater to. I'm going to address each of these broad themes separately and then conclude by tying all my thoughts in together. The increasing need for family offices in India. Following Simon Sinek's advice, let me start with the important question. Why? Why do we need family offices? Now, all of you here would have varying answers for this based on your experience or understanding, but here is mine in one line. We need family offices for optimal mobilization of our time and wealth while ensuring adequate safeguards to our privacy. Essentially, we need family offices to perform all the functions that may administratively derail our time, which can be productively used elsewhere, and or help us find options to make our money grow efficiently while ensuring that privacy of our information and transactions to permissible extents is maintained. But then again, why do we feel the need for family offices now in India? Again, here is my answer in one line: increasing wealth in individuals. Here are some encouraging statistics. According to the Hurun India Wealth Report 2021, the number of dollar millionaire households in India has increased by 11% to 458,000 households compared to last year. These households have a net worth of at least 7 crores rupees. The number of Indian dollar millionaire households is estimated to increase by 30% over the next 5 years to reach 6 lakh households by 2026. Oxfam reported that India's richest doubled their wealth during the COVID crisis. The years 2021, 2020, and 2019 saw the birth of maximum number of Indian unicorns, with 44, 10, and 9 startups being added to the club each year, respectively. In the 2 months of 2022, India has already seen 10 unicorns, and this number is only expected to rise. In short, India is poised at the cusp of phenomenal growth, but this growth cannot happen by itself. Benjamin Franklin reportedly said, "Money makes money, and that money that makes money makes more money." So, increased individual wealth makes it possible to deploy money in such a way that not just the investor, but also the economy at large shall benefit and grow continuously. This growth will fuel further growth, and the butterfly effect will spread, increasing in impact as the circle grows larger. This literally means that investors, entrepreneurs, all those who make up corporate India would be significant contributors in India's growth story in the days to come. As I've said this before, and I say this again, together is the only way we can grow. So, challenges. There is, however, a sobering reality to efficiently managing increased individual wealth. And that is the sheer complexity of issues that such individuals have to contend with, from legal compliance to tax planning, to navigating the attendant administrative issues, to figuring out new investment alternatives, many of which may be completely out of the scope of the individual's competence and or realm of knowledge. To top it all off, all of this would need to be done alongside running the individual's primary business. It would be a classic case of too much to do, too little time. Resultantly, the individual is forced to compromise somewhere, thereby lowering the efficiency of optimal utilization and deployment of his or her resources. Another concern is safeguarding such individuals' privacy with respect to transactions. In a genuine attempt to analyze the viability of a potential investment route and or understand new investment options, such individuals may speak to a wide variety of people who may or may not be the right sources for such information. This trial and error type of method may be inefficient in terms of time and outcome, but may also carry the real danger of the said individual interests becoming public knowledge, and almost certainly rumor. Rumor grows as it grows, and the domino effect of such rumors may potentially become a huge waste of time, energy, resources, and missed opportunities. Seeking family office services will mitigate both these challenges. I'm sure you can appreciate how having dedicated professionals who can navigate the administration, legal, and tax tangles, spot attractive and lesser known investment opportunities, and negotiate on our behalf with the right people within the respective industries would save a lot of time and hassle at our end. With this in mind, Here are what I would want family offices to provide. So, what services should family offices provide? Personally, I would see value in a family office that would provide a comprehensive solution to all the issues I have highlighted above, while also ceding ultimate control of my portfolio to me. With that in mind, here are all the services that I would value from family offices: scouting investment options for better returns, dealing with stakeholders, fund managers, private equity firms, etc., on the individual's behalf, complete assistance in investing in global markets and foreign funds, from locating viable investment options that synthesize with the individual's ethos to managing the entire investment process, safeguarding privacy of dealings to permissible extent, distribution of assets across various investment options, and being up to date with the latest trends and avenues in investing, risk analysis and planning, tax planning and management, legal compliance, and navigating the minefield of individual family corporate structures, disclosures, forms, KYC, and all the accompanying chaos, insurance planning and management, estate planning, what happens when such individual dies, assistance with donations and other charitable works. Lifestyle management would be a bonus, such as conducting background checks on personal and business staff, concierge services, providing personal security for travel, property management, and so on. Any firm offering these services authentically and keeping the client's interests furthermost in mind would, in my opinion, be an extremely valuable partner to any HNI. I have been fortunate to have experienced Franklin Templeton's excellent service in this endeavor. They have been very proactive in seeking new and emerging funds as investment options that align with my interest and my risk appetite, and have adeptly managed my money, making the process hassle-free and seamless for me. Attractive investment options for family offices. Having made my case for the need for family offices and services that I would seek from them, let me now take you to my thoughts on the second theme for my talk today: possible investment avenues for funds managed by family offices. Broadly, I see the following industries as possible investment options: startups, international funds, passive funds, new age businesses like EV, robotics, green energy, space travel, blockchain, Internet of Things, 5G, artificial intelligence, cryptocurrency, the India growth story, startup IPOs, and increased retail participation. I will address each of these separately below. I have culled out statistics and publicly available data relevant to these topics. The reason being to set a context to why I have chosen these heads as possible investment options for family offices, and also show that investments into each of these subheads are not only attractive at the moment, but these are also poised to grow steadily in the years to come. So do bear with me if the recitation of numbers and percentages becomes slightly sort of ponderous. Okay, startups. With the sudden proliferation of unicorns in India, it would come as no surprise to anyone here that Indian family offices' direct investment in startups is growing. The statistics that follow below provide ample evidence to this. According to a 2021 report, 75% of the family offices see direct startups and emerging market equities in India as the highest conviction opportunities and best high performance bets in the next 3 to 5 years. In comparison, 56% of family offices see investment in VC and PE funds as the highest conviction opportunities, followed by investments in developed market equities, 39%, real estate, 25%, emerging market equities, 22%, and commodities, 5%. In terms of sector distribution, the report found that fintech led the pack with 82% of the family offices backing the space. This was followed by enterprise tech, 71%, consumer tech, 68%, healthcare, 50%, agri-tech, 35%, and ed-tech, 42%. This trend in India also seems to be in line with global trends on family office investing. International funds. It is reported that 22 new international funds were launched in 2021, including the first Indian mutual fund to invest in the Taiwanese market, an ETF focusing on IT sector companies listed on the Hong Kong Stock Exchange, select index fund investing across European markets, and funds primarily investing in REITs or equity of real estate companies throughout the world. The launch of these funds is indicative of an encouraging larger trend of Indian investors actively seeking potential avenues across sectors on a global scale, a trend which I see will only increase with time. Passive funds. That is an investing style that mirrors the index, either through an index fund or an ETF, is gaining popularity in India. Business Today reported that per historical data, the assets under management of passive funds has jumped tenfold in 3 years from March 2018 to 2021. Between March 2016 and March 2021, the AUM of passive funds rose from rupees 22,409 crores to rupees 3,10,000 crores, 3,10,000 crores, reflecting a CAGR of about 69%. Also reportedly, passive assets, passive products, and passive assets as a percentage of overall assets have more than doubled in the last 5 years. We see that 3 factors contributed to the rise in popularity and AUM of passive funds. 1, the underperformance of active funds. 2, the cost, and 3, the regulatory and government policies. It is predicted that the AUM of passive investment products will grow 8 times from the current levels of rupees 3 trillion to rupees 25 trillion by 2025, and that passive assets will continue to grow 37% of the overall assets in the mutual fund industry by 2025. As for global trends, a report showed that the AUM of passive funds, it's a BCG report, the AUM of passive funds was pegged at $22 trillion in 2020, which is expected to rise to $34 trillion in 2025. Fund houses are eyeing themes such as blockchain, robotics, US IPOs, semiconductors, electric vehicles, cloud computing, etc., to launch new passive funds. New age businesses, EVs. Globally, we see a determined shift towards electric vehicles, EV, with legislative and regulatory encouragements given for people to buy and use EVs. This presents a generational opportunity for investors to buy high-quality EV stocks or invest in EV-related businesses at a discount before they run up in the years to come. Artificial intelligence. AI is no stranger to our times. It has, in fact, become endemic to our lives. However, it is growing at a phenomenal pace, virulently advancing into myriad industries. This precipitous proliferation presents a plethora of investment opportunities, and we see a number of global billionaires upping their investments in AI-based firms. 5G. Through a landmark 5G economy study, it is found that 5G's full economic effect will likely be realized across the globe by 2035, supporting a wide range of industries and potentially enabling up to $13 trillion worth of goods and services. The studies also reveal that the 5G value chain, including OEMs, operators, content creators, app developers, and consumers, could alone support up to 22.8 million jobs, or more than 1 job for every person in Beijing, China. the Internet of Things. With IoT permeating our existence, with its steady infusion into our daily lives, it is not surprising that reports reveal that investment in IoT is set to overtake cloud computing, next generation security, big data analytics, and other digital transformation technologies in the near future. So IoT will probably overtake these. Green energy. Due to climate change concerns, the world is moving away from carbon-based fossil fuels to cleaner alternative energy sources. However, it is estimated that decarbonization of the global economy will take an estimated investment of more than $100 trillion over the next 3 decades. Renewable energy sources such as wind, solar, and hydroelectric currently supply about a quarter of the electricity generated by the power sector. The industry has been growing briskly, increasing its electricity generating capacity at a roughly 8% annual rate over the past decade. Space travel. Easier access and falling launch costs due to development of reusable rockets have spurred opportunities in space travel. It is estimated that the global space industry could generate revenue of more than $1 trillion or more in 2040, up from $350 billion currently. The most significant short and medium-term opportunities may come from satellite broadband internet access, which likely will represent 50% of the projected growth of the global space economy by 2040, and as much as 70% in the most bullish scenario. More futuristic ideas include delivery of packages by rockets instead of airplanes, sending mining equipment to asteroids to extract minerals, and so on. One thing is for sure, intergalactic travel would see the light of possibility, and so investment opportunities in this realm may not be as far-fetched as it may seem. Water investment. While it sounds slightly strange to think of water as an investment opportunity, it actually is a commodity like gold or silver, and one that is becoming rather scarce these days. With only about 3% of the world's water sources being used for human, agricultural, and related activities, water scarcity is a real problem in today's global world. Water-related investment options are mushroomed, whether it is companies provided clean drinking water, water filtration, water utilities, or water-related infrastructure, and so on. In November 2021, President Joe Biden signed into law the Infrastructure Investments and Jobs Act, which inter alia specifically allocated $55 billion towards clean drinking water. There are specific indices to track water-related investment opportunities, like the Dow Jones US Water Index, S&P 1500 Water Utilities Index, S&P Global Water Index, and so on. Environmental consciousness is the need of the hour, and water, which was freely available, has suddenly become scarcer, owing to both overuse and pollution. Thus, in my view, the interest and investment in water-based projects will only rise hereon. Robotics. Due to semiconductor and software innovation in recent years, robots are being applied throughout the global economy at a record pace. As technology continuously improves, it will transform the way organizations operate and make the world a more efficient place. Multiple robotic startups are coming up with innovative and unique robotic products and services to serve customers efficiently, especially post-pandemic. Having said that, it could do well to bear in mind that robotics is a long-term trend, and investing in stocks within the space may require patience. Blockchain. Blockchain is clearly the buzzword for 2020s, thanks in large part to the pandemic that suddenly hurtled us all into the digital space and making the metaverse a closer reality. a digital public ledger that records transaction information with each block of information having a unique hash or identity and digitally verified. The use of blockchain technology is especially famous as the basis of cryptocurrency. However, there are several more uses of blockchain technology, like improving operations, specifically for complex and decentralized systems for large organizations. For instance, Walmart has been testing the use of blockchain to track the distribution of food from its myriad suppliers, making it potentially easier to isolate outbreaks of foodborne illness. Starbucks also piloted a blockchain project for its coffee growers in Costa Rica, Colombia, and Rwanda to improve pricing transparency. It would come as no surprise to anyone here that we have just scratched the surface of this new technology. With the metaverse already a looming reality, applications of this technology are all set to explode. It will be in our interest to be front and center of this new wave. Cryptocurrency. Arguably, the most talked of topic during the 2020s was cryptocurrency, especially among today's youth. Investments into cryptocurrency, especially Bitcoin, has been steadily increasing. Regulatory and legislative concerns notwithstanding. Reportedly, as of 2021, global crypto ownership rates are at an average of 3.9%, with over 300 million crypto users worldwide and over 18,000 businesses are already accepting cryptocurrency payments. Bitcoin market cap reached US $1 trillion in February 2021. Bitcoin constituted 66% of the total market capitalization of cryptocurrencies in 2020. While there is a general wariness among most about the actual nature and contours of cryptocurrency investing, including their legislative and regulatory treatment, it is clear that cryptocurrency will be an undisputable part of our future. Thus, it may serve us well to take a keener interest in the developments in this space. The India growth story. I quote this line from a recent article in the Hindustan Times because it perfectly encapsulates my view on this subject. So the quote is as follows. The underflow of changes in the Indian economy in the post-pandemic world has made one thing abundantly clear, that the India growth story isn't going to lose its charm anytime soon. Rather, it has all the makings of a magnum opus. To put my opinion in perspective, I have set out some indications of this magnum opus, quote unquote, journey below. India remains a preferred investment choice among peer emerging markets on the back of strong fundamentals. Despite the second wave of the pandemic in India, the earnings for FY22 and FY23 have not seen any significant downgrades and are anticipated to grow by 25% and 20% respectively. In several sectors of the economy, pre-pandemic levels of output have now been crossed, and nominal GDP is now also above pre-pandemic levels. The central bank to continue its liquidity normalization with a reverse repo rate hike in early 2022. Electric vehicles as a segment in the auto sector is seeing healthy adoption. The government's initiative of boosting domestic manufacturing through the PLI or the Production Linked Incentive Scheme has been gaining good traction. The IPO market has been very buoyant in 2021, and we expect the similar trend to continue into 2022 this year. New age digital businesses are gaining traction and have also received strong investor response via IPOs. However, return expectation from equities is expected to be more moderate in 2022. Startup IPOs is a heartening trend I see that will only increase with time and an especially interesting investment avenue for family offices. In the past year, we saw Indian startups come of age with 8 IPOs in 2021. A self made woman found herself among India's richest people after her firm was listed. A Chennai based firm became the first Indian software maker to be listed on the NASDAQ. A food tech firm achieved a market cap of rupees 1 lakh crore within hours of trading. A fintech firm clocked the worst debut for a tech company since the dot-com bubble. India's answer to Google Maps dropped a pin on Dalal Street and had investors queuing up. In all, these companies raised as much as $2.5 billion from public markets. This encouraging market interest in startup IPOs makes investing in this segment at various stages, even prior to the IPO, an attractive option for family offices. Increased retail participation. A major shift in investment trends started in post-pandemic 2020 when active investor accounts increased by a record 10.4 million in India. At the same time, retail stock ownership in the 1,500 plus companies listed on the National Stock Exchange rose 9% in Q3 2020, the highest since March 2018. The NSE alone saw retail investor share grow from 33% in 2016 to 45% in 2021. Equity mutual funds have also seen a jump, with individual investments rising 16% in February 2021 as compared to the same month in the previous year. 39% of the index futures is accounted for by retail investors, with foreign investors making up only 15%. Reportedly, an increasing number of new customers coming in from smaller towns and cities of the country. The primary drivers of the rise of retail investment appear to be pandemic, technology advancements, low interest rates, and social media. It is predicted that online trading could reach a value of $14.3 billion in India by 2025. My concluding thoughts. I firmly believe that India is shining today. Family offices as a comprehensive service in India in the manner I have described above will be a very valuable addition, not just for HNIs, but also the economy as a whole. The infusion of skilled professionals dedicated to growing investor money will oil the clogs of the corporate ecosystem, thereby unleashing a seismic effect on the rest of the country. Historically, it has always been the job creators, the radical thinkers, and the doers in their various forms who have uplifted the country. India is poised at the precipice of this explosion. An increasing inclination towards entrepreneurship and a creator economy paves way for greater job creation and growth opportunities. As investors and a generation that will hand over the baton to the youth, it is both our privilege and our responsibility to deploy our resources in a manner that will ease the path of these young firebrand and put India firmly on the global power map. But like I have said before, this cannot happen by itself. It is and will be a collective effort. All hands, the government, the corporate sector, the regulatory legislative arms, and the doers have to come together with a larger intention of putting the country first. Borrowing from the oft-used expression, money makes the world go round, I see our role as being the facilitators of entrepreneurship, not just with our monetary investment, but also with mentoring, with passing on our cumulative experience to guide and protect, either by being advisors or board members or crafting some such association. A step in this direction will also be to include impact investing as part of the family office's portfolio. Investments in businesses focused on bettering the world around us through environmental conservation or sustainable practice, in my view, our responsibility. I also think it is important for us to cultivate and nurture healthy professional networks focused on mutually beneficial exchanges of information and business. I think it is important for all of us to constantly upskill ourselves, keep ourselves abreast with changing time by being connected with today's youth. And lastly, I would love to see family offices services grow to a point where we have a voice in policy making in our country. I've always said together is the only way to grow. With that said, I now open the floor to our day's events. Thank you again, Franklin Templeton and Transformance Forums for affording me this opportunity to share my thoughts with you all today. I hope that we can all rally together as one synchronized change machine to put India on the global power map. I look forward to hearing from and learning from everyone else gathered today. Thank you.
Thank you so much, Monica. So with this insightful keynote, I'm very excited to for the next presentation that's on equity outlooks and trends. Please join me in welcoming Mr. Anand Radhakrishnan, who is the CFA Managing Director and CIO EME India from Franklin Templeton Asset Management Private Limited. Mr. Radhakrishnan has been into the investment management industry since 1994 and also responsible for overseeing all the local equity funds and mentoring all the portfolio managers, apart from continuing to be the portfolio manager for some of the key products. He also manages Franklin India Flexi Cap Fund, Franklin India Technology Fund, and Templeton India Value Fund. A very warm welcome to you, Mr. Anand. Over to you. Mr. Anand, can you hear us? Okay, we'll take a few minutes till Mr. Anand joins back for the session. I request all of you to stay tuned.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Okay, I think Mr. Anand has logged in. Mr. Anand, can you hear us well now?
Yes, I can hear you.
Okay, we can hear you well too. Okay, over to you, sir.
Can I go ahead?
Yes, yes, please. You can share your screen.
Okay.
Yeah.
Is my screen visible?
Yes, it's visible.
Okay. Good morning, everyone, and thanks for being in this call. And over the next 20-30 minutes, I would like to give some update of the Indian equity markets and our views on the current situation. Broadly, I will follow this agenda. What are the big issues that are facing us in terms of economic issues, and what is our view on it, and how Indian corporate landscape has changed over the past few years, and what is its relevance to the market. Here, globally, I think post-pandemic, most of the economies have been on a recovery mode. Both in 2021, we saw significant normalization, and we think 2022 will be continuation of that, and growth will become a little more well entrenched in both developed, advanced economies as well as in many emerging markets. We are seeing that even that is indicated by the significant recovery in global trade, which is a kind of an indicator of the health of the global economy. And we are seeing reasonably good traction on most of the macroeconomic parameters. In that context, of course, India has also had a good recovery in the current financial year. We have seen most of the economic parameters fairly stable within India, and growth has, because of the lower base last year, of course, we have had a good, optically good number in terms of GDP growth. But if you look at the in fiscal 2023 as well, the expected growth rate is around 8% or so. The quarterly GDP numbers are also kind of course, now the latest print, we have seen some moderation of growth, but they have bounced back significantly. Coming to the key issue that globally we have seen, which is inflation and interest rates. This chart gives you, over the last 10 years, what has been the inflation trend in India and inflation trend in US, and what has been a kind of a differential between these two. There was a time in the beginning of the last decade where Indian inflations were upwards of 10, 11, 12%, whereas US inflation was around 2%. I think over the last decade, we have seen some kind of structural deflation in India. Of course, US also had a period of low inflation. But in the last 1 year, we have seen the developed economies, especially US, have had a significant improvement or hike in inflation, whereas Indian inflation has also gone up, but has not gone up as much as the global inflation. Because of that, the inflation differentials, which used to be 6% or 7% or even higher, has now practically become zero or even negative between India. The last print, few prints we have had even negative differentials. So why I am emphasizing this point is that the policymakers who had this mindset that India is a high inflation economy, and therefore have to have structurally very high interest rates versus the global interest rates. I think what we are seeing is a change in that approach, where they are looking at Indian inflation drivers, which are different from global inflation drivers. Like global inflation drivers are driven by wages and salaries, whereas on asset prices, and Indian inflation is driven by food and energy prices. In that backdrop, when the inflation differentials have narrowed, there is a case for arguing at least that the interest rates differential should not widen, if not narrow. Ideally, it should have narrowed. So this chart gives you the 10-year yields between India and US on the top side and the differentials at the bottom slide. On the top, if you notice, of course, the 10 years in India is around 6.8 or so, whereas US is less than 2. There is still a big 500 basis point kind of a gap between India and US inflation, US interest rates, though the inflation has significantly narrowed. So in what we are trying to emphasize here is, while directionally the interest rates may have bottomed out and may tend to go up, they need not have to mimic each other in terms of magnitude, because of the underlying drivers of inflation are behaving very differently for the developed economies versus India. In other words, we think that Indian policymakers will lag the global policymakers and will be much more moderate in their interest rate actions than the global policymakers. So, which kind of gives me the confidence that India will probably support structurally lower interest rates for a slightly longer time this time than what it did earlier, which is good because the cost of capital coming down has to really is very important for India to kind of do well both on the supply side as well as on the demand side. And people should be able to set up capacities with borrowed money at cheaper cost, as well as people should be able to borrow money at cheap rates and consume. So both on the supply side as well as on demand side, lower cost of capital is something which we think is very, very important for structurally higher growth for India. Of course, India has been on the good side of both FDI and the FPI for significantly part of the last 3, 4, 5 years, barring the last 6 months where we have seen some moderation on the FPI flows, and some of them have gone negative as well. But if you look at the direct investments, we have seen reasonably good traction, and as a percentage of GDP also, we have seen they have been structurally improving from about 2% of GDP to closer, more than 3% of GDP in terms of FDI inflows. All of it have made our external situation lot less volatile and more stable than what it used to be. I mean, there was a time when oil touched 120 and rupee went for a big toss in the year 2011-12 kind of a time period. I think this time we are not seeing such a kind of a panic reaction on the foreign currency side. The reason is that net of oil, the exports have kind of caught up a lot, and the sensitivity of oil to the current account and the trade balance has reduced. And that is kind of making our macroeconomic situation slightly more stable, less volatile than what it used to be given the same situation a decade back. Of course, domestic policy situation has been pretty accommodative. Government has been trying its bit to stimulate the economy through spending in infrastructure, to produce to giving credit guarantee schemes for SMEs, etc. And I mean, though the fiscal deficit is moderating, we still think that the fiscal impulse from the government is reasonably strong. Probably they are waiting for the investments from the private sector to kind of catch traction before withdrawing their fiscal stimulus. Government has also tried to broad-base the growth by maybe more inclusive schemes for the MSMEs, SMEs, and the employment generation for the unorganized sector, etc. And of course, PLI schemes for the manufacturing sector also seem to have revived a little bit of enthusiasm towards manufacturing sector than what it was about 3, 4, 5 years back. The confidence amongst the entrepreneurs towards investing to create fresh capacity, either for import substitution or new exports, or for domestic demand, has become much better today than what it was about a few years back. Bulk of the, of course, cyclical demand is driven by this capex spend, as well as availability of liquidity at low cost of money. So I think that liquidity and low cost of money is still continuing in India, despite the recent inching up of interest rates. But and then public capex spend, both on the central level and state level, we have seen reasonably good traction on that side. Now, the private capex has been a bit of a challenge for people to predict. But if I look at some of the leading indicators, like number of approvals, environmental clearances, etc., credit pickup, and corporate sentiments, we kind of get reasonable confidence that it's a question of time before private sector capex starts to catch up with the public sector capex. Of course, some of it is premised on good demand and capacity utilization gradually improving over the next 4 or 8 quarters for us to take a very definitive view. The banks are flush with funds. Their books are more or less cleaned up. Most banks are well capitalized. So in some sense, I think they are ready for pushing credit into the system and kind of drive the next credit cycle. And if that happens, we would see the growth getting more entrenched, and we will see next 3, 4, 5 years of a reasonably good cyclical recovery of the industries. This chart gives you various PLI schemes and the general goal of manufacturing as a percentage of GVA, how it's expected to increase over the next decade from the bottom of 15% of GVA to close to 20%, which was what it used to be in 1990s and 2000s before it kind of came down. We think the whole effort of the government is to kind of make India competent enough to manufacture things on its own rather than resorting to imports. I think that is going to bear reasonable fruits. We are already seeing a lot of companies setting up capacities, be it in automobiles or textiles or consumer durables, white goods, electronics, etc. And we would see probably the ongoing geopolitical issues may even hasten this process further, where India will be forced to indigenize and set up more capacities locally. So that is the overall kind of a macroeconomic view. We still remain positive. We think that inflation and interest rates will be lagging the global economies. And by and large, our external situation is fairly stable. We should not have a runaway weakness in rupee every time the oil used to hit 110 or 120. I think this time we will not have it, though it may weaken a bit, but it will not have some kind of a devaluation kind of a thing. On the corporate side, of course, it's gone through various cycles. This chart gives you corporate profits as a percentage of GDP. In the 90s, it used to be around 3%, and of course, it went up to 7% before the global financial crisis, and then it came all the way down to 1.6% of GDP. And I think now it's kind of gradually recovering, and we would see this kind of recovery continue for a few years, because there was a time of when the corporate sector was readjusting itself, shedding the excess capacity, malinvestments. Some of the bad investments have reflected in the banking system and kind of led to further challenges. And we think that the overall macro trend of long period trend is that of a recovery in corporate profits in relation to the overall economy. In an slightly inflationary environment, the profits tend to be a lot more healthier for corporates. And I think that is what we are saying, that global inflation in some sense is good for the corporates. And that's the reason why generally the earnings expectations for the market is pretty good, though we had a very, very lackluster decade between 2010 to 2020. I think we'll probably have this decade of better growth because of the reason I mentioned just now. More than the growth, I think the growth is becoming broad-based. That is very important. I think there was a time where bulk of the growth was driven by consumption-oriented sectors, whether it is consumer staples, durables, consumer finance companies, retail banking alone. I think now we are seeing contribution from other sectors as well. Sectors like commodities have come back pretty strongly. Telecom, which was struggling with profits, have now started reporting healthier numbers and profitability. IT is still chugging along with reasonable good growth. And healthcare sector, because of COVID and other related issues, we are seeing more and more healthcare verticals open up and growing pretty well. Hospitals, testing labs, etc., health insurance companies, etc., have been growing very well over the last 4-5 years. And so as the growth becomes broad-based, the number of investment choices are increasing versus what it was very narrow in 2015-16. And I think that is a very important trend which we should be aware of, that it's no longer that you got to buy companies or investments in a particular sector. And there are even some of the traditional old sectors have come back pretty strongly. And this is not to say some of the new age disruptive sectors like fintech, edutech, health tech, logistics, etc., and e-commerce, online retailing, offline retailing, modern retailing. There are so many sectors which have now businesses have gathered critical size. Some are already beginning to list. We think more will get listed in the coming days and give more options for investors to invest. Another classic example is the quick service restaurants business, where there was a time only one pizza delivery company was listed. Today, we are seeing much more number of companies listed in that space. That is trend one. Trend two is, of course, during post demonetization and during COVID times, we have seen the strong get stronger kind of a trend. I think that is something which, or in some sense, anybody who was weak got weaker and ceded market share to the stronger names. So if you look at sector after sector, whether it is banking or telecom or passenger cars, etc., the top 2, 3, 4, 5 players, the market share, if you track over the last decade or so, we have seen significant increase in their market share, which means, of course, India has become a little more consolidated. Corporate landscape has become a little more consolidated. People with good balance sheets, prudent financial policies, careful capital allocations have generally tended to do better than people who have been extremely aggressive, reckless in their spending, etc. So I think corporate India went through a huge learning curve post GFC, and I think that is showing up in numbers. I think the better ones gained the market share and became stronger. I think maybe the mid-sized ones will learn some lessons out of it and would come back and challenge some of this consolidation, which we have seen. Maybe next 5 years, we will see some reversal of this trend. We have to be careful about that. But it's quite possible that mid-sized companies may rise up to the challenge and gain back some of this lost market share. I mean, this is evident in sector after sector, whether it is, real estate or switch gears or paints, steel, cement, ceramic tiles, banking, insurance. You name it, we have seen that the bigger getting or stronger getting bigger over the period of time. It's coming to markets, of course, have, till this geopolitical issue broke out, Russia invading Ukraine, I think markets were pretty buoyant. And though I think global markets began to correct right from September onwards, in anticipation of hiking rates and withdrawal of liquidity, India held up. But I think because of the current situation, we have seen some pullback in the valuations and levels, which is in a sense it is good for the longer term investors and probably makes valuation a little more accommodative and meaningful. But before that, I think Indian valuations had trended higher than the MSCI emerging market indices, as well as its own past. We have seen valuations relatively higher, and its premium over the other emerging markets had gone up, partly because India was doing well, and we had seen some of the other bigger emerging markets struggle. For example, China government had significant regulatory control over many of the big firms, which led to massive erosion in value of big firms like Alibaba, Tencent, Pinduoduo, Meituan, which was a food delivery companies, etc. We saw massive erosion in value of these companies, which kind of brought the Chinese investments down for many foreign investors. And incrementally, they became very averse or very careful and circumspect about their exposure in China. Similar was the case in Russia, where I think predominantly commodity companies were listed. Oil companies, gas companies, and aluminum companies, along with banks. Many of them have started to derate even before the onset of this particular event. And of course, this event has now made it even more worse. So some components of emerging markets were doing badly, and because of that, Brazil was similar situation. Turkey, of course, was a similar situation where there was a macroeconomic instability, runaway inflation, high interest rates, lira devaluation. We saw massive dislocation in some of the emerging markets, which made India look a lot more stable on a relative sense. And that's why even today, as we speak, India trades at a healthy premium to the other emerging markets, partly because of them messing it up, partly because our policies have generally been more stable and more progressive and forward-looking. But we had our own small challenges. I think the liquidity that came in the market led to some kind of a spike in valuation of many companies. And the retail investors' enthusiasm has also created a significant overvaluation in mid and small sized companies. The IPO boom that happened, and it's still probably on the way, also kept this enthusiasm well fed. But subsequent pinpricking happened, and many people lost money in some of the IPOs, and that has kind of reduced the enthusiasm. But valuations are still to reset in some parts of the market, and we think that in the coming months, the pockets of overvaluation will correct as markets begin to rotate from expensive sector to moderately valued cyclical sectors. This can be domestic cyclicals or global cyclicals. So we think there will be a bit of a rotation that will happen. We are already seeing some underperformance of some of these names in many of the portfolios. So this year is going to be a bit of course correction, rotation, moving away from hyper expensive mid and small caps to more moderately valued large caps and large mid caps, and some bit of yo-yo between risk on and risk off. It's not going to be a constant risk on mode like we had it in 2020 or 21. I think 22 will be a bit of a yo-yo where the investors oscillate between risk on and risk off mode. People will get opportunities to buy when the panic hits the street. And I think some of the impacts are going to be shorter term. So we need to remember that. So people ask me, so what is the impact of the current situation? Is it going to make India structurally weak? Clearly not. Yes, energy prices is a fly in the ointment in terms of our ability to handle it. But our guess is that, like, there was a time where oil was trading at close to zero in the peak of the pandemic. At the time now oil is trading at $120 in the peak of a geopolitical risk, all within a space of 3 years or so, 2.5 years, not even 3 years. So this kind of volatility is inherent to commodity markets. And we think that once the current situation subsides in one way or the other, the energy markets will cool off to more moderate levels, and which should be manageable for India. And that is therefore any panic that comes because of high oil prices, etc., because of the ongoing geopolitical issue, should be viewed as a temporary panic, or it will mean revert to more normal situation in the coming months. And second is, does things change structurally on other issues for India or for even the world for that matter? So clearly, I think some things will change. We need to be very careful about predicting too much. But yeah, I do think that some things will change, and India will become more aware of its of the geopolitical risk and its hyper dependence on specific commodities and products in the import side. So maybe this will accelerate the indigenization or domestic production process, manufacturing process more faster, and that should throw up a lot of opportunities. It will probably drive a big insourcing of defense spend, which again should throw up a lot of opportunities. India can have a meaningful role to play in some of the commodity space where I think global supply chains will be disrupted. This can be in steel, iron ore, coal kind of a thing, etc. So again, there can be opportunities there. And of course, ongoing opportunities of China Plus One strategy, PLI schemes, etc., or anyway, will continue to play into our strengths. Of course, India has to be seen as neutral, if not progressive, towards some of the democratic values in the global scene. So that is, India should not be seen as supporting some kind of a war or something like that. So I think it's very important for us to make the right political moves in this juncture to be seen as a balanced, growing economy with some kind of staunch neutrality towards things, global issues. So I think some of that, if you play it well, I think India will come out stronger. But there are risks to that. There are definitely some risks to that. China can get more assertive globally. And US may warm up to China more just to neutralize Russia. There were last few years have been one of US slightly growing colder towards China. I think that can thaw a little bit if they use China as an ally to neutralize Russia. So all the geopolitical risks will play itself out. But I think India will probably continue to maneuver ourselves in that situation. Some of the outcomes can be pretty positive. So I'll stop there, and I'll be happy to take questions if it is an interactive session. Thank you.
Thank you so much, Mr. Anand, for the insightful session. May I request the attendees if you have any questions, since we have more 5 minutes to go. So if you have any questions, feel free to write in within the Q&A tab, so we can certainly help Mr. Anand take it up. Okay, Mr. Anand, I don't see any question yet. In case I get any, we'll be certainly happy to email you, and would be great if you can answer it. Okay, I have one question that has come up. How LIC IPO is going to impact equity market as well as overall liquidity situation?
Yeah, LSE IPO, of course, was expected to be one of the milestone IPOs from the government, because after a lot of regulatory changes, etc., they kind of readied up the insurance company for taking it public. But in the initial stages, I think they kind of overestimated the valuation for the firm. I think newspapers and others were trying to value it as one of the largest company, rivaling some of the existing large companies in terms of market cap. I think market feedback was it is not possible. So I think the valuations have toned down significantly versus initial expectations. So I think that is point one. And because of that, the size of the issue, which was supposed to be big, also correspondingly would have come down. I think valuation expectation falling down by 30-40% is probably kind of was a bit of a negative thing for the government, and probably now they are thinking as to whether this is the right time to do it as well. But the thing is, even if even if sentiments were good, I think the perception of that it's worth a lot was kind of slightly misplaced. I think it is worth something, but it is not worth stupendously high valuations. Definitely not. And I think that is very important for us to understand. There are various reasons. We don't want to go into the details of it. But suffice to say that the negative impact of the liquidity going up to the market was a lot less because of the valuation reset, which has happened. Of course, now they are rethinking whether we should go ahead with the issue or not at the current juncture. So one, but even if it had come, I don't think that would have put serious dent on overall liquidity. I think domestic liquidity was pretty high. Banks were sitting with 7-8 lakh crore of surplus liquidity, and people were also kind of because of over the last few years, people have not spent on many of the other investments. Equities were getting more traction. So my guess was, even if it had come with a good size, market would have been able to absorb it because of the availability of liquidity. Now, we don't know. Well, 6 months later, when the global liquidity cools off, whether it is possible to do that, maybe it will become tougher. But for now, it would have been okay to go ahead with it. But we'll have to wait and see whether the government is going to go ahead with it.
Thank you so much, Anand, for answering that. I still don't see much questions. But anyways, we have next 15 minutes quick break. So Anand, if you get any questions, we certainly will email it to you and we can coordinate with you on getting answers. Thank you so much for joining and for that insightful session.
Thank you.
Okay, great. So after this, a lot of insightful sessions early morning, time for a quick 15 minutes break. We'll start off with a very exciting panel discussion at 11:45. So kindly stay logged in and we'll start the next session at 11:45. Thank you.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi.
I can just can somebody confirm if I'm audible? Hi, everyone.
Yeah, audible. Am I
audible?
audible?
Yeah, you are audible, Mr. Doshi. Can everyone say hello? Maybe you can just check your mics maybe once.
Yeah, am I audible? Manish here?
Yes, you are audible.
Amit here. Am I audible?
Yes, you are audible, Amit, for sure. Maybe Amit, you want to come on the center of screen, maybe Amit. You're not in the center, Amit. Yeah.
Okay.
Is my background okay?
Absolutely fine, sir. Looking phenomenal. Absolutely
Sanjay,
clean. Hi,
Can you hear
Shekhar.
me?
Hi, Sanjay.
Yes, loud and clear. Anyone who is not with the headphone, just be careful, because then your either voice echoes or your voice is not maybe clearly audible to the. I'll tell you if there's a case like that. I will prompt maybe.
Sanjay, you can hear me okay? I'm not using a
You're
headphone.
slightly feeble, but I can hear you for sure.
Okay, let me.
Maybe I need to increase my volume, I guess. So laptop volume. So that should be okay. Yeah, looking nice, but that's fine. Absolutely phenomenal.
Okay.
Yeah. देखो मैं सबको फोटो भेज देता हूँ, ऐसी क्या बात है। ये लीजिए, भेज दी मैंने आपको, थोड़ा डार्क आ गया। और कुणाल ने चश्मा पहन लिया फाइनली, इसलिए याद आ गई उनको क्या पहन लो। एक ही बचे बिना चश्मे के, पराग जी बचे, बस और कोई नहीं है।
Justifying my photo.
I was actually unable to find my specs for last 3 days. I was going without them. And
Actually, I was wondering that I've always seen you in photograph also, you have specs, but you're not wearing it. Maybe I thought, okay, that's
actually I was shifting my residence and I उसको ज़्यादा संभाल दिया था कहीं, वो मिल ही नहीं रहा था।
Mansi, give us a countdown, because I'm sure it's around 11:44. Yeah.
We are starting in next 1 minute, Sanjay. So we'll start with a quick round of introduction.
Okay.
Okay, great.
You just introduce me and hand it over. Balance I will take care of.
Sure.
Yeah.
Okay, so welcome back, everybody. So as mentioned, we have a very exciting key panel discussion on the future of investment themes for family offices. Please join me in welcoming our moderator, Mr. Sanjay Patni, who's the Vice President Head of India Institutional Sales from Franklin Templeton Asset Management Private Limited. He's been into IT marketing, consumer durables, product lightning, banking, financial services, and he's also looking at handling and mastering sales for every product of financial services. Learning is what holds the key to his growth path step by step. A very warm welcome to you, Sanjay. Over to you.
Hey, thanks, Sharon. Sharon, if you can just confirm if we are audible, if I'm audible.
Yes, very well, very clear.
Okay, thank you so much. Good morning, everyone, and thank you for joining to this call. First thing first, I think hope all of you in audience, panel, and your family members are taking a sigh of relief. Maybe I'll not say you have an issue yet, but with receding behavior of COVID-19, oblique Delta, oblique Omicron, whatever we call it as. But let's all of us continue to take precautions, because I'm sure most of us must have started going to office now. But I guess it's important to take the precaution, because this is not over yet, unless few months pass by without any more mutations. And well, praying for all, indeed, no doubt about it. I can only tell you this morning, we have an exciting panel on future of investment themes for family offices, where we'll be discussing about many emerging themes and where lies the future of family offices to grow, to multiply, or sustainably grow forever a long period of time. Ladies and gentlemen, on this note, let me introduce you to my Shark Tank. Yes, I said Shark Tank because I have 5 seasoned family office bearers here from various geographies of our country. We have an August gathering of these learned panelists for this session. Let me introduce one by one to you. On my left, on the top of my screen, at least, which I can see, I have Mr. Amit Goenka, who is the Vice President Treasury and Family Office of Hindustan Composite Mumbai. Next to him is Mr. Parag Doshi. He's the Senior General Manager, Family Office of listed entity called Garware High-Tech Films Limited, Mumbai. We also heard Mrs. Monica Garware as a keynote speaker today on the investment theme. Then we have Mr. Shekhar Jadhav, who is the Director at Probity Advisors based at Pune, spending long time in the markets. Then we have Mr. Manish Verma. He is the head of treasury as well as the family office for Shyam Steel, Kolkata. And then last but not the least, we have Mr. Kunal Palta, who is the CIO of family office of Hero Cycles. Well, everybody knows Pankaj Munjal Group. There is no doubt about it. I don't need to throw any light on that for sure. So let me welcome all of you panelists and looking forward to you for an enlightening discussion, your views, basis specifically the vintage which you have in family office management and markets. Yeah. So maybe let me straight away jump to maybe on my first question, just to kick off the discussion. We have next 60 minutes. I have only one request: keep your answers short, precise, so that the audience get the actual summary and the juice out of that answer. That will be actually of great help, and that will allow everyone to spend a great time on this panel. Shekhar, let me jump first to you, because why I'm jumping to you is because this is a buzzword called fintech, digital. These have been buzzwords for last 1, 2, 3 years time. Little birdie tells me that you have invested in these platforms as well. What's your view on these themes? What's your view?
Yeah, so of course, fintech has been one of the buzzwords for many years now. But the prominence has been very, very clear in last 3, 4, 5 years. It's a structural story at play, in my opinion, because most of us are using mobile phones and internet, but that penetration in India is going deeper and deeper, and most of the financial services will get disrupted because of this availability of mobile phones and financialization of the entire country. So there are many, several things at play. Of course, lending, banking in a way, investments, insurance, and we've also seen an insurance, fintech in a way getting listed. One of the payments lending company also got listed recently. So yes, it's a big thing, and I feel it's a proverbial battle between the established players and the new age guys trying to get garner the market share and the share of profit pools, and that is how the profit pools will get redistributed in a way in the longer run, in 5-10 years. So that is it's an exciting space for sure, and a lot of investment activity, as you may have seen in the past.
No, sure, I can't deny more, because just can't agree more for sure, because this space has actually exploded. There is no doubt about it. Let me connect that, try and understand. Maybe let me move to Mr. Parag Doshi. Fintech, digital, etc., which we are talking about. Automatically, we have seen in this same space, we have seen startups also. So how is your family office looking at startup space, if I can use the word? Have you taken the same very seriously, or you've been out of that space? Because that's something which, just before our panel, Anand was talking on the markets. I could hear something from him also. So I thought it'll be keen to hear from you. Yeah.
Thank you, Sanjay. Thank you, Franklin Templeton and Transformance Forums, for this opportunity. I think last year, post the pandemic, there was huge liquidity in the market, which saw a lot of choices for the investors. Be it REITs, be it ETFs, IPOs, cryptocurrency, international funds, international direct investing, and also startups got a lot of interest in terms, not only in terms of valuations, but a lot of inflows also. Mr. Piyush Goyal, the Union Commerce and Industry Minister, has gone on record to say that we would like to create 75 unicorns this year. Total, India has about 83 unicorns, and last year we created 43 of them. There was some research recently that earlier unicorns used to take 10 years, now they are taking only 5 years to become unicorns. Government has also said that there will be an open network for digital commerce, the ONDC. India is the third largest in unicorns, leaving behind UK, and just after US, which had about 487 unicorns, and China, which had about 301 unicorns. From 2018 to 2021, startups have created more than 6 lakh jobs, which has added to our country. There was a recent research report also on family offices investing in startups, and it said that 75% of family offices are likely to invest in startups for the next 3 to 5 years ahead of VCs or direct investments or real estate or commodities. And fintech, as mentioned earlier, is the preferred choice, which is followed by enterprise tech, consumer tech, healthcare tech, agri-tech, and ed-tech. Also, last year, we've seen a number of platforms where lower ticket sizes for startups have been possible for investors to invest. One important new trend was listing of a lot of startups and being available to customers through IPOs. There were 8 IPOs in 2021, which garnered about $2.5 billion from the public markets. Self-made woman found herself among India's richest after her firm was listed. A Chennai-based firm became the first Indian software maker to list on the Nasdaq. A food tech firm achieved a market cap of 1 lakh crore within hours of trading. A fintech firm clocked a worst debut for a tech company since the dot-com bubble. And India, the answer to Google Maps, dropped a pin on Dalal Street and had the investors queuing from there. As far as our family office is concerned, we have taken some exposure and found good returns in them. But of course, a word of caution for the investors that this is a risky asset and not so liquid also. So one should take proper advice, which we have done and found good returns. Our allocation has been up to 5 to 10%.
Yeah, interesting to know, because startup, we have seen some exploded, like you mentioned, few of them, and some of them actually gone bust. They've actually dusted big time. So it has been a very, very mixed bag. There is no doubt about it, for sure. So let me remain with the theme, startup, and let me go to maybe Kunal. Kunal, it's very interesting because you are in an organization which has been there in hero cycles. That's the organization which has always been famous for in India. And I think all of us on the screen and everyone who's listening must have used those cycles. I can tell you that for sure. No doubt about it. But there's another segment which is buzzing or developing, or I can see startup has evolving now, is EV space. Now, do you think within the two-wheeler industry, you're looking at EVs as a space, as an emerging sector, which is the most talked about? Maybe audience will be happy to have your views. Yeah.
Right. Sanjay, first of all, thanks to you and Templeton for giving us the opportunity to share the panel with esteemed panelists here. Thanks a lot. Coming to the question, let me answer this question of yours in a slightly different, or let me tweak the question a little bit itself, and then I'll give the answer to that.
Sure.
I would say that EV per se is not the only theme. It is mobility which is the theme, basically, I would say. And mankind has always been obsessed with mobility because that has helped them grow very efficiently. It was cycles, then it became motorized, then cars, then planes became Concorde planes, rockets. And now all of that, which was fuel-based, is now converting to either non-carbon based, non-carbon. EV is one of the themes. Now you're already hearing hydrogen as the other thing, which many other players are also working on. So I would say the theme is actually not only mobility; it is about mobility as a whole, which is very interesting, and that has come up. And since we are part of initially what you said, the first form of mobility, which is cycles, but there has been such a big revolution in this space itself globally, and the way that we've seen trends in other industries, developing, emerging industries. West develops it perfects it, then the technology slowly and gradually shifts towards East. Things come to India in another 8-10 years, and they go further East in another 8 to 10 years. I think that is precisely the reason that you see the buzz today around EVs, because that is something that has happened in the West already in last 8-10 years. You already see the Teslas of the world reaching such bigger heights. So I think that is why you're seeing the EV as a space. The only point here is that this space still needs to evolve big time, because there are a lot of dots that are yet to be connected. We still do not see a lot of things as far as India is concerned, at least. We don't have great technologies around batteries here on the EV. India is constrained on the chemical side. Then you see about I would say the motors there, or or replenishment of the battery waste. That is a big theme. So I would say if you look at EV as a theme, there are so many parts as an industry that get connected as additional industries. So you will have a very big industry coming out of the battery space. You already see the Dabur Group making out that open offer just a couple of days back for Eveready. They see great interest in that business. There are players who are working big time in the startup space only on the motors. There are players that are working on the recycling of batteries. I think battery recycling is going to be a huge space as far as EVs are concerned. Then there are players like Toyota and Bosch, big players who are saying that there are better technologies than EV also. So they're working on hydrogen or maybe other rather than lithium-ion batteries. They're working on different types of other batteries. So I think mobility as a theme is in a very sweet spot as of now. There is a lot of traction that is coming because of the health of our mother planet, and precisely that is going to help as we go ahead. So we, as far as we are concerned, we are ourselves very excited. We used to do only pedal cycles till around 3 years back, I would say. And last 3 years, Hero Cycles being one of the rather the largest, biggest manufacturer of cycles in terms of volume globally, we've always felt this as our duty to develop the industry and go into the newer themes. Precisely the reason that last 3 years we ventured onto the electric bicycle space, at least, because it is the sister concern, which is Hero MotoCorp, that is already working on the other bit, which is through the FS of the world and in-house work also. So we've gone into the electric bicycle space. We've made some acquisitions in Europe for technology and for market reach. Europe seems to be at the center of at least the electric bicycle space. There's a huge market, and we feel that trend is going to get replicated in India as well. And what has happened owing to Corona, people have latched on to cycles as an amazing instrument for health as well as recreation. Now people have started using cycles even to commute to offices. I think this is a very interesting time for mobility overall as a theme. EV, as I said, is just going to be a subset for industrialists, for investors. There are a lot of things that everybody's going to get out of it.
Yeah, no, sure, I agree with you. When we were kids, when we used to ride, we used to feel those potholes for sure. Let me just understand a bit more. Maybe let me move to Amit, for example. Amit, mobility comes in. EV comes in, development comes in. I'm sure infra can't be behind. So if I go back to the infra space, for example, which is one of the most interesting space right now, and something which is very well talked about in union budget also this year, which had a huge focus. Do you want to touch upon on the infra side, whether it's residential, commercial, ports, roads, airport? This can be a big theme for family office investments also, which is the emerging one.
Yeah, thanks, Sanjay. First of all, giving me this opportunity to be part of this panel and the nice audience. So now I wish to say that infrastructure is the backbone for any economy. If we talk about EV, if we talk about mobility, that infrastructure has to be there. And the extent and quality of infrastructure determines the ability of the country to utilize its comparative advantage. So if you wish to speak about the real estate, in a recent past, while addressing our event, Amitabh Kant, CEO of Niti Aayog, has just said this real estate market will touch about 1 trillion size in 2030. This will be about 80 to 20% of the India GDP. And this real estate plays a multiplier effect in the development of any economy. So this is going to be a very big theme for Indian economy and the development of real estate. As far as roads are concerned, road transport is one of the most cost-effective and convenient modes of transportation in India. So there has been a consistent increase in the construction of national highways and the roads in India over a period of time. Further, airports in India has emerged as one of the fastest growing aviation market, and the domestic tariff in India has more than doubled from around 61 million in 2013 to around 137 million in 1920, registering a growth of about 14% per annum. Government of India took various initiatives to boost the aviation sector, which included calibrated opening of domestic sector, disinvestment of Air India, privatization, modernization and expansion of airports, boost the regional connectivity scheme, that is UDAN. Further, the Indian ports performance of the economy is crucial for trade competitiveness and economy. Expansion of port capacity has been accorded the highest priority by the Indian government through implementation of well-conceived infrastructure development projects. As per the latest government release, the capacity of 13 major ports, which was 871 million tons per annum at the end of March 2014, has increased by 79% to 1560 million ton per annum by the end of March 2021. All these figures gives us a very good opportunity to think about the infrastructure segment, and considering the thrust of government, Indian government in infrastructure segment, I perceive that this space is going to be a big investment theme for family offices, and it can generate a very good return in the upcoming years.
Sure. No, so can't agree more, because the reason being that even whether looking at a union budget focus, or you look at the PSU expenditure which is coming in, that's primarily into this space of infra. There is no doubt about it. And I'm sure none of us can stay away from this development area, no doubt about it.
Sanjay, if I may add on to what Amit just said, we were just a little while back debating on the EV space. There is a huge scope for infra investments even in the EV space. You're already aware the biggest shortcoming that EVs currently have is the battery cost and so if you take away the battery, the vehicle actually doesn't cost that much. Because of the battery size, it is the cost. So from infra perspective, you're already seeing government is investing huge in the charging infra space. There are private players that have started putting up, and rather I hope and I think this is going to come up that government is going to give the tax ops for even individuals to put up the charging infra outside their homes or offices or shops. You just set up one charging point, and whatever money that you invest, government might give you a break for that. That'll help.
Yeah.
I think ramping up the charging infra, further pushing ahead with the EV as a theme. You already have so many battery swapping options that are being utilized by e-rickshaws, at least in the major metros, and e-rickshaws are the biggest revolution that have actually pushed this country ahead on the EV as a theme. There were no scooters or cars or trucks or rockets. It was e-rickshaw only that was on the ground. Imported shabby rickshaws from China, maybe, but that has actually taken the livelihoods of these rickshaw pullers to a different level. And if you today, they were making what 200, 300 rupees a day. Now they're paying rent of 250, 300 rupees a day on that rickshaw and making 2 times more on that flying that rickshaw every day. The kind of improvement in lives that they've seen, and what that has pushed is created completely a different industry on rickshaws, on batteries, on repairs, and plus now the battery swapping that has come up with that. You will see software services around these services. So a lot of industries are actually I would say peripheral industries are going to get developed because of this. So employment opportunity is huge, investment opportunities are huge. We are already seeing a lot of private equity funds making investments in these peripheral investments in the EV space also.
No, sure. I so completely buy your point, because I'm sure we are just tracing what West has done over a period of ages. We are just following that. Let me go to my heart, okay, and ask maybe Manish, all this, whatever everybody said, that Shekhar said, Amit said, Kunal said, Paragji said, let's talk about equities. Ultimately, that's where the money is made about, right? Let's talk about that. Direct equities, of course, is a backbone and a heart of family office portfolios. What's your view today on managing the volatility, and especially for a long-term investor like yours? Let's talk about that.
So first of all, thanks, Sanjay, for the opportunity and to Transformance and being part of such a great panel. So, the underlying highlighted word, as you rightly said, is long-term investor. And if you're a long-term investor, how you should be thinking about equities is all that you have to define when you begin the journey. For us, it's very clear that the buyers make more money than the sellers. So we are a buyer. all the time.
Okay.
We were a bit inactive last year in the middle of the year when the valuations were running out of control. But since the time the market peaked out in October, we have been regular buyers. And the key there, when you do such kind of disciplined investing, is what is it that you're going to buy and what is it you're going to avoid, even when you're carrying that in the portfolio. So how are you going to weight it, right? And with that kind of a discipline, with clearly defined objectives in terms of how you're going to select your companies, what kind of quality of companies are going to be there, we have been, and I'm happy to share that, is that we have been able to expand our alpha by over 1.5% in the last 5 months since the time the market started to actually correct. Now, how did that happen? The way it happened was that we created this whole approach about, first of all, what are we going to buy? Second of all, how much of that we are going to buy? Now I'm carrying something in the portfolio. Am I going to add more? Am I going to hold it? Am I going to reduce it? Now, those are the key questions that we answered. And then we just went about in a very disciplined manner to make sure that we keep buying at every single opportunity. So we have defined parameters, we have defined limits at which we'll buy. And that has worked out beautifully. Now, from a long-term investor, that's another question. I know, how to think about it. In the previous presentation, the fund manager was talking about valuations.
Yeah.
I think that's very interesting right now that if I look at the trailing PE, we have corrected significantly from 31, 32 to around 24. And that's almost like a 25% correction. But if you look at the forward PE, given everything that people are talking about at a 930, 960 EPS for 23, we are talking about a valuation which is around 16.5, 17 levels at today's market for the Nifty 50, which means that we are just about at the long-term average. Now, if you're a long-term investor, market could go down further, we don't know. But if you're a long-term investor, if you're not thinking about investing now and you're panicking, then you will not be able to make money. In March 20, by the way, we were still, after the market had corrected significantly, we were still talking about some 21, 22 levels on a trailing basis. And today, on a forward basis 16 and a trailing basis 24, we are not really too far away from those levels. So for a long-term investor, I think this is a great opportunity to buy good quality stocks at valuations that seem much more reasonable today than what they seemed 6 months back. So that is what our view is, and we continue to buy.
No, so let me extend that question and ask you, last 18, 20 months have been a secular rally, one way if you can look at equities, you talk about IPOs, you talk about somebody mentioned about P's buying and exits are happening, etc. Do you think there's some sustainable from today, from March 4th onwards? Do you see that?
So sustainability, definitely. I think the earning growth on the the top line doesn't seem to be going anywhere. Where we are going to have precious gross margins. This is very interesting, and being active investors in the US also, what we are seeing is that a company comes today and says my gross margin or my EBITDA is going to be lower by 5% or 2%, or my EPS will decline by 0.5%, and the stock gets cut by 70%. So what's happening is that the market is very, very quickly aligning you to forward expectations. So now if the earnings continue to grow, 0.5% doesn't deserve a 70% cut. Even in India, we have seen companies being cut by 40%, because they've just missed expectation marginally. So my point is that, if the revenues are going to be in place and when things start going bad, people think that there's no, tomorrow is all going to get finished today. And that doesn't happen. The bad case, the worst case doesn't happen. The best case doesn't happen. So this is the time when you slowly start accumulating. And I think sustainability is definitely there in India. All of what Shekhar talked about, Amit talked about, Kunal talked about, Paragji talked about is the fact that, we are growing infrastructure. There is so much investment, EV, there is so much investment, startups are booming. So then how are we being positive on all of these things and being negative on the companies in the listed space that are going to drive it? Second thing, very importantly today, and a lot of people think about it and they say, oh, SMEs are not doing well. The growth is coming in the organized segment, which is correct. But, when you're looking at it as an equity investor, you are focused on the listed space. And the listed space seems to be taking up space from the unorganized, the SME space. Now, that might be bad for them, but as an investor for you, all you're looking for is that the companies that you're investing in, are they in a position to gain the market share which somebody else is vacating? And if that is true, then today's valuations are definitely giving you a sustainable situation.
So Amit, let me flip the same question to you. Have you been able to utilize the same space in the last 18, 20 months or made some money, made some good bucks out of the exits? You're on mute. Sorry. You're on mute, Amit. Yeah.
Sorry. I think every big investor in the last 18 months have got benefited by one-way secular rally in the equity market. So we are not exception to this, and we have also got benefited from this one-way secular rally. And I completely agree what Manish said. We were also till June 2020, we were also a little conservative. We have not allocated a big chunk in the equity markets due to uncertain economic events led by the COVID-19 pandemic and all. But July 2020 onwards, we have started allocating equities in a big way. We have bought Nifty ETFs, sectoral AIFs, large cap, multi-cap PMSs, PIPO funds, and private equity funds, which really proved to be a very good investment decision by our treasury. So we have seen also a very good IPO season in between, and the decent companies got listed in the last 18 months. So we have played this theme through IPO funds and not directly allocated our money to this pre-IPO thing. So which has also proved to be a good part for our treasury. Further, we have seen a big jump in our portfolio, which we have never seen in the last 10 years period, which we have seen in the last 16, 18 months. And as far as exits are concerned, in the last 3-4 months, we have exited from some healthcare and pharma funds and mid-cap and small-cap space. And we think now market has corrected pretty good, and we can go ahead and buy something at this point in time, which Manish rightly said that the market has valued correctly now, and it will give you a good opportunity for us to invest further. But at the same time, like you said, whether this will sustainable or not, this rally will be sustainable or not. So I think this one-way rally, which we have seen in the last 16-18 months, we can also go in the past and see. We have seen this kind of dot-com bust. We have seen this mortgage subprime crisis. And after that, the market has gone up like this. So this year also, we have seen this pandemic thing, and the market has gone up afterwards. But this kind of rally does not sustain every year. But obviously, at this point in time, when the market has corrected significantly from their highs, so at this point in time, we should invest gradually, and we should see the sustainable economic growth in the Indian market led by the Narendra Modi government. So I think India's stories is yet to be played out. And there are so many things which we have spoken about, which we have talked about. I think this will play a very good role in the economic growth of the India. So obviously, looks to be a good time to gradually invest or gradually increase our equity allocation in the different parts of the equity.
No, so I'm not surprised. As an asset management company, I can tell you, I see a FOMO factor, which people missed out over the last 18-20 months of secular rally. People feel they've actually missed out. Hopefully, this dip is a great opportunity for someone to maybe enter into, because that's not a bad time to look at. With valuations have corrected October onwards till now, we are already entered into March now, and I think people are looking at. So buy the dip, maybe it continues to be a big story for sure. Let me move from domestic market to overseas market and move to Mr. Parag Doshi. Mr. Doshi, people talk about last 1.5 years, 2 years have been a big story about overseas investing, exposures to US market. FANG became a real, point to talk about, abbreviation to talk about. Scorching NASDAQ, we saw people have taken exposure there through various approaches at direct markets or through mutual fund ETFs, etc. They have been in vogue. Have you also taken exposure to overseas markets, and how it has worked for you?
Yeah, sure.
And maybe add on to that, what's your advice to the investors and audience who is listening to this call?
Yeah. In fact, the Ukraine-Russia conflict underlines the fact that one should have diversification abroad also. Today only I was reading in the newspaper Mr. Mark Mobius mentioning that markets could go down a bit also if this conflict enlarges. There's a very interesting WhatsApp floating around on social media where Mr. Putin is saying that for the next few days, I'm going to manage your portfolio. Of course, international funds is very important as a diversification. Last year, we have seen about 22 funds which have been launched. We have seen a lot of inflows in them. I think from 4,000 crores, this category has gone to about 40,000 crores. I think Franklin also has some international schemes. Some funds did very well. On an average, I think the category gave about 12% return, and some of the funds have even given more than 20% returns. We saw last year some funds launched on the Taiwan ETFs, on the Hang Seng ETF, on MSCI Global ETF, and Global Sector Real Estate Fund also. And many more funds I understand are in the pipeline, which are going to see themes like fintech, e-commerce, cloud, AI, electric and autonomous vehicles in the near future. An interesting thing we noticed as a fund, as a family office, we have also invested in the international space through domestic funds as well as through the direct equity platform. And we have taken exposure up to 10%. And in the last year rally, we also made good returns over there. One interesting thing which we noticed is that from the taxation perspective, direct equity exposure globally and through 100% international funds is treated as debt taxation. But in case you invest in funds in India, like I think Franklin has a technology fund, where there is some exposure to global investments also, then if the majority of the investment is in India, up to 75%, then the taxation is equity taxation. So we have taken some exposure there also.
Right. Okay. Yeah. So up to 65% exposure, if it is in India, it's actually qualifies to be an equity fund, and that's always welcome. So let me move to Shekhar. Shekhar, I'm sure equities, Manish talked about, Amit talked about, Paragji talked about, etc. We have seen various sectors actually showing scorching returns. So we have seen metals, we have seen sugar, we have seen chemicals, maybe super specialty chemicals. They have been rallying like no tomorrow. And even today with Ukraine-Russia issue, I mean, metals have again fired. So have you been beneficial to these sectors? And what's your advice, more importantly to me, because these sectors have run up to an extent, but going forward, what's your advice to audience? That's even more important, I guess.
Yeah, sure. So yes, all the three sectors, Sanjay, you mentioned, have made a lot of money for the investors in the last 2-3 years. Speaking specifically of chemicals, chemicals has been a strong cycle, not just for last 2-3 years, but even before that, maybe 5-6 years for sure. And we've seen a lot of supply chain being shifted out of China because of other geopolitical issues to India. And India remains a very small portion of the global chemical supply chain, be it commodity chemicals or the specialty chemicals. So whatever, even if small amounts come out of China and come to India, for the Indian industry, it's a big capex opportunity and business opportunity. So that has been at play. A super cycle, so to say, is in play, specifically to India, not specifically to the global markets. So yes, chemicals. We see a lot of PLI schemes. This China Plus One we spoke about. So yes, it's been a very good space. Having said that, a word of caution at least from our perspective is, I'm not sure how much of this growth is already priced in the stocks. So that is something you have to be very careful about. Not just pick random chemical companies and start allocating because it has maybe corrected 20% in the current last 1 month or so. You still need to be very careful about how much growth is still going to come in and whether the current valuations justify that kind of a growth. So that is a word of caution there. Speaking about sugar, I'll come to metals later. So sugar has been again another classic cyclical commodity. And we've been studying and investing in sugar for last 15 years. It's a funny commodity, you keep tracking what Brazil is doing, you keep tracking what Pakistan is doing, you keep tracking about what Indian government is talking about sugar and everything else, and make up your mind in terms of how cycles are developing and make quick entries and exits. I've personally never held any sugar stock beyond say 9 months. I'm
Okay,
happy making
that's
that
interesting
money
to know.
and yeah. And again, sugar, again, as I said, 15 years we've been in this sector. We've played the cycle say 3-4 times, not more. Otherwise, it will take away whatever money you've made, and maybe you will make losses if you keep holding on to it for a long time. So you can't take large exposures. You also need to be very nimble in terms of your entry exits. And the investable universe is very small. So you can't, beyond 2-3 companies, we don't even look at sugar companies. So that is on sugar. But sugar lately has been in a different sector because of the ethanol story.
Yeah.
Now, ethanol, you may have seen that, in the past also ethanol came in terms of blending. The government made announcements, and, a lot of, sugar companies invested into ethanol. Blending targets never met, and, that story died down. So, nothing happened in reality in the past ethanol cycle. Ethanol cycle now is again, come back up. Hopefully this government seems to be very serious about the blending targets and all that. So, probably, the vagaries of the commodity cycle, the classic sugar commodity cycle probably may impact less now going forward for the sugar companies because of the ethanol coming in. And they might become slightly stable in terms of their numbers and performance. So that's what I feel. But it all depends on how we achieve the blending targets and all that. And asides of sugar, ethanol, you have other capex plays also, which probably are maybe slightly better in terms of playing the cycle if you want to play the cycle.
Sure.
So that's on sugar. Metals,
Sure.
again,
Yeah.
classic commodity. We participated in the past. It has a counter-cyclical behavior. So yes, but right now it seems in the past, because of past as in last couple of years, because of Chinese issues and no new capacities and everything else, we saw a huge rally in most of the metals, ferrous, non-ferrous. And then there was a period of lull and some bit of correction in the for some time, but now because of this new geopolitical situations, probably aluminium maybe another few years of growth, and we already see that most of the aluminium companies performing in the last 1 week or so. So yeah, I mean commodities in general, you have to be very careful, be nimble. Many times we have seen that these are not long-term buy and hold kind of stories. You have to be.
But as of today, if I were to ask you, you're a thumbs up or a thumbs down? Let me ask you straight. Only one word answer.
Aluminium is a thumbs up right now.
Okay.
Steel, yeah, maybe. But aluminium for sure. Yeah.
Okay, good. So overall, it's a thumbs up, at least looking at the current situation for sure.
Yeah.
Okay. So let me, like I moved to equities earlier to Manish, maybe let me move to Kunal, exactly opposite to that. Let me ask you a very straightforward question. Family offices do use yellow metal either as a hedge or as an investment. Have you used gold or silver, or maybe if I can say US dollar as a strategy to hedge the portfolio, or completely no?
So we have in the past invested in gold, but that was not, I would say, as part of hedge in the portfolio. That was merely as an allocation of up to 5% in the portfolio. We've never done that either. We'll reduce equity. So whatever equity has been there in the portfolio, it's only for long term. and gold is as part of just an allocation, because we never thought that it is going to be hedged, but certainly in times of distress like these, we've seen in the past that the value shoots up. Unfortunately, there are so many other factors that also play in terms of valuing the metal, that despite such huge distress currently also, gold has also reacted, but in terms of investing in India, you got a bigger factor, which is currency, that plays. So internationally, gold might go up, but if currency doesn't move up, you don't tend to make that kind of money. And fortunately for the country, currency has been super stable for last at least 2 years. It has corrected a bit in last a month or so. Today it's trading about 76. So I would say we've not been very fond of investing in gold, but we've held in the past some allocations. Currently, we don't own any, neither as allocation nor as hedge in the portfolio. As far as currency is concerned, the business already has a lot of currency exposure, both from imports and exports. We have some businesses which are based out of Europe also. There also we've got a decent bit of investments in currency. So from that point of view, so to say, the business has already invested decently large chunk in foreign currency, which in terms is appreciating as the INR depreciates. But from investment or treasury point of view, we don't take positions, but business hedging or positions we do take, and that has helped us in the past. But that is purely from operations point of view, nothing to do from treasury. So we do keep a very close track of this, because we as treasury feel that debt and currency both are the precursors to what are going to happen in the other asset classes.
So anybody in this group uses gold as a strategy? Shekhar, Amit, Manish, or Parag ji, anyone uses gold as a strategy? No, or you're all out of that?
We don't.
No. Okay.
I think gold is a pass. Except for Russia, nobody's been holding gold.
Well, Kunal, 43,000 in October to 4th March, 51,000. You can't say it's out for me. For sure, I can tell you that. Maybe let me be devil's advocate. Okay.
Personal accounts, we do hold some, but I think it's a craze in the family, in every Indian family, that people want to hold gold.
Well, ask me. I Marwadi can tell you better, for sure. No doubt about it. Sure. So, so we talked about equities, we talked about themes. Let me also talk about, let me move to Amit maybe. Amit, alternative investments have been, part of family offices, no doubt about it. Have you taken views on AIFs, PMSAs? What type of scope do you see as a great opportunity for you? Amit, you're on mute in talking, sorry.
Let me tell you first that AIFs and PMS are most appropriate vehicle for investment for large family offices, unlike mutual funds, which I think is more appropriate for retail investors, because we get a lot of good quality investment manager managing these funds.
Okay.
The outcome of investment in PMS or AIF is purely dependent on the behavior of investor of that particular scheme. But in mutual funds, a lot of investor decides about their scheme outcome. So I think PMS scheme and the AIF scheme is more beneficial for the large family offices. And as far as PMS schemes are concerned, they offer a higher degree of transparency, and all activities of buying and selling happens directly in the name of the investor. And that is also in a structured manner, according to the defined parameters set for that particular PMS scheme. If an investor wishes to take concentrated bet on securities with a limited pool, PMS schemes are best suited and can be chosen according to the theme and style of that particular PMS scheme, and according to the behavior of the particular investor. Since our treasury is also having a risk-taking ability, we follow a strong risk monitoring process and having a higher investment horizon. We invest some portion of our funds through PMS and AIF schemes and found most of them beating the benchmark. In my opinion, the success of any prudent investment manager through PMS also depends on the manager selection, number of the years of experience of the fund manager, his performance through the business cycles. So while selecting our fund manager, we also consider these parameters and keep selecting the good fund managers for our PMS and AIF schemes. Further, with my limited experience, I have seen some fund managers consistently beating the benchmark, push management fees and carry. Such fund managers offers a very good scope for family office to invest through these schemes and optimize their investment goals. So I think these schemes are very good for any large family office if they consider this.
Okay. No, sure. I agree with you. So let me move to Mr. Doshi. We look at so many emerging themes coming up. So which are your 3 top emerging sector bets which you feel maybe you're happy till now, you must have made money, or you're looking at further for investments, and what's your advice to the audience?
Yeah, many sectors look interesting, like Shekhar mentioned that sugar is interesting, chemicals are interesting, textile looks interesting, autos look interesting. But three sectors or themes which we are closely tracking is one is real estate, one is the banking space, and one is the infrastructure space. So on the real estate side, we are seeing a lot of signs of healthy growth since the pandemic in this sector. We've heard many market experts saying that this sector is looking very promising because of the lower interest rates now and the liquidity available in the space. The housing sector is quickly adopting to digitization and innovation. The work from home concept has emerged as a dominant undercurrent for shaping home buyers' preferences. And amalgamation of commercial real estate, co-working space and grade A offices with well-connected infrastructure has gained a lot of momentum. In fact, some state governments have reduced stamp duty, which has also helped the cause. In the banking space, we feel that now the sector is improving from stable. Balance sheets are more strengthened, there is a improving credit demand, and with rural demand improving, this sector also should do well. The public sector banks space should do well from recoveries from their provisions and NPS. The NPS cycle seems to have bottomed out. And in the private sector bank space, due to their superior product and service proposition and technology enablement, mobile banking, they should do well. As far as the infrastructure space is concerned, due to the budget push, it looks very promising. Some of the infrastructure funds have delivered about 50% return, but some of them have even gone as far as 80% return. So overall, these 3 themes look very promising, and we are closely tracking it. But again, a word of caution: these are sector bets and high risk bets. So one should cap their exposure to up to say 10% of the portfolio.
So let me move the same question to Shekhar also. Shekhar, what's your take on though you talked about metal, sugar, and all that, which I asked you other question, but let me still ask you, for the audience benefit, which are the top 3 sector bets which you feel is good?
So Sanjay, in terms of long range, investment themes that we are tracking and looking at, taking small bets also is, we talked about fintech, so that remains one of our, top, ideas or, ideas to track and look at how we can participate and invest in that. The other 2 are, one is a D2C, direct to consumer segment. India, we believe, is going to be a huge consumption story in the next 10 plus years, and direct to consumer is catching up in a big way. So, be it food, beverages, small categories within that, be it, broadly in staples or discretionary, is a very, very exciting category to look at. And, many of large companies in the FMCG space listed have also realized that D2C is the way to go. And they are also taking bets within these segments. So, you can, look at some of these large listed. We are also, looking at unlisted space where, a category is created or developed, and then, eventually they'll get sold to a larger player. So that is one thing we are looking at. The other thing, the third thing we are looking at is agri-tech. Agri, we have a huge dependence on agri, and it's an extremely unorganized and inefficient space in the country today. But we believe that there is tremendous amount of work happening, and there is huge scope to bring in efficiencies by use of technology. So that is one thing we are very excited about. There's a lot of work happening in agronomy, supply chains, market access, warehousing, farm to table within the generic agri space, agri tech space.
Right.
So broadly, these are the three segments that we are very excited about in the next 5 to 10 years.
Wow. I can see very different kind of views for sure, either from Mr. Doshi as well as from Shekhar. I can tell you for sure. So overall, net, I can see definitely it's booming markets, all across. If I were to look at, or maybe look at various sectors, each one of you talked about till now, I'm sure it looks to be interesting. Let me not leave this opportunity, to throw a very pertinent question. Maybe Manish, let me throw that at you. Cryptocurrency has been the biggest theme in alternate investment globally. India, we have seen hordes of investors. Can't happen that India will not catch cold when world sneezes. Okay, do you want to share your experience with the audience on this investment theme?
Yeah, sure. So, crypto is generating extreme reactions from people. People love it or people hate it. People think it's Ponzi. Some people think it's great. So my, thinking always is, and you started the session with startups, right? And when you startup 101 is clearly about what is the problem you're going to solve. Is there a problem you're solving? Or are you sticking to the same thing? Now, when you look at it from that perspective, you realize and you go back and, Shekhar talked very nicely about fintech and how fintechs are talking about inclusion, financialization, etc. And then you go back to 2008 and, when crypto really kind of started. And what was the objective of that first set was driven by the, Occupy Wall Street kind of movement, where the middle and the lower class got, wiped out when the Wall Street bankers didn't have any implication or accountability for their actions, which led to the GFC. And then you think about it and why this whole decentralized movement started, right? So crypto there is speculative element to it. However, the core objective, which is really decentralization, is something that has caught on. And when you think about it from that perspective, you don't want to be out of any movement which is people-led and which is decentralized and which is catching on. $1 trillion market cap is not small. Even if you say Ponzi, it's sticking around there. And it's sticking around because it's finding use cases. It's sticking around because it's finding an audience. It's sticking around because the audience thinks that they can relate to it. And the whole Web 3.0, which all your tech players are working on today, is an outcome of what crypto is. And to me, what is more important is that including our own RBI, our own government in the budget declared that they want a CBDC. Now, this is all a fallout of crypto. If crypto had not started, nobody was thinking about it. Now you can talk about disinflation, inflation, the impact on all of those technical aspects. But to my mind, you don't want to be out of the action on something that is getting this kind of legitimacy from the retail segment, which has been out of financialization. And when I look at the Ukraine-Russia situation, and you get two views on Twitter and all the other social media, some Ukrainian talking about the fact that they had to flee with nothing other than Bitcoin. Sure. And on the other hand, the Russians trying to hide behind Bitcoin or other cryptos because, the world is banning them from accessing anything else. Now, these are all things like, Kunal talked about how EV adoption is going to happen. Now, maybe the fuel prices are leading to EV adoption. Similarly, these kind of dictatorial actions by one person could lead to more adoption of decentralized currencies. And to my mind, you want to be a part of that action. You don't want to be sitting out and letting it run away.
Sure. So we are already inching towards time. We have around 3 minutes. Okay, let me throw one common question to all of you and ask you your view. It can be common answer. It can be indifferent answer, but I will give you only 30 seconds. Maybe don't take more so that we are within time. Let me ask you, interest rates are about to go up. There is no doubt. I'm sure yesterday Mr. Powell talked about, again, we are about to catch cold. That's what the market says. Okay. and $120 of crude price now. We're hitting that bar. Inflation is about to spike, but there could be something very different that US might delay because world economy may slow down further again, maybe, and all that. So there are very, very mixed views, and India is in a different situation. Which are your, say, top 2 themes? It can be anything under the sun, which you feel are ones which you want to advise to investors. Maybe I'll go with my screen. Maybe Amit, you have a 30 seconds if you want to throw some light on that. Amit, you're on mute though.
Yeah, actually, I referred the budget theme in which Mr. Modi and Mrs. Nirmala Sitharaman has announced about the capex theme. So I think India is in a growing phase. The temporary situation will go out of the box now. So taking the 3 to 5 years kind of view, I think capex will do better. Capex theme will do better. And to fund capex, banks and NBFC sector, that will also do better. I think these 2 sectors are the good space to invest in right now for the long-term view, 3 to 5 years type of view.
Sure, Mr. Doshi.
Yeah, I think banking, infrastructure, real estate, and in that the mid and small cap space also looks interesting now after the valuations have become reasonable.
Only top 2, sir. Only top 2.
Yeah. So I'll go with the banking and infra.
That's fine. That's fine. That's fine. Kunal.
I'll break it up into 2, equities and debt. So equities, we like banking space with interest rates rising, and we feel there is more scope on the chemicals also. So these 2 for us in equities. On the debt side, we've sold all the duration, so we don't own any duration. We'll be going either for at least next 3 months in fixed deposits or very low liquid funds.
Yeah.
Second would be we like the REITs and InvITs as a theme because of their a lot of debt behavior and the stability that they offer owing to the stability of businesses. So, and we count those as part of our debt portfolio.
Okay, Manish.
So, kind of sticking to what I continue to believe are secular themes in India is consumption.
I hope number 1 is not crypto for you.
Not really. Consumption and sticking to consumption. Within consumption, QSR is something that we feel very excited about, whether it is a Zomato or something else. And the other thing that we are excited about is banking financial services like everybody else.
Okay, Shekhar.
Same thing. I think banking seems to be the flavor. So we are also very excited about banking, public sector, private sector, both,
okay,
and consumption. These are the top two broad themes for us for the next 3 to 5 years.
Well, I can definitely see these are all interest rate agnostic sectors, if I can, for sure, I can use the word. And I think whether it's staples, consumer, discretionary, or you talk about banking or financials, if I can use holistically, for sure, looks to be very, very interesting, no doubt about it. Ladies and gentlemen, we are at the hit of 12:45 hour, so time which were given to us. But I can only tell you one thing for sure right now before we conclude this call. In this financial world, the more your money works for you, the less you have to work for your money. And these sharks, with the 5 of me on this call right now, have money in their family offices, who have used all sort of strategies, starting from equities to debt, to hybrid, to alternate, to startups. They have looked at it, including AIFs and PMSs and everything. So I think they're all very, very experienced gentlemen. Thank you so much for enlightening the audience here, and I hope you had a great time in this panel discussion.
Thank you.
Thanks a lot.
Thank you.
Thank you, Sanjay. Thank you. Nice interacting with all of you.
Thank you so much. Thank you, everyone.
Bye-bye.
Thank you.
Thank you so much, Sanjay, for moderating it so like a rock star, and also those insights that have been very in-depth. It's been an exciting discussion. Thank you, all of you, Mr. Kunal, Mr. Parag, Shekhar, everybody on the panel. Thank you so much for joining us.
Thanks, Sharon. Thank you so much. Thanks, everyone. Thank you. Bye-bye.
Great. So with this, we now move on to our next presentation, which is on the global lens, critically of regulatory, legal, and integrity management for family offices. Please join me in welcoming Mr. Arpinder Singh from the Global Markets in India leader, Forensic and Integrity Services, EY. He brings in 25 years of enriching experience in multi-jurisdiction investigations, forensic accounting, and dispute advisory. He is the practice's global managed service leader and a member of global leadership team. He has also worked with corporates, regulators, and law enforcement officials on many high-profile and global investigations across sector. A very warm welcome to you, Arpinder. Over to you.
Well, thank you so much for that, Sharon, and thank you for everybody to invite me today. I think I was just listening to the conversation earlier. I think that was all about growth. I think my conversation will be all about conserving the growth in that sense. So for the family offices, I think it's very important in today's day and age. As you read newspapers today, and compliance issues can cause so much disruption in valuations and can cause so much disruption in reputational losses, can cause problems which you cannot quantify and you cannot value sometimes. If you look at the current conflict which is happening in Europe, I mean, the values of certain companies have actually dipped just because of this, their presence there or their linkages there. So sometimes you have to assess the risks considering compliances, which I will try to focus on in today's conversation. But again, thank you for inviting me today. Ruma, if you can go to the next slide. So a little bit, I'll try to cover around why obviously family offices are becoming very, very strong, and they become a very important element of the economy. It was mentioned in the previous session. Every promoter, every HNI in India I've seen is getting into family offices, and we are obviously our number of HNIs is significantly increasing based on the number of requests we have been getting to do things like background checks on individuals being hired into family offices, because it's obviously a very trusted inner circle. So I think the growth story, obviously, as I mentioned, comes with certain risks and challenges. And I think it's very important to make sure you capture them or you cover for them. So if you look at some of the risks that I see at a very high level, and I'll go into much more detail, is integrity is number one. Are you hiring the right people? Are you investing in the right companies? Have you done your adequate diligence before you hired them? I think these are all very important tasks, as I put it. The second is just general governance and compliance. I think having the right compliance framework as your family offices become larger, making sure tomorrow there's no inquiry on your organization, just like it would be on any corporate, is important. Cybersecurity, I think, is one of the biggest risks in family offices because there's so much confidential information, and you could potentially have issues where information which is very close to the family or confidential to you gets leaked, and that can be quite embarrassing. Privacy and confidentiality, obviously, I think is the most important part of a family office because there's so much which is confidential to family complexities between family members, complexity in the way the investments are done, complexity in the way the money is managed, I think is something which brings a slightly different dimension as compared to the way a corporate is run. And we'll go into some level of detail on that. If you can go to the next slide, please, Ruma. So what does integrity mean? It means honesty and accountability. So you've got to be honest and obviously accountable for what you're doing. After obviously the COVID-19 pandemic has brought a lot of issues to the surface, but 98% of the C-suites who we interviewed in India as part of our global integrity report, which just was released, said that disruption causes critical risk to ethical business practices. So there's always some shortcuts taken. People say, oh, we'll try to fix this first, and once we fix this, we'll focus on governance and compliance. It unfortunately never works that way. Even if you take simple thing like the Competition Commission of India, they came out with a guideline saying, hey, we'll give you a moratorium. We won't go after we'll give some easier approvals on merger acquisitions. But that doesn't mean that people take advantage of it and put wrong submissions, lie, or give incorrect information, because that will come back to bite you at a later date. Family offices are obviously facing heightened integrity challenges because of leadership structures, lack of robust risk management processes, at least what I've been exposed to. I don't see the same level of process in a family office as I see in a corporate. And that there are many reasons for that. Obviously, corporates 20 years back were exactly like family offices, right? They were all large startups to medium startups or small startups. And you kind of did things in a flexible way so that decision making is quick. And for decision making to be quick, you need to obviously not have hundreds of controls. And second is a lot is based on trust. I would never encourage that family offices should be as you should invest as much as a corporate, but at least there should be a middle ground where you are at least mitigating some of the key risks. At least you should know what are the risks and you should mitigate them. Some of the concerns why these integrity challenges are happening, one is remote working. So they weaken controls. People are working from home. that may expose family offices. So for instance, you have a CEO of a family office, or a head of a family office, or a CFO of a family office, or a legal head of a family office sitting out of a home. Their kids come share their devices, or they connected their TV to the Wi-Fi, to the iPad, to the iPod. So you're connecting multiple devices at the same time, which obviously exposes you to much more enhanced weakened controls. Internal fraud, obviously, if you look at our survey, it said 32% leaders said that bribery and corruption is actually still the greatest risk. So is there a tendency to cut corners on compliance in the interest of growth? Sometimes that is a little short term in the way you look at it. So I think family offices are, of course, prone to internal fraud because there are fewer people, 4 or 5 people, key people who are making decisions for you. And obviously family members may have delegated or may not have delegated to the professionals. And even among family members, sometimes at least I have seen disputes come up on allegations of compliance and governance, where one family member is looking at one portion of the business, another family member is looking at another portion of the business, causes a lot of conflict sometimes. Third-party risks, obviously, with rapid digitalization, there is a reduced transparency in dealings with third parties. For instance, we've had recent cases where money has left an organization because the controls which were there earlier have reduced in the work from home. Just to give you a specific example, earlier for doing an RTGS transaction, you had to sign a few documents, physically look at the vouchers, send that to the bank, then the payment would happen. A lot of eyes were looking at it. Today, everything comes on email. Somebody could morph an email and say, I have the approval, when they actually don't have the approval. Payments get done, and no one's doing reconciliations on a timely basis like they used to when things were normal. So I think that obviously exposes you to many more compliance risks. And also these hidden high-risk relationships, these third parties who could be related parties. One family member knows about them, the other family member doesn't know about them. And doing business with third parties without doing adequate diligence, again, can expose you. Because I've seen in family offices a lot of partnerships, there are a lot of trust-based investments happening, and that can again expose you. Also in management oversight, as I said, the trust part is really important. I do believe always, some wise person told me many years back when I started my career in compliance forensic, was 80% of people sit on the fence. That means if there's not enough deterrent, they will end up doing the wrong thing. If there's enough deterrent, they will do the right thing. And that's a large percentage of all of us. And this was based on some studies done in the US and Europe, where people did test this theory out, and it's kind of worked out in that way. If you can go to the next slide, Ruma. So what do you mean by strong governance? Now going a step below. Strong governance obviously puts the do's and don'ts out there. A lot of times people leave everything gray. I would not recommend that. It's sometimes good to say this is okay and this is not okay. It just makes it easier for employees, whether you're senior, middle, or junior, it doesn't matter. People like to know what is possible and not possible. Also, it sets priorities and ownerships of the oversight to the family. So one of the things which families which lack clear governance structures may suffer from is conflicting goals. Are you clear about the goals and objectives? Are the sets being managed? Are they being monitored on a weekly basis? Are there things like derivatives and options which tomorrow could expose you to significant risk? People don't even know properly how to value them, because some of these derivative instruments, etc., can become very complicated. I'm just giving an example, for instance. A lot of investments happen into private companies, startups. We've been hearing some of the noise with startups, for instance, in the media. Obviously, there's some which have been very successful, and we're all very proud of it. And there's some where there are questions being asked from a compliance perspective. So obviously, that shows you that it's just important to invest in the right companies. There could be power struggle among leaders because, as I said, there are 4 or 5 people within a family office, so it's a small group. Also, unmet financial or investment needs. So, for instance, do you have the right amount of money? You've committed something. So, I think a good structure leads to a long-term success. And these are some examples, for instance, where there is a pull and push and conflict, which does set in. Family office is a fantastic example of parallel governance. It's more than even corporates, because everybody talks about corporate conflict between managers and owners. But I think it comes maximum, in family offices, because you have some level of business governance and owner governance. So I think the owners come in saying they want to hire the right people, human capital. There's a lot of emotional development. They help prepare the company for good stewardship, support the family mission. The family has a mission. A lot of family offices outside India, for instance, believe in sustainability, ESG, social and governance. That's their theme. So, the tone is set by the family, and that's what we call owner governance. And they ensure that they set the tone and say that we want governance, we want to invest in the right organization. This is our mission. This is our objective and what we want. And they obviously have to put in a good stewardship and hire the right people. Then the business governance comes below that, which is developing the business to provide operational confidence to the family. So they have to say, we're really running the company with right governance. Here's the policy and procedures. Here's an audit report. Here's showing that we're fully transparent. We're making the right calls. Show them that everything that is the mission is actually being done and there are no shortcuts happening. I mean, recently we did an investigation in a family office where the mission was to invest in hospitals, for instance. But the actual business which the CEO was doing in trying to shore up the value of the company and trying to show more profit was trading. And trading was never the agenda. And it always landed up in an issue because there was lower stewardship, lower oversight in that sense. If you can, Ruma, go to the next slide. So if you look at the right-hand side, these are, when you say compliance and governance, it really includes 6-7 elements which are mentioned on the right, and I'll walk you through it. I think the first is anti-bribery and anti-corruption. Everybody's aware about that. If you have money which is coming in from the US, or you have some joint ventures with US or European entities, you have the Foreign Corrupt Practices Act in the US, you have the UK Bribery Act in UK, you have different anti-bribery and anti-corruption acts in Europe, some like the SAP2 Act in France. India has the Prevention of Corruption Act. Very important thing, it's regulated by the CBI. You would hear of all these newspaper articles where you hear CBI investigates, CBI raids. That is when generally around POCA, as we call it, Prevention of Corruption Act in India. And that's the law that the CBI works around generally. Then the foreign trade and sanctions, you've been hearing a lot about the Russia-Ukraine conflict, a lot of discussions around sanction. People use that word loosely. What does that mean? It means you can't do business with you should not ideally do business with an individual who's in a sanctioned list. Generally, people refer to OFAC lists as a benchmark for sanctioned individuals or sanctioned entities or sanctioned countries. So I think it's very important if you're doing business globally from your family office that you keep in mind about foreign trade and sanctions, because if you start getting into bed, as we put it, with a person or an entity who has sanctions, you have a problem and a lot of questioning at a later date. Everybody's heard about some embarrassing stories around some of our HNIs in Panama Papers, etc. Some bit could be wrong and just good investments done outside India, and some could be where you just unfortunately or unnecessarily come under the limelight if you're not able to explain some of these accounts, some of these Benami accounts, transactions. And I always call this as a shortcut to save taxes sometimes, or it could be some other reasons. But it's always better to stay clear from any compliance issues or risks. Third is money laundering. So you would have all heard of the PMLA, which is the Prevention of Money Laundering Act in India, which is the statute under which money laundering is looked at. What is money laundering? Money laundering is where you could have potentially got money, you're using different layers to move money around, avoid taxes sometimes, and money which potentially could have also been got from ill-found means like bribery and corruption, etc. And in money laundering, it's basically suspicious transactions which go back and forth from your account, and that you come under scrutiny generally under the Enforcement Directorate. So just for your knowledge, the regulator on money laundering, like CBI is the regulator on anti-bribery and anti-corruption, the regulator on money laundering is the Enforcement Directorate. And again, you have heard of many cases where the ED is coming in. Now coming to pure play fraud, obviously for a lot of you, depending on how your family office is structured from a legal entity perspective, the Companies Act at least has a very clear definition of fraud, which most of us as professionals are using as a definition. It's a very broad definition which says any irregularity, basically, even if the fraud has not been done, if there was an intent to deceive, gets covered by the fraud definition. There's a lot of debate today between boards and auditors and investigators on fraud. How do you define fraud? I mean, you all read the newspapers. You've been hearing of a lot of cases where some bit of questioning is also done. Was this a fraud, or was this dereliction of duty, or was this an error which had happened? So those are all authentic, genuine questions which are sometimes supposed to be asked. Now, fraud, depending on your legal entity, has to be disclosed. If you are investing in a listed entity have reporting requirements to SEBI under LODR, the listing requirements. If you're a company, you have the auditor discloses it in his audit report or audit opinion. Directors have to report on that in their director's report. So fraud, once it gets into the definition of fraud, as you've seen in the banking assets, especially more recently around NPAs, this is a very debatable topic on when do you define it as a fraud, how do you report it as a fraud, what are your reporting requirements. So again, a very, very debated topic nowadays, and quite a hot topic nowadays. And then also, is there a materiality, etc. The Institute of Chartered Accountants obviously have come out with the 1 crore number. Now that's something which can be debated. How do you value it, etc. But it's at least a spoke in the ground. And data privacy and data protection is another area I think family officers should care about. Europe obviously has GDPR, which is the data protection rules, which are very strict in Europe. US has some California privacy rules. India, the data privacy bill has yet to be approved, though there's an Information Technology Act which puts down certain requirements around privacy, etc., which I'll go into in more detail in my remaining slides. Antitrust competition law, that's when you're cartelizing. I don't see much of that in family offices, but if you're investing in companies which have antitrust or competition law issues, then you should be more careful. Basically, it is when there are two types of antitrust and competition, more for your knowledge, is one where there is an M&A activity which gives the company monopolistic authority. A person who has monopolistic power misuses their power in squeezing dealers, vendors. Their contracts are one-sided, so those become an issue. And some is cartelization, which is the third leg of the chair, as I put it, which is basically where 2-3 companies come together to bid on contracts, and they basically manipulate the bidding and do cartelization to keep other bidders or other companies, third parties, out of the bidding equation. And then you have industry-specific regulations. If you're in the healthcare industry, you have certain regulations around healthcare professionals. If you're in the infrastructure industry, you may have to sign an integrity pact with the government. So if you're in the defense industry and doing offsets with them, there are different requirements. So different industries have, we don't have enough time to go into it, but every industry has their own nuances in their thing. One thing I would always recommend is make sure that there are two aspects of compliance. One is which is mandatory, where the compliances have to be done. These 10 policies have to be there. The law says it. And then the other good to have. I would say companies should assess both of them. Don't just do the bare minimum, because sometimes there's certain things which would only help you clarify the do's and don'ts, as I said, to employees and senior managers in your organization. Another thing I would recommend, a lot of companies I've worked with, including family offices where there have been issues, it's always reactive. Fraud happens, you make a bad investment, some senior leader takes money out, takes advantage of a promoter's trust or a family's trust. Then you start working on saying, why did that happen? And there's a lot of furor at that point of time. You find police cases, there's investigations which happen. And then somehow everybody, some companies or family offices do the right thing and they work to fix the process gaps to ensure it doesn't happen again. But others, I find this is the part where there's a weak reaction post an issue and there's weak reaction even before an issue. Why wait for an incident to happen? You should try to, address it. I mean, if there's other companies or organizations which have had an issue, you should learn from it and make sure. I always tell most of my clients that if something hits the newspaper and there's a modus operandi or there's a fraud theme, go back into your organization, ask your CFO or CEO and say, could this happen to me? If it can't, tell me why not. And if it can, what are you doing to fix my process to make sure it doesn't happen to me? And let's learn from somebody else's mistake. It's a smart thing to do. So that's what I would recommend. And also, as environments become more complex, people are working globally, it's more important to be compliant because you're exposed to more than just India. If you can go to the next slide, Ruma. Now the question is on exposure to cyber threats. I do believe cyber threats are critical. Most family offices I find often use personal email IDs. They follow very weak security practices. They sometimes give access to their admin person in the family office who responds to emails or checks emails, informs the family, oh, this email has come in. It's very loosely run. And I think the reason is generally a family office is starting off is very informal, which is a good thing, but that's where it gets you into problems. And as we've seen in our surveys, C-suite executives are 12 times more open to attacks by cyber criminals. In fact, 76% of the CEOs have admitted that they've bypassed security protocols in order to accomplish a task more quickly. It happens in the corporate world all the time, right? You want to do an app, you want to roll out a cool fintech app, you roll it out, cyber infosec clearances are not received, but you just launch it in the market. When you launch it in the market, it gets hacked, you then lose money, and then you start fixing it. It's just, it's like a truck without brakes, and you kind of run the truck till it bangs against the wall and you have an accident, and then you try to fix it. But why do that? It can be easily done more proactively. And I would say your biggest exposure in family offices is reputational damage. I think the fact is that if you look at your cybersecurity risks, it is so easy to stop some of the easy exposures so that you can at least mitigate some of the reputational risk which can happen in family offices. There's so much confidential information, financial, tax related, legal, as well as nuances in family agreements, why do you want that to become public? So I think it's very, very important to keep this part. I think this is the most critical part in a family office. You keep it tight, you will be all set. If you can, Ruma, go to the next slide. I know we've only got 5-6 more minutes. So what are the types of phishing? So what is phishing? And this is just, me as I'm not the tech expert, but I just thought I should raise it. If you look at phishing, it's when a business is contacted by malicious people. So, you get a WhatsApp or you get an email which says, please click on this because your credit card is going to be blocked and you need to give this personal information. Or like you see these examples which I've put on the screen, that it helps you. You have to confirm that you have authorized this particular company to initiate a one-time credit card, or something which looks a little odd, and it gives a link to a website. You have to click on that website and put in information. Never get taken in by this. Be very, very careful. In fact, I always tell people, look at the email ID this is coming from, make sure it's an authentic email ID. The best test is the email ID. More often than not, you will catch it. It's a very simple thing to do. You don't have to be this big tech guru. You can easily catch some bit of this. Some of the things is identity theft, credit card fraud, criminal activity using stolen identity is happening a lot nowadays. Stolen bank information or money, unauthorized use of accounts. Again, big problem because somebody uses unauthorized, money does come back, but it takes a long time. It's a very painful process. And the last one is your credibility. Somebody sending an email on your behalf, it causes a lot of issues. In fact, long time back, many scams had happened where the addresses on certain vendors were changed or the bank accounts were changed. And the email looked exactly like the CFO's email because the person had, through malware, got into the CFO's computer, was tracking the CFO's movement, was writing emails just like the CFO. And when they wrote to the finance controller and said, hey, change the account and make the payment by 2 o'clock because the family wants the payment to happen by 2, $100,000 just went. And getting that $100,000 back is just impossible. Another thing, I'm again not the insurance expert. I would recommend all of you should definitely see what insurances are out there. Because that's a great thing, which again comes up as an issue when the issue happens, because did we have the insurance? Who was responsible? Have you done insurance gap assessment? I think that's another area we need to become a little bit more sophisticated in trying to at least mitigate some bit of the fraud, which we are always exposed to. If you can go to the next slide, please. Some very simple practical tips on finding the phishing frauds. And this is applicable to all people. And trust me, you may think it's very simple, but it can happen. One is spelling errors, always happens in a phishing attack. Hyperlink, which I just gave you an idea. There's always a sense of urgency, like I gave the example that you have to make the payment by 2 o'clock. Or, your card will be blocked if you don't click on this and provide the information. They make it very frantic where you panic. And because you panic and click on it, they've got you. There's personal identifiable information they want, or there's a suspicious attachment. So if you have these type of 5 red flags, or there could be more, please be careful. Just think twice before you give anybody any information. Also, if someone calls you, don't give information on the phone. Somebody will say, hey, I'm a delivery person, give me your OTP, or, I've done that. Sometimes by mistake, you may give an OTP of your bank rather than giving an OTP of a particular delivery partner. So I think it's small things can get into a lot of trouble and can cause you harm and or disruption for quite a few months. If you can go to the next slide. So what is the confidentiality? Confidentiality is crucial in a family office because employees know intimate details of the family, the assets, the wealth, the personal relationship, disputes sometimes, even legal troubles the family is happening. The family office may also carry some data privacy risks. You should be so there should be a lot of information on confidentiality and non-compete provisions. So contracts you have with your key employees in a family office have to be solid, airtight. If you ask me, those contracts are the most critical for you, which will help you in the long run, because this is the most critical part of a family office: the confidentiality, the trust, the privacy. So I would say NDAs, contracts with your employees working in family offices, please make sure they're robust. If you can go to the next slide, please. So how do you address them? You can do strong people checks, where you can also make sure that, the people you're hiring are authentic. So, for instance, if you're investing in a company or you're hiring somebody, the background checks, the KYC. If you're investing in a company, checking the digital address of the target, using, any court records to check who's the person you're engaging with. Are there any, and there are a lot of vendors who do this for you, background checks, etc. I would recommend that. They're not very expensive, but can save you a lot of headache for the future if you're going into business with a partner or you're investing in startups which don't have great legacy on social media or through company records, etc. Also, when you're hiring somebody, look at the disparity between earnings and lifestyle. Suddenly you have an employee who's a finance controller or someone buys a Lamborghini, which is great for the person, but how's the person getting a Lamborghini? Trust me, there are very few basic things we've seen in fraud cases where the promoter or the family has come up one day and said, I kind of felt that because the person is going so many times to the US in the last 1 year, I wasn't sure how that happened. Also, as I said, a questionable background. And if a person has been caught by fraud in another company, obviously you must give everybody a chance, but it's something you need to dig into deep detail. Like, how did that fraud happen in the previous company? What was your role in it? Do you think the person actually was wrong? So that way, the person's past. As I said, I'm not saying whether to hire or not hire, but I would say, do your governance, do your compliance, make sure that the person you're doing business with at least doesn't have very obvious issues as mentioned on this particular slide. If you can go to the next slide, please. And so my last 2 slides. So physical security is extremely important. Obviously, if you're working from home, you may not have CCTVs at home. How do you ensure that somebody has not bugged your home or bugged your family office? In confidential information, which could lead to potentially insider trading issues, hacking, extortion sometimes. As I mentioned, you could have a lot of confidential information in a family office around disputes, family arrangements, investments, offshore agreements. All of that is so confidential in a family office. I feel physical security is so critical in a family office. And there are many ways to test for that. And I'll show you that in the next slide. If you can, Ruma, go to the next slide. There are 2 ways to do that generally. If you look at debugging, for instance, everybody talks about it. A lot of people have not been exposed to it. I would recommend you should at least be aware of it. So you can check for surveillance bugs, for instance. The first way is a thermal imaging device. So it actually tests. It's a device where you can check if there's a certain amount of thermal heat emitting from devices. So you can see if there's a particular bug lying in your office or family office or confidential room where discussions are happening. A second one is RFI. So it checks for any suspicious radio frequency transmission. So the experts who do this, and they can actually test for these if your family office or your boardroom is bugged. It's always good to test it once in a while. Let's say you find your confidential information is leaking out in the newspapers before you launch it through your PR agency, or you find that some of your deals which you're doing is suddenly in the media, journalists know about it way before you know about it. So never hurts them. And purpose of my session today is just so you are aware that this is all possible and people do this. If you can go to the next slide. So this is my last slide for the day. It's just giving you a holistic and practical framework for family offices. I would say first is identify and assess all your risks. Look at your devices, work and personal. Second is tailor the education awareness, digital footprint. Even if you have a small team in the family office, make sure they're fully up to date. You have proper monitoring. Look at all your relationships and inner circle. Make sure they're cyber protected, secure. You've done your background checks. Look at some of the cyber habits. Look at the environment you're working in to make sure that if there is an incident tomorrow, you have the proper response. You have somebody who can help you on the cyber side. You have somebody who can help you on the physical security side. You have somebody who can run quick background checks on them, who can come and keep testing and monitoring all your investments to make sure they're kosher, they're compliant. So I think a family office will never become a corporate, but you can do some bits of it. And I think that's it from my side. I know I've exceeded my time. But thank you for giving me the opportunity, everybody.
Thank you so much, Mr. Arpinder, for that insightful session. Thank you so much for joining us for the session today. It's been great hearing the presentation, all the insights that you've shared. Thank you. I certainly do not see any questions in the Q&A tab. In case I get, I'll certainly be happy to email it to you. It would be great if you can help us with the answers for the same.
Definitely, Sharon. Let me know. Thank you so much for inviting.
Thank you so much. Thank you. Okay, so with this, it's been a great session with a lot of insights through the panel discussions, presentation. We take a lunch break now. I request all of you to be back by 1:30. We certainly will start off with the session by 1:30 sharp. And yeah, a lot of excitement on the way. So request all of you to stay logged in. You can be on mute with your cameras off. And 1:30 sharp, we proceed with the forward sessions. Thank you.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I think Siddharth has a problem with the virtual background, I guess. Sharon? Sharon?
Yes, Sanjay, I can hear you.
I can see Anjali, Arun, and Srinivas, but I can't see Siddharth. Siddharth has not switched on his video, Siddharth, yet.
Yes, Mr. Siddharth, if you could please on your video.
But
we have set up the virtual background,
blurred. He's blurred.
Okay,
Yeah.
can you just go to the setting of the stop video icon? Do you see there's a small arrow there?
Yeah. Tell me. Video
Yeah,
settings.
just click on that.
Yeah, tell me.
Yes, so you get an option to choose virtual background, right?
Yeah.
Yeah, so when you go there, there's an option on the lower tab, mirror the video and green screen. So just untick, might be one of them are ticked over there.
1 second. I have a green screen picked here. Your device requires a green screen. Achha. So we need to sit somewhere else, right?
No.
Yeah,
It's
maybe-
absolutely okay. Now what you do is don't wait now. It's already a minute to go. I guess
Okay.
it's better you remove your virtual background and go on. That's all.
Okay. Okay. I'll just
Omi,
try
Omi
once.
just do it. Yeah.
Okay. Cool.
No point in struggling now. It's better you remove your virtual background and be there. That's all.
Okay, sure. Thanks.
बीच में कर पाओगे तो you can do it. Otherwise, leave it. That's perfectly okay.
Okay, sure. So a minute more to go. Sanjay, let everybody join back on the meeting. If any of them are like still not on the meeting.
So all are there. All four are there. Not an issue.
Okay, cool. Good afternoon, everybody. Welcome back. So as I mentioned, we have an exciting panel set up post-lunch. So that's on the views of equity markets and alternative investing, domestic and overseas. Again, I'm very glad to welcome our moderator, Mr. Sanjay Patni, Vice President, Head, India Institutional Sales, Franklin Templeton Asset Management Private Limited. The panelists who are accompanying him is Mr. Sheshadri, Srinivas Sheshadri, who's the head of investments, Mirabilis Investment Trust. He has more than 17 years of enriching leadership experience. He's been managing investment for a family office of a reputed tech founder based in Bangalore. Responsibilities include multi-asset allocations and also managing a capital pool to invest in good quality public and private companies based in India. Welcome, Mr. Srinivas. Accompanying on panel is also Ms. Anjali Dave, who's the head group Treasury ACG World. She's currently working as the head group treasury, handles investments, debt, finance, and forex at the group level. And also previously to joining ACG, Anjali was the joint general manager to Acer Group. A very warm welcome to Anjali.
Hello.
We have Mr. Siddharth Kothari, who's the chief investment strategist from Om Kothari Group. His startup portfolio has over 50 companies in India and abroad, and he has a special interest in plant-based companies. Last but not least, we have Mr. Arunagiri, a founder director Trustline Holdings, who has more than 17 years of enriching experience in capital markets in various capacities. He has also come to believe that the key to success is value investing lies not so much in financial skills, but in emotional and temperamental skills. He's set up a trust line in the year 2004 after his illustrious career spanning over 15 years in Wipro Technologies. A very warm welcome to all of you, and over to you, Sanjay.
Hey, thanks, Sharon. Just confirm it to me if I'm audible. If you can just confirm
Yes,
to me that.
very
Yeah.
well.
Okay. Thank you so much. Siddharth, you want to switch on your video because I think you are still off video. In case if you have the bandwidth to switch on, maybe you can come on. Yes, great. Good to see you. Or good to see all of you for sure on the screen. Thank you so much. So good afternoon, everyone. I think hope all of you in the audience, in the panel, and your family members are taking a sigh of relief with receding behavior of COVID-19, or you call Delta, you call Omicron, whatever you call it as. But my only request, let's all of us continue to take some precautions, as this is not over yet from any standard, unless few months pass by without any more mutations. I can only pray for everyone, indeed, in these times, for sure. Let me start by saying that generally, going by the trend, and I'm sure this group will tell us better, going by the trend, corporate treasuries, which are run primarily as a cash management tool, or slightly conservative behavior, while family offices generally are run like a profit center who really like to maximize by looking at various kind of assets as an opportunities. But I can also tell you in the same breath, markets are whipsawed by uncertainty today. Frenzy after euphoria of 18 months. We actually enjoyed that run for a long period of time. And well, we have again come to the scenario of somebody can talk about a FOMO here. So this afternoon today, we have an amazing panel on views on equity markets and alternative investing, domestic and overseas, where we will be discussing about, so to say, erstwhile most heated, now cool down equity markets and alternative investing in India and globally, no doubt about it. I'm sure the panelists will be happy to share how to allow money to grow, how to allow money to exponentially grow, and how to allow money to continue to grow and sustainably grow. Okay, so ladies and gentlemen, on this note, let me introduce this panel, which are big four, if I can use the word. And yes, these are seasoned family office, officials managing assets in India and overseas. I'm privileged to definitely have all of them part of this panel today, which is having a full of wisdom of almost 75 years of experience across industries and functions. But this group, I can also tell you, is very diverse because they are from Bangalore, Chennai, Kolkata, and Delhi, and Chennai. Okay, so we have actually a great mix of four gentlemen here on this call. So let me welcome all of you again, and looking forward to this 60 minutes of session, enlightening, and I'm sure gathering will be benefited with your views, on vintage in the family office management and around that. So let me maybe, on this ground, let me straight away jump to maybe Srinivas. Maybe first question to you, to kick off the discussion today. You have been part of K. Dinesh Family Office, which is Infosys co-founder, and you have been looking at a long only kind of investor behavior for sure. How has been your journey and how has been your experience in managing those assets? Yep.
Hi, Sanjay. Thanks. Hope you can hear me clearly.
Yes, we can hear you for sure. Yep.
Okay, great. So first of all, thanks for inviting me to be part of this discussion with my esteemed co-panelists. It's a pleasure to be here. So on the asset allocation, see, the family office has been there for just about 6 years now, since we started this and doing it in a systematic way. The broad asset allocation journey, I will break it up into 4 parts. As I see it, one is the approach itself to asset allocation. Second is the process, if I may say so. Third is the direction, and fourth, I would say tactics, which are more immediate kind of things. So when we talk about the approach to asset allocation, we look at a broad spectrum of financial assets which need to be part of the assets of the family, we speak. And a good mental analogy to give here is a ladder. Basically, what we see is that different asset classes have different risk and return attributes, and each of them can be looked at as pegs on a ladder. So something like maybe a really lower level could be a very risk-free, low duration fixed income asset class, followed by various other things, and then maybe something like a VCP investing comes pretty much at the top or near the top. So that's how we look at the overall scheme of things, and then on that basis, what we do as a family office is that we come up on the process bit. We come up with a 5-year kind of plan, and this is a rolling plan in the sense that it gets reviewed and kind of signed off every year. So there, one of the important things I think, which is quite essential for any family office, is to kind of judge the risk appetite, because that's the starting point, and this becomes even more pertinent on days like these when we have all these market volatilities. So what we do as a part of that is present a case as to how we should look at the journey on the asset class allocation. At the same time, what we also do is present, say, bear case scenarios where, say, certain market linked asset classes could have sharp drawdowns. Based on that, we also try to arrive at what is our own risk appetite and how we want to go along. Analogy, what one needs to do is climb up the ladder, of course, in the search of returns. But at the same time, when one looks down and sees the downside, right, you shouldn't get vertigo. I mean, that's how we think about it. So,
Sure.
So once you've kind of sorted that out, then you sign off, and then that gives you peace of mind for everybody, and at the same time allows you to be decisive. The third part is on the direction. As a family office, when we started out, we were a lot more conservative in terms of the asset allocation, primarily towards fixed income. The direction is going more to the allocation towards risk asset classes. And when I say risk asset classes, it goes well beyond public market equity towards, say, VC, private, alternative investing and all that. We can speak about that at length during the course of the panel, so I won't jump in there. And then again, there are a lot of opportunities which are opened about in the alternative space, especially, which we'll discuss at a later standpoint. But nevertheless, I mean, the pegs on the ladder keep on getting added as these opportunities come. And to that extent, it makes our job more meaningful. The final point on the tactics, I mean, I think what is required is some kind of tools for you to make decisions. So for examples, for asset allocation, we follow this multi-asset yield model where we compare yields for one asset class versus the other, and then basis that we take decisions. Similarly, within equity, we have models to measure which spectrums of the market look more expensive related to each other, and then select products based on that. So that's more on the tactics part of it, which helps us on timing as well as allocation in specific buckets within asset classes. So that's broadly, I'll probably stop there since I've taken a bit of time.
Sure. No, Srini, I completely understand, because you have been one of the earlier ones and you have been systematically managing, which we understand that from the family office. So let me go to the theme of the panel discussion as well. That maybe let me jump to Siddharth. Siddharth, I mean, this union budget 2022 was a much awaited one, and it had a good focus, huge focus on infrastructure development, and more so, you belong to a house which is esteemed house. Thick into this industry for more than 50 years now. I'm sure who can be a better person than you in throwing some light on infrastructure, and where do you see infra going from here? Yeah.
I think we're thanks a lot for having me, by the way. Great to be on the panel with such high achievers. And I think you asked a very important question, because a lot of the country's success as a whole is dependent on our infrastructure, right? The first thing you visit when you visit a country is the first thing you notice are the roads, the ecosystem, how ease of life there. And of course, we all know that while we're making progress, the leaps we need to cover to create a good infrastructure ecosystem. Earlier, with Mr. Nitin Gadkari, we saw great progress with roads specifically. The record number of target per kilometer day was being achieved, and it was really phenomenal. Hats off, to him and the team that have managed to achieve that. But now with this new budget, we're seeing a push towards hydropower as well. We're seeing a push towards, irrigation projects. And I think as time passes, I hope to see that same, policies and announcing it in the budget is one thing, execution is another thing altogether. And with the thing like infrastructure, with all the red tape in the government, things can tend to get delayed. So let's hope that this time, the way they manage to push the road agenda and the highways, they will do that with other parts of other sectors in infrastructure as well. We've seen a slowdown in smart cities, and we could really use our target of 100+ smart cities in India. And but when it comes to, say, a family office perspective, when you're investing in infrastructure, one has to be careful with stocks, because you have to be very specific, because it's cliche to say that management is important, but when it comes to infrastructure, management you cannot turn up the volume enough on that. And unfortunately, we've had a lot of cases, I don't want to name any names, but cases where the corporate governance has not been great in the infrastructure and real estate vertical. So, but I think, something like RERA that it came out would really be a big beneficiary to, say, good developers in the real estate space. So there are moves from the government side which are giving a good push. And I think we have a lot to look forward to with infrastructure in India.
No, I agree with you. And I'm sure Srini looks to be dropping out because of some network issue, looks like. But anyway, let's move up. So let me remain with that theme of equities here. Maybe move to Arun. Arun, I mean, you have been part of equities for a long period of time now. If I were to ask you the same question about valuation 6 months back and where it is today, what is your view now? Let me ask you on 4th of March today, where are you looking at valuations now? And maybe you want to break up into large, mid and small cap, etc. and all that. You're on mute, sorry, in case if you're talking. Yeah.
Hi, Sanjay. Thanks a lot for this invitation. Thanks for this opportunity. I'm really privileged to be part of this. So when you look at valuation, there is a general tendency to look at valuation with a common look at valuation on an aggregate basis, right? At Nifty level or Sensex level and all that. That could be really misleading. There could be extreme divergence within that basket. So even in this current market, that after 2 years of rally, what we see is one segment of market like IT, if you take, extremely expensive on historical terms, even after the correction in the current phase. Whereas if you look at pharma, financials, and so many other sectors which are going really dead cheap. So I think painting the entire basket with the same brush may not be a very wise, sensible approach. I think the right approach would be to look at, very selective basis and look at the pockets of undervaluation. Believe me, there are many, many pockets of undervaluation in this market, even after 2 years of rally. For any savvy investors, there are many, many opportunities. That is the first part of the question, Sanjay. Coming to your second part on the small mid caps, let me give some, historical perspective. If you look at any bull market cycle, right, initially the first leg of the rally always is led by large caps, Nifty and Sensex. This is when you have a large amount of liquidity sloshing around the system, and the growth gets rewarded, growth strategy. But as the bull market matures into a mid cycle, what happens is the action shifts to small and mid caps. And you go back and see 2004 to 7 cycle or 2014 to 17 cycle, you would see a same pattern playing out. Actually, from 2016, I think the entire alpha was created only in the broader space. We see something similar happening, but for this geopolitical situation, I think you would have seen a lot more action in small and mid cap. Yeah. So once the dust settles on geopolitics, I think we see a lot more action in the broader space. So the stock specific portfolio building is the time. The time is for stock specific portfolio building to create that kind of an alpha return. That's what I would say. So in the current phase, once the dust settles on geopolitics, I think the Nifty and Sensex probably will adjust a little bit because of the correction. So initial rally would be there. But I think when you look beyond 6 months, I think more and more action would happen in the broader space with Nifty and Sensex consolidating. Something similar to what we saw between 2016 to early 2018. So this is the time to be there in multi-cap and small and mid-caps. This could be a little contrarian view, but if you look at the past cycles, I think the pattern is very clear.
No, sure. So as per you, this is a clear thumbs up for sure. I can see that for sure, no doubt about it. No, so let me remain with that, because let me move to Anjali. Anjali, my only question to you is that you have been a supplier to the pharma, healthcare. So you have been in the toughest time. You have been in the market for sure as an organization. The healthcare and pharma sector has been. Do you want to share a bit of light on healthcare sector? Where do you see a sector on a broad basis? I'm sure audience will be definitely benefited about it.
Yeah, sure. First, very good afternoon, and thank you for selecting me among this panelist. So welcome everyone. And coming to the healthcare sector, post-COVID, the healthcare sector has seen very drastic change. Pharma ancillary company like us have seen increase in the market share both internationally and domestically. India has made significant advancements in the healthcare sector. During pandemic, India was not only able to meet the internal requirement, but it rose to the occasion and was able to support other countries. So healthcare as an investment option looks very attractive. If you go by the Economic Survey 21, the healthcare domestic market is likely to go 3 times in the next coming decade. Government of India is also aims to spend around 2.5% of the GDP on healthcare sector till 2025. One of the reports even suggests the healthcare sector would reach around $370 billion in 22. So these are the very strong numbers that we are talking about. Many pharmaceutical companies have adopted and will be adopting China +1 policy, and that will lead to a lot of diversification of manufacturing facility across the country. Even the PLI schemes introduced by the government is going to incentivize these pharma companies to set up capex facility, increase the capacity, and set up manufacturing facilities around. This will help the drug companies to procure raw material at locally, and that too at a cost-efficient price. If you see government's policy of Arogya, Ayushman Bharat, or the National Health Mission, digital mission, these are all the schemes which government is planning or it is pushing so that it makes the healthcare very affordable and accessible for public at large. And this is a very good thing for the private companies to wherein they can widen their scope and their presence. Also of late, you have seen, we have all witnessed that there are the increased awareness for the insurance products has increased, and many people are now willing to invest in the insurance, in the healthcare insurance, which is increasing over a period of time. Globally, if you see there has been certain discontinuances. Domestic developed market has shown a bit of slowdown, but in the coming decade, we expect the emerging markets to make a very good presence. So looking at all these factors, yes, healthcare sector, the future for the healthcare sector looks very, very bright.
Sure. No. So can't agree more. Reason being, I think healthcare sector has been a Rahul Dravid, no doubt about it, who has been on the wicket for a long time and been very, very consistent and will remain consistent. There is no doubt about it.
It has a long innings to play.
It is a long innings to play for sure. And that's why let me move to the Bangalorean, Srini, let me move to you on this ground, that you have been based out of Tech City in India. Who can be better person to give us an idea about, because you have been first to get into, internet side, fintech side, digital side, all the startups of digital, etc. are on your backbone there in Bangalore. Have you taken exposures there? Have you been beneficiary of that? Any view on that sector?
Sure, Sanjay. You rightly said that I think digital and tech is kind of the new growth engine for the economy, if I may say so. I think one recent anecdote I came across is that tech as a percentage of GDP is just under 10% today, and by some bullish estimates, which you can take with a pinch of salt, but they talk about that becoming nearly 40% after, say, 2030, 2035. Even if not there, it's certainly moving in that direction, in the sense that it's a larger part of the GDP. So to that extent, as asset allocators or investors, we do need to be mindful that our portfolios need to adjust with the changing shape of the economy. I think, I wouldn't say Bangalore is kind of the capital. I mean, there is enough hotbed of activity happening in, say, for example, in the NCR region, Bombay, etc. Though, of course, I think Bangalore has shown the way for a long period of time. I think a few things to think about is that there are certain very fundamental underlying changes which have happened, which is enabling this phenomenon. So if I talk about, and these are by and large known, I'll just repeat it just so that you're on the same page. So one is you can say the proliferation of the smartphone app ecosystem, and coupled especially with the geo phenomenon, which has thrown bucket loads of cheap data at the consumers. That is the first phenomenon. The second is the development of inter as well as intra-city logistics in a big way the last few years, which was missing. To just kind of supplement Siddharth's point there, the road development is something which has been happening over a long period of time to help the intercity mobility a lot. And within intracity also, there are a lot of these delivery models, whether you're talking about, say, the likes of Dunzo or Zomato or even Big Basket, etc. The third point is the development of marketplaces. These can be general marketplaces or verticalized marketplaces. But what they've enabled is explore the consumer choice, the ability to select a wide array of goods and services for themselves. That's the third point. And then the soft infrastructure, I think, has really come on its own in the last 3 years. When I say soft infrastructure, I'm talking about things like Aadhaar, UPI as a payment mechanism, credit bureaus to help understand the profile of borrowers, etc. So when all this comes together, this creates a huge kind of a thrust for the digital economy, or say services and products riding on these. So we feel that, and again, apart from this, there are other structural trends happening. Like, for example, one trend is the climate change and the push towards electric as a theme. though India may not be at the forefront of it, but we see these trends as inexorable when we look really long term. So as an asset allocator, what we can do is look at some of these venture capital firms. I mean, fortunately, a lot of money is being raised domestically, which didn't used to happen about 6-7 years in the past. Now there are a bunch of funds who are doing really good work, exploring various aspects of, say, digital consumer tech, health tech, or say fintech, as you called it. So, so there are a wide variety of options, and I feel we should spend a lot of time and effort identifying the right asset managers and selecting them. So that's point number one. Also, the other way to look at it is that, I mean, historically, a lot of money has gone into public equity markets. We feel that a lot of businesses are getting disrupted. They may not be clear today, but may become clear maybe 5-10 years later. So one needs to also be wary of where the disruptions are happening and make sure you avoid those and allocate some part of your capital to the private space. So that's how we are looking at it. So we've been steadily pushing up that number within our risk bucket. Specifically on fintech, I think difficult one because there are various models. One is a lending-driven model. Another is you can say what do you call financial services or a investment product-driven model. Another could be a SaaS model. There are lots of companies emerging, and if you open the hood, there are literally hundreds. So we believe as investors, it will take for the common investor, it will take a lot of work to identify those few winners. It's better to go with the VC kind of expertise and let them kind of zero in on the kind of investors.
Sure.
Okay. I hope this provides cover.
Yeah, no, sure. No, let me extend that to Siddharth, because I remember I was having a chat with him. He said that venture-backed capital has been a biggest strength of theirs, and they have been very successful there across multiple companies. Do you want to share for everybody's benefit your experience of venture-backed investing? And I wouldn't mind if you share hits or misses both. You know, doesn't matter. Sometimes you'll be Virat Kohli. Sometimes you can be on zero also. No harm. Sure, go ahead. Yeah.
I think Srinivas, you made some very good points. And one of the big reasons why it's so important to look at venture capital as an industry today and participate there than ever before. I'd say two main reasons. One is because back in the day, companies used to list at an early stage in their life. They give you an opportunity to create wealth in the stock markets, like successful tech companies, like say in India, Infosys, for example, listed very early in its life, and people have made 100, 200, 500 times their money, and more than that even in Infosys, who've held on for the ride. Even in the States, you can see that with companies like Microsoft and Google, the tech behemoths have created massive wealth for investors. Today, though, you see big tech companies listing much later in their lives. We saw Zomato listed a 1 lakh crore market cap, similarly with Paytm, and it's already a decacorn and above. So how much upside is left after listing these days? Because there's so much private equity and VC money available, it makes sense if you want to play those big winners, you have to look at the VC world. And that's something we take very seriously at Om Kothari Group. In our family office, we started startup investing in 2016, and Venture Catalyst was a great partner to have. Venture Catalyst is India's largest incubator and accelerator for startups, and they get really some of the great deal flow. And another thing people get confused is when they think about startup investing. So the second reason why it's also really important to look at startups now as a very serious asset class is SEBI has now allowed loss-making companies to list, which is why we saw Zomato go through, and it's opened the floodgates. It's not a coincidence that we've had a record number of unicorns in the last year, because now there's an end game for VCs as a listed kind of play, and you'll see a lot more loss-making but highly growing companies from the startup world list into whether it's MobiKwik, which will happen soon, and Ola eventually, and so on and so forth. All of them will come. So it's important to participate, I think, in player winners. Like you said, there are hits and misses. You need to make a portfolio of companies. You should not think that you are great just because you get one big one. And also look at startups, not just from a tech angle. People think when we talk about VC or startup investing, people assume it's just tech companies. It is tech, it's deep tech, but D2C brand can also be a startup. A new company is essentially a startup that's backed by VC money. We've had some great successes in non-tech startups. We did Beardo, which is a men's grooming products company. That was a big winner for us. It was acquired in its third year of our investing to Marico. And even company like Innovate, which is a co-working space. And fortunately, this was pre-COVID. Oyo had acquired from us. So we've seen good success with startups, and we continue to be aggressively investing in in the VC asset class, both through funds and through directly.
Okay.
No, sure. I'm not surprised why you're groomed so well. Beardo is an example of that, I guess. So that may be the reason, I guess. Okay. So I mean, Arun, if I were to ask you, I mean, we have seen this market for last few years now, maybe 2-3 cycles for last in say maybe 17-18 years now market. Have you actually analyzed the balance sheets? You look at financials of banks, NBFCs, etc. And especially with interest rate about to be hiked, I don't know. After Powell's statement yesterday, who will sneeze and who will catch cold? I don't know right now. But which sectors do you feel good for the investors to bet on?
So
Or have you changed your mind after Powell's statement yesterday? If I were to ask you that.
No, we've become more convincing now.
Okay,
it's more compelling now.
Sure.
Sanjay, so let me take it this way. I think this question I will spend a little more time, a little longer time. So if you look at the macro, the biggest tailwind for the economy right now is not anything to do with the pent-up demand from pandemic or any temporary government stimulus in terms of capex push and all. Of course, they are all helping at the margin. But in our view, I think there are two factors which are the real great tailwinds for the economy, and it is not well appreciated by the consensus investment community. One is the cumulative base effect, or you could say the cumulative pent-up demand coming off a very, very low growth for the last 6-7 years for India. I think the last time we saw any growth above 7% was in 2014. After that, the economy has been just languishing. Your capital investment is below the trend line. Your manufacturing share is below the trend line. So it's been just languishing. The second factor is the cumulative impact of the painful reforms this administration has done for the last 6 years, be it GST, be it IBC, be it MPC, and to some extent even DeMon. So these are two factors which are really underestimated, and this is what is going to drive the economy to, in the medium to longer term, to the trend line growth of 7 to 8%. So the good news is the reforms are stabilizing, GST is stabilizing, IBC has given some fantastic outcome, and the DeMon effect plus the pandemic effect is really putting organized market at strength. So all these are going to drive the economy into a real solid trendline growth of 7 to 8%. And that kind of a backdrop, there are many, many sectors and themes the investors can look at. So given this backdrop, I think more than sectors, what we would look at is the kind of themes which are likely to play out for long time to come for India. One is formalization. This has been discussed, and a lot of it, some of it we saw play out in the last 2 years. This is thanks to the reforms like GST, as well as some accidental impact from pandemic. The weaker players are getting weaker and stronger players are getting stronger. The market share is shifting from unorganized to organized. And this is not happening only in the large cap space. It is happening across the spectrum, in mid caps, in small caps, in micro caps, and large caps. So any savvy investors, I think consolidation is a big theme one can look at across the spectrum. No sectors, spared. You can look at any sectors in which you can then, most of the gains, market share gains are being, it's getting accrued to all the listed players because listed players are organized guys.
Yeah.
Second theme one can look at is a financialization theme. It's again, it is, though everyone talks about it in the market, I think people are ready to see the benefits. So the saving shifting from physical assets to financial assets, this is going to play for a very long time to come for India, And you could look at, anything, any exchanges, depositories, new age broking firms, or, financials, private sector banks, rating agencies, and, something like that. Even asset management companies. Asset management companies are going so cheap. There's, they have a CAGR growth of 16 to 17 to 18% per annum, and they're available at a substantial discount to, intrinsic worth through free cash flow model. So there, you have a lot of opportunities in financialization. Besides this, I think one can look at China Plus One, which if one can look at manufacturing scale up because of the PLI focus from the government, or capex breakout cycle. So these are well discussed. I don't want to spend too much time. So basically, the kind of themes one can look at in summary is formalization, financialization, China plus one, and then manufacturing, big manufacturing scale up, and then finally the capex cycle breakout. So there are a lot of opportunities across these particular themes one can find. Many sectors.
No,
so it's a great time to be an investor, I would say.
After talking to you and listening to you, I can only tell you I should be all in right now. That's what I'm feeling.
Of course, there is a caveat. Of course, there is a caveat that the current conflict, geopolitical tension, we assume that to be a limited one. If it escalates into a wider conflict, of course, your thesis could change.
No, that's fine. I mean, that's understandable. But as long as you can behave like a genius and sit tight, it's fine. Doesn't matter. So that's the only thing I can think of that. Yeah. No, great. So let me move a little bit, to the other side of the coin. Alternate investing has also been growing. Like you mentioned about asset management business has been growing by 16-17% CAGR. Similarly, alternate investing has been growing too. Maybe let me throw the ball in Anjali's court and asking maybe alternate investment across the space. Maybe InvIT, we have seen one emerging space. We have seen maybe AIFs and PMSs. Have you taken that as an opportunity and it has worked for you?
Yeah, I'll briefly run through InvITs for the benefit of the audience. Infrastructure Investment Trust. So it's an interesting financial product. So earlier, what used to happen if we had to invest in the infrastructure space, there was only two ways. One, either go through equity, through share purchase, or through mutual fund. But now it is InvITs provide a third option. So InvITs, like mutual fund, provide pool money from various investment base, and like mutual fund, it is very professionally handled. The underlying asset is the infrastructure projects. So InvITs allow companies to monetize their revenue earning assets, infrastructure assets like buildings, roadways, bridges, airports, etc. And it plays a very significant role in financing government's infrastructure plans. Globally, InvITs have been a very developed market. People get into the products because it provides a good spread over their souvenir bonds. The advantages of having InvITs in the portfolio for the reasons for which we have it in our portfolio is one, it is an excellent gives excellent asset diversification, totally new asset class. Second, there is a visible revenue flow in form of dividend payout, dividend payout and interest payout. They are tradable, and more they're professionally handled. We started looking on for InvITs when the interest rates had fallen and the returns from the fixed income portfolio was not doing much. So this is precisely the reason why the interest in these products has increased among the investors. Of course, they are not without their challenges. There are few risks, like the performance of InvITs are based on its operations, linked to its operation. Like in case of slowdown or the loss of revenue, it not only impacts the NAV but also the dividend pay. One other challenge that we had faced is that if the ticket size is big, we have some liquidity issues. But this is a very temporary thing, I guess, because once the investors' awareness increases in these products and the participation increases, the depth of the market increases, this would not be much of an issue. If we stay invested in InvITs, we can easily look to earn around 7 to 8% post-tax return. So yes, we do have InvITs in the portfolio.
Sure. So, because when we're talking about alternate, I think Arun, maybe flip back to you again, because you've been an expert of AIF space. Do you see that as a better space, or looking into direct markets directly, or through mutual funds, or through any other option? Is there a good space to be?
Yeah, yes, Sanjay. Let me give some interesting facts for AIF. AIF is one of the fastest growing investment platform for ultra HNIs and HNIs compared to the conventional PMS and mutual funds. So look at the industry growth numbers; they are really stunning. Your PMS and mutual funds, in fact, has been, as I said earlier, it's been growing at 17-18% per annum. The last 5 years, AIF assets have grown at a, stunning rates of about 70% per annum, CAGR. So, and currently we are talking about the industry numbers of, 600,000 crore rupees, which is 6 trillion rupees. That's the industry size, and it is really growing so strong. There are certain factors which are really driving this growth, especially when it comes to Cat 2 and Cat 3. Cat 3 is where we specialize. The factor is one of the biggest factor which is pushing Cat 2, which is seeing biggest growth. If you look at the assets across AIF, I think Cat 2 is the biggest assets, right? And it's also growing at a much faster clip. The reason that the factor which is driving the assets in AIF Cat 2 is the debt mutual funds, because they are giving low returns, that is pushing this ultra HNIs and HNI investors to look for, sophisticated strategies which can deliver higher returns, right? That's how AIF Cat 2, AIF Cat 2 has the flexibility to invest in real estate, structured debt, venture debt, or, even even debt, venture debt, etc., and all that. So that's one of the reasons why it's growing. When it comes to Cat 3, it has a huge flexibility vis-a-vis your PMS in terms of having, structure a very close-ended, concentrated strategy in either micro cap or mid cap or small cap. So that gives you the flexibility of hard lock-in. Today, we all know that PMS doesn't have a lock-in. SEBI has removed that lock-in provision. So if that way can be really, you can build a very concentrated portfolio and with a longer lock-in so that you can deliver much higher alpha, right? So in that sense, we run an AIF fund in micro cap, a very deep value strategy, and it is done very well. It's almost like running an early stage investing in public markets in listed space. So it's a very interesting space. It offers different kind of options for investors. It's here to stay, and you are going to see more and more investors opting out for AIF compared to the conventional ones.
So Srini, let me move to you. I mean, alternate investing has been a space, no doubt about it, but you have also been, it's not about, there are asset-backed high yield opportunities or any other emerging asset class. Do you want to share that with the audience on alternate side?
Sure, Sanjay, happy to do that. We've been definitely, I think my earlier panelists, co-panelists put the context very well. One challenge is the declining yields on the traditional high grade debt products. And the second part is the emergence of these new opportunities. I think Anjali covered the first part, which is the asset-backed yield products, which are come under the InvITs. I'll just add that there are certain privately run strategies as well, which do the same thing. So the options are there to look at them. Of course, they don't have the same kind of liquidity which is there in an InvIT asset class. Also, I mean, maybe just expanding on what we look at specifically when we evaluate such products. A few things are there. One is we look at the manager's ability and track record to select the right assets. When we say right assets, the quality of the asset, if it's a road, whether it's a good, well-maintained road and so on. Second is having the right commercial counterparties. I mean, typically, if there are central government counterparties, these assets have better chances of success because these are usually some kind of annuity or semi-annuity kind of payments. Thirdly, also look at the O&M and the risk cover kind of practices, insurance covers, etc., as to how they manage the assets once they acquire it. And then, of course, the fourth part is more the financial aspect as to whether they have acquired the assets at the right unlevered IRRs, and have they kind of created enough spread for the investors with the help of good long-term financing without running much ALM mismatches. So those are the few things I just want to add on to the points that Anjali mentioned. We do feel this is an area which will grow over the next few years because there is a very big monetization plan which is there both by the central government in terms of power, road, etc., other assets, as well as many of the private developers who have got these contracts and developed these assets for the government coming to the market and liquidating their interest in these assets. So we feel this is going to be a very vibrant area for investing for the next 5-10 years. The other asset class which we have been looking at very closely is the venture debt. So there, again, this is something which has emerged more in the last 2-3 years, I would say, and this kind of accompanies the kind of rise of the startup ecosystem and the emergence of larger private companies. So what happens is that these companies, though they have very high equity valuations, they're not able to access traditional bank financing, because most of these companies do not have very strong cash flows, or say that a typical type of collaterals like inventory or fixed assets and all, based on which limits. So we believe venture debt comes in as a good filler here. Though it carries the risk that it is primarily unsecured, and these are businesses which are growing but maybe not very profitable and kind of well set in stone, we do look at a few things to draw comfort when we are doing that. So one is we look at the debt to enterprise value of the company very closely as to where they are being lent. Secondly, what kind of a cash burn runway these companies enjoy when they're taking on debt. Thirdly, we look at the structures themselves in terms of self-liquidating short-term lending, which is typically given in this, say, 2 to 3 year kind of thing. And I think the most important intangible thing is the kind of venture capitalists who are backing these companies. Finally, they will come to the rescue if the company is under. So, but of course, it carries the risk that if, say, the value of enterprise value of these companies suddenly collapses and comes even below the debt which is funded, there is a possible haircut of that. That is certainly a risk which is carried in this asset class. So that's something to be cognizant of. Second is if suddenly venture equity funding rise, that is something to be examined as to how will these companies these are the two things we think to think about. And the final point is that typically this venture debt comes with certain equity warrant covers which help boost the yields on an aggregate basis. So though looks risky, but we feel on a risk adjusted basis it's an excellent asset class.
Sure. No, so completely agree with you. But let me be euphoric again and maybe go to Siddharth and ask him that last 18 months have been a one-way euphoric secular rally, equities, IPOs, exits, etc. Do you see that sustainable going forward? And where are you? You are all in, like Arun said, or you are still holding the money with you?
So I think, you're right. The last 18 months have been quite euphoric and unexpectedly so. And it's been a great, people have made a lot of money. But unfortunately, when this happens, people forget that when periods like these happen, what follows is not the same euphoria. It's not sustainable. It cannot, although I'm not disagreeing with Arun that, it's a good time to make great bets. Right. I think people also need to be cautious that you can't paint every sector and every stock with the same brush. There's not money to be made everywhere across the board. I think you need to be stock specific. I think you need to be with the right teams, with the right, there are two ways to play it. You invest independently, do your research. I always recommend being as bottoms up as you are. In India, secular growth, basically, the economy does well, everything will do well. But if you've seen say, let's take airlines as a sector. If you've bet on Indigo over the last several years, you've done well. But if you bet on SpiceJet or if you bet on, another weak player, you've lost money. So in the same sectors where there's been growth, you've seen you can make money with some managements and you'll destroy wealth with other managements. Forget same industries. Even in the same family, you've seen that with Anil Ambani companies. There have been severe wealth destruction. With Mukesh Ambani's companies, you've done Reliance Industries has done fantastically for shareholders. So I would recommend to kind of be cautiously optimistic, but I definitely agree with Arun that India is always a good time to bet on and to be all in on if you can handle the volatility in stocks. So it's a great place to create wealth if you are long-term oriented.
Let me be a devil's advocate. RIL did not make money for 10 years. SBI did not make money for 10 years. ITC has yet not made money for so long. I don't know how to make money. I am yet to learn from all of you. I'll be happy to learn and understand from all of you. Yes. Let's see how it goes from here. I will not comment to that, maybe. Yeah, but yes, finally it has multiplied. I agree with you. So let me go to Anjali, maybe, because geopolitical tension continues, and Arun also correctly mentioned that we don't know how many days it's going to continue and how it can spread further up. Nobody knows about it because you have been into exporting company as well. What's your view on USD INR? And let me also put another question in front of you right now. If you were to invest in products looking at the USD INR depreciation also, limits are bust on asset management companies, I can tell you for sure. So if you want to do it to investment, what do you do? Yeah.
So the first question, the currency, being an exporter, the currency view, today we see dollar rupee trading in a 76 handle. It's difficult. The indirect impact of the current crisis, Russia-Ukraine crisis, is fallen on India through increasing oil prices. The oil have hit 115. We all know we are net importer of oil. High oil prices are so detrimental to the economy. My view is that as long as it stays below 125, we'll be able to sail through some difficulty. But if the range is breached and it stays sustainably on a higher side between 125 to 140, we'll have tough situation in hand. That's because any $10 increase in the oil prices leads to 20 basis point increase in inflation and 30 basis point increase in the to the GDP percentage. So that is going to be a deciding factor from here on. RBI previously has managed the currency quite well. It keeps saying that it will not protect a level, but it will contain the volatility. It has been able to do that. So we have a very strong reserve currently, unlike 2013 when we were facing with a twin deficit. This RBI will try, if there is a run on the currency, RBI will come into play. But couple of other factors which are very important is that Jan to March month is heavy. Always historically we have seen it is very heavy on the flows. So that kind of supports the currency. Now also it is to some extent supporting it. But once we move into the next quarter, that is April, May, June, the flows will dry out. So that brings an added pressure to the currency. One most important factor is that this is the first time we're witnessing the inflation in India is lower than the inflation in the US. So when in this scenario, in this dynamics, the currency depreciation, our rupee depreciation is under check. But the Fed has already made its point clear that it will increase the rates. If it keeps on increasing rates and controls inflation, and our inflation remains elevated for a longer time, then even that kind of defense is not there for us. So currently rupee looks depreciation bias, but we do place our faith in RBI and see how things go. Now, coming to your second question of overseas investment, the limits are getting bust. Of late, overseas investment has gained a lot of popularity because suddenly investors realize it's important to diversify. The geographical diversification also should be seen in the portfolio. And we saw many mutual funds also coming with multiple schemes supporting this theory. Then we have SEBI coming up and telling mutual fund not to invest in the overseas stocks with the risk of limits getting breached. At our end, what we do, we are continuing to invest in the overseas market, but we are doing it through FOF route. That is, the underlying security is ETF. It has a separate cap. It has a cap of $1 billion, and it will come up for exhaustion, and we will again that would also be kind of capped by the regulator because we haven't seen any communication or commentary coming from the regulator. On a macro perspective, I want to throw some light. When $7 billion limit was set in 2008 April, when the mutual fund for AUM was around 5 lakh plus crores and the forex reserve was around 300 billion. The same number today is 17 lakh plus crores and 650 billion. So what I'm trying to say is that the broader perspective, there is very conducive for regulators like RBI, SEBI to come forward and look into these limits. Of course, there has been a brisk of flows in the last couple of years, and that kind of triggered, pulling up of mutual funds to stop investing. But I think when the geopolitical tensions cool off, when the market stabilizes, these limits can be revisited by the regulator, and they could allow us investors to again go back to the overseas market to diversify our portfolio. Currently, there is no other option to access that market. So we would, I would suggest the investor to stay put. But this is a temporary phenomena for sure, and this will be looked into very, very soon once when everything is settles out.
Okay. So we are 8 minutes away from closing but let me still have 2-3 questions to ask. Maybe Arun, maybe if you want to give a short answer, maybe to give a view, because there is a long-term bet or a long-term debate on the word called value and growth investing. Okay. What is your take? You are still a value side now or a growth side?
Of course, we are on deep value side. Okay, this is a very interesting question. So I'll try to keep it very short, given the time limitation. So let's first look at how to define value and growth, because there are a lot of myths around it, right? In our view, value is not about, picking some cigar butt on the road and with, basically picking stocks, cheap stocks in terms of price to book with no growth potential. That's not value in our view. In our view, I think value is all about picking growth at a discount, and growth strategy is all about buying growth at any price, right? If you define value like this, there's a lot of value you can create. Our own performance over the last 17 years is a proof for that. It's a testimony. So in terms of value and growth, let me also tell you how they perform in cycles, right? So initial part of the bull market, and when the economic recovery is a little fragile and the liquidity is sloshing around the system, growth strategy rewards like anything. But once the bull market matures into mid-cycle, when liquidity starts getting tightened, that the market starts slowly shifting to value, like what we saw in the earlier cycles. And you're already seeing that phenomena playing out in this correction. Expensive stocks are getting beaten much worse than the value stocks. Value stocks are much more resilient in this correction than expensive stocks. I don't need to give examples because all of us know about it.
Yeah.
So that way, I think, value can create a lot of value if you define value as a strategy of picking stocks, growth, basically a strategy of growth strategy, but buying at a discount, right? And our own performance, if you look at, we run a deep value strategy for the last 17 years. It is done north of 20% over 17 years. So value strategy doesn't just create value, it creates a lot of alpha for investors if you stay around that strategy.
Okay. Well, good to hear that, because we have seen in value funds in the mutual fund space have also done very well in last 2-3 years time, and people have understood that. Siddharth, we talked about domestic markets, we talked about alternate, etc. How is overseas investing? Maybe FANG have been in vogue. Have you taken exposure to overseas markets, through various ways, and how it has worked for you? And what's your advice for the investors?
I think it's always a good idea to avoid home country bias. So, we as people in India will be investing largely in Indian companies, people in Brazil will be in Brazil. And while there are opportunities everywhere, you should not miss on some great themes just because they're geographically in a different area than you are. Because in today's world, it's very easy to invest outside your home country. So, for example, anyone you mentioned correctly, the big tech companies, the FANG or the FANGM stocks, themes like that don't exist in India for us to play out. Large social media giant that Facebook has become, or even the software empire Microsoft has created, people who've been open to the home, outside, have fought their home country bias, have been able to monetize this. So we have about approximately 15 to 20% of our listed portfolio in foreign companies. We use brokers such as Interactive Brokers, and now almost every broker's bringing on this aspect. So we always encourage people to evaluate this. Even if you're a mutual fund investor, PPFAS has a scheme where about 15 to 20% of their investments are abroad, and they're overweight stocks like Amazon, which have been great wealth creators. So I think it's always a good idea to look at foreign markets for value or growth. You can play out all types of themes there. This is just the known kind of FANGM. Just the big tech was an obvious theme that people know is available abroad and not in India. But we made money in a funeral services company, and in India it's an unorganized market. People will not make money in that ever. It will not be a organized business. But abroad, carriage services is a stock that's 3x for us, because over there funerals and caskets are a cost, and people, it's like almost like a party. They suit up, they have wine, and they talk about eulogies, and it's an events business there. So I think people should be open-minded and invest across geographies and not just in India. Sometimes you find Coke in in a developing country much cheaper than Coke in the US, or Coke in a Coke bottler in India. So these themes can be great arbitrage opportunities as well.
Sure. maybe a quick one, Srini, if you want to answer that. Maybe yellow metal has been a hedge or an investment tool for you, or you have completely avoided that in your portfolio?
Yeah, good question, Sanjay. And I think it depends on your asset allocation. So if your fixed income is a core part of your asset allocation, I think it acts as effective hedge as a gold, because in India, typically you tend to get a 6 to 8% carry on fixed income. So to that extent, that gives you enough buffer when markets go down and support your overall returns. So we haven't been kind of looking at gold for hedging because it doesn't have any carry per se. Other point which is a misgiving more of late is the emergence of crypto, where it seems like the more early adopters seem to see it in a similar way as a gold, in a sense that it also doesn't have an intrinsic carry component and is seen as a replacement for fiat currency, just as gold is. So we honestly haven't dabbled much with it. And in a country like India with reasonably high nominal interest rates, we don't feel a company.
So I have a quick one common question, to all the panelists today. Okay, we are at 2:58. Let me give you 30 seconds to each one of you and answer that maybe in a quick one. All are convinced Fed's rates tapering, inevitable interest rate hikes in near future across the globe. And maybe I'm sure you will see in England, you'll see in, everywhere in Europe, etc. What's your view and advice to the family offices? Should invest and hold, or wait and wait? Yeah, maybe let me go one by one. Anjali, maybe you can start quick, 25 seconds.
Yes, in 2022, there will be volatility for sure as the world adjusts itself to the reduced monetary, physical, and liquidity. My advice to the family offices is that in case they are having equity leaning portfolio, to hide themselves behind, and volatility is not they want to kind of control, then hide behind good quality stock in the large cap. But if there is some scope for being aggressive, then we definitely mid cap is a space, a good balance between them. But more importantly, rather than timing the market, spending the maximum time in the market is what is required. Long term.
Your 20 seconds are over. Arun, I'll move it to you.
I'll make it very quick. It's time to stay put and add as much as possible, because taper is already discounted. It's behind us. $15-16 billion have gone out of Indian markets from FI since October. In any taper cycle, not anything more than that goes out. So taper and interest rate hike is behind. Its economic momentum will dictate the trend once the dust settles on geopolitics. So it is time to add and build a fantastic portfolio. It's a great time.
Srini, 20 seconds.
Yeah, just to add to Arun's point, I largely agree with him. Choose good active fund managers. This is going to be active fund manager market. Secondly, look at, given the skew in valuations across sectors, look at sectoral funds or ETFs and see if some of them make sense to you. And I'll end at that.
Okay, Siddharth?
Is inflation a big threat? Yes, it is, stock prices. But can you predict it? Can you know when and how it will come and get you? No, you can't. So like Arun said, find good, and Srini said, find good fund managers, find good managements, good stocks to bet on in the long term, will make money.
Sure. No. So thank you so much, everyone, because I can only tell you that listeners, I can tell you that temperature on this virtual room is quite hot. I can tell you that even at $120 of crude price, they are heated up. I can tell you that for sure. They are, if not all in, they will be all in very, very soon. If you are feared of missing out, please don't. This crisis is giving an opportunity. Markets are down. There's an opportunity. You should look at where the opportunity lies, where the value lies. And let me thank panelists for all your prudent views and being very specific on the various points. I'm sure audience must have been enlightened with your views. So thank you so much for sparing time on this Friday afternoon. Have a great weekend, and thank you so much.
Thank you.
Thank you, everyone.
Thank you for having us. Thank you so much.
Thank you, Sanjay. Thank you, everyone.
Thank you, Sanjay. Thank you.
Thank you, Sanjay, again for the fantastic session. Thank you, panelists, for your participation. It's been really insightful having your diversified insights from the session. Thank you so much.
Thanks, Sharon.
Okay, thank you. So, okay, for this, we now move on to our next session that we have on a very interesting topic, that's market outlooks and trends, discussion on economic scenario. Please join me in welcoming a moderator, Mr. Pransanan Kumar, our Senior Director, Treasury, Northern ARC Capital, experienced head of Treasury with a demonstrated history of working in the financial service industry. He is skilled in fundraise, liquidity, and other financial risk management and banking. a strong finance professional with a CAIIB focused in banking from Indian Institute of Banking and Finance. A very warm welcome to you, Mr. Prasannan Kumar. Accompanying him on the panel are Mr. Suchindra VG, who's the ED and CFO, Veritas Finance, responsible for functions of finance and treasury. He was earlier the CEO of IFMR Investment Advisor Services Private Limited, the fund management and investment advisory arm of IFMR Trust, where he successfully launched the fund platform in the alternative investment fund space. He also has experience of more than 20 years in capital markets and inclusive finance industry. A warm welcome to Suchindran. Joining him on the panel is Mr. Rahul Sarvagi, Fund Manager, Dabur India Limited. Over the 13 years of experience in treasury and risk covering areas of cash flow planning, fundraising, cash and investment management, foreign currency risk mitigation, and related hedge accounting with companies like Reliance Industries Limited, India's largest oil refinery company, ICICI Bank, India's largest private sector bank, and Goldman Sachs as product controller, etc. A warm welcome to you, Rahul. We have Mr. Ajit Bhaskaran, who's the Director and CIO, Fixed Income Karvi Capital Limited, with more than 20 years of experience in trading corporate bonds, government securities, funds of bank and insurance company. He led a team of dealers and fund managers, ALM of bank, also specializes in corporate bonds trading and sales, GC trading, debt, capital market. We also, last but not the least, we have Mr. Deep Banerjee, who's the Chief Investment Officer from Shriram Life Insurance, an MBA, FCMA, and CGMA, and Associate Member of Insurance Institute of India with 2 decades plus professional experience in diversified industries across various geographies. Proven track record in setting up finance and treasury operations of the company at the startup stage, from defining the accounting process, identifying and setting up the right IT infrastructure, talent onboarding, defining team KPI, etc. A very warm welcome to you all the panelists, and over to you, Mr. Prasannan Kumar.
Thanks, Sharon, and thanks for that lovely quick introduction about panels. And I welcome the members. And we have a good mix and balance of buy side and sell side investors. After hot discussion on equity, we have now a panel which is going to discuss about the fixed income and economic scenario. And we have been given the last session, probably not the best, hopefully. And the theme is the current economic scenario, and the context is slightly longer, I would say. It's not just current, we medium term, would say. We have had 2022, we started the year with a new variant, and then it didn't live up to its expectation, but we quickly resumed, and now we had a budget followed by a policy which surprised everybody, and then now we have a geopolitical issue. So in this context, I have a balance of issue side and the buy side, and like to be a wonderful chat with the budget, the impact on the rural economy, the expectation on RBI policy going forward, the government borrowing program, current economic outlook from the investor side, the interest rates, the impact of oil, crude, other commodities, even our edible oil, which largely depends on Ukraine, is going to cost us more. Hopefully, let's embrace for that. And I'll open the floor by inviting Mr. Ajit Banerjee to give us an evolving business environment, and then we can move on. Over to you, sir.
Thank you. Good afternoon, all fellow panelists, and thanks to the organizers for inviting me to be part of this, share the panel with the elite members. So I think there is only one news now. I think all of us across the globe are following what's happening, between Ukraine and Russia. Something which was certainly the crisis was precipitating for quite some time, but possibly nobody, had any clue that it will really get into a full-form aggression. Now, February month by itself has we had a few important events to consider. One was certainly the union budget, and followed by the monetary policy. So in the union budget, certainly with India, which was slowing down on the economic growth perspective for
quite few, consecutive years, certainly the impetus was how to revive the growth. I think that is something which the government had in mind very clearly. And we have seen that, across, be it the Modi government version 1 and version 2, the emphasis has always been to bring in a lot of structural changes, as opposed, be it, introducing demonetization, or for that matter, GST introduction. Most of the things on the face of it might look disruptive in the nature, which might, bring some economic, I would say, downturn or degrowth to start with. And that has happened, worldwide, wherever this sort of GST introduction has happened, or a mammoth, exercise like demonetization, which has been introduced. So India was no exception to that. So certainly, what if 2 sentences, if I have to describe, I think Union Budget 22-23 is, we can say, is a growth-oriented and realistic budget with the focus on capex-led initiatives as a means to push economic growth. And so what we have seen is that this budget maintained the consistency in terms of stressing on the government's policy towards bringing structural changes. It has brought in a lot of transparency this time in terms of earlier there was a lot of off-balance sheet items which used to be there in the budgets, which this time has been has been reduced, I would say, and a lot of things has been brought on the face of the balance sheet, as well as it is realistic in nature. By realistic, I mean to say that the estimations which has been done for the revenue as well as the expenditure. And typically, as an accountant, you are always required to be, conservative in your revenue estimation, and as well as prudent in your, I think, expense, which is what the government has done. So that's the reason we can say it's a realistic thing. At the same time, it has emphasized upon the fact that in order to hit or having a maximum impact at the pyramid, one need to emphasize on the growth and capital expenditure. That was essentially the primary way, the objective of the government, what we can say about this budget. And as a means to achieve that, I think the government pushed the throttle full blast on the capital expenditure front, trying to reinvigorate the infrastructural development and economic growth. What we have seen is that all across last 2 years throughout the pandemic period, there was a lot of emphasis being put on the supply side, but not much happened, or we could see some response coming from the demand side, which is of course required to balance it ultimately to get into a growth platform. So for that to happen, certainly government had to take the lead and bring basically demonstrate the required confidence that infrastructural growth, they will lead from the front. And once that actually translates to in reality, then I'm sure we can see that the private sectors also would definitely feel that now is the time that they need to also step in order to take it further. And since, as we are aware, that any capital expenditure for that matter has a multiplier effect of 2.5 times approximately, that's what it is assumed to be, then certainly this would have been possibly the best way to take at this point of time. But of course, having said that, this looks very good on the paper, but lot much has to depend on how this is really implemented. And that is something which is more important to happen.
Sorry to interrupt. That's where I'm like to add, with the much of oil price increase has not been passed on. I mean, would the government have ability to pass the full, from last oil price increase, it was around $75 per barrel. Now it's almost $40 up from there. Would you think government be able to pass on, or will it adjust? And I was reading elsewhere that government might have to take the impact by reducing the tax. So will it affect the revenue receipts?
So actually, it's a catch-22 situation for the government at the moment. If you see, so on the one hand, actually, if it tries to absorb the taxes, absorb the cost by keeping the reducing the tax for that matter, then certainly ultimately the size of the kitty is same, it doesn't change. So somewhere, if it is absorbing, then definitely the revenue receipts which would have otherwise come from the from the tax collection would have been used, for further deployment in terms of either capex or revenue expenditure. Then actually, if suppose just for simplicity purpose, if 100 is the for the tax purpose tax amount, what we say, if that is something which basically government would have collected, this 100 would have entirely got spent in various ways in the economy to as a capex or a revenue expenditure. On the contrary, if it's actually passed back to the domestic consumer, cost push inflation in any case is going to happen. Then there will be stress on the margin also. So ultimately, it will have an impact on the demand as well. So of course, it's very easy for us to say that this should be the government should be doing this and all that. But I think a lot of back end work is happening, which will ultimately they will see that which is best for as a balancing act, at this point of time. That's the, I think, best answer I can give you to this question at this point in time.
Yeah, no, I would agree. See, at 100 and last time the dollar, the oil was above $100, rupee plunged about 20-25% within a short span of time. Now rupee holding up shows A, we have the reserves, and B, there is a ability the economy to absorb high oil price and to produce the goods. So yeah, I agree. Though that might be
so there are certain, I think, basically, see, so long that it has been able to still, hold on to the price itself demonstrates that possibly there is a bit of a cushion which is still there, leaving aside the fact that elections are going on. But because we have to keep it in mind that even though when the budget was placed, actually government did not present a populist budget, which everybody expected that this time budget will be more populist in nature, keeping in mind that 5 state elections were on the way. But so keeping that in mind, I think there would be some amount of relaxation which it has in terms of its revenue, because tax revenues has been quite buoyant for that matter. So some amount of cushion would certainly be there, but it has to strike a fine balance, I would say, that in terms of that, what extent it can absorb and what extent it has to pass on to the consumer. Because at the end of the day, as I said, the entire kitty remains the same. Ultimately, it has to take a fine balancing act.
Yeah. As you touched upon this, the kitty remains the same. The redistribution, India was good at may not be at generation, but good at distribution. We have this farmer, Samman scheme where Prime Minister scheme where it gets passed on to the farmers, and which they say is help to reduce the rural distress. And we have Mr. Susinder, we would request him to touch upon as one of our topics on how is the rural or the unorganized sector, which by far is one of the biggest or worst affected sectors in the entire pandemic. The earlier panel also say the formal sector has benefited, but biggest part of our workforce in the country still remains the unorganized and rural sector. Would you have your thoughts, Sachinder, please? Thank
you, Prasanna. At the outset, I want to thank Franklin Templeton and the organizers Transform for inviting me as part of this panel. Just to add to what Ajit said, maybe I'll give a small background and then move into the question on the rural part. Government has given a lot of thrust on the infrastructure side, right? The kind of highways that has been built in. Now the smaller cities and towns, the airports are now getting redeveloped and started to be put to use. And now even the railways have reached the Northeast. So and what we don't see in sort of the national media is the waterways. I think there's a lot of work on the waterways, which is happening silently. So the kind of thrust that is put on the infrastructure. In fact, the smart city program, a lot of bus stations have been redeveloped across the country. Absolutely. So one side we are sort of leveraging the technology. The other side, we are trying to go deeper into this, the rural electrification and the connectivity in terms of the various modes of transport. I think this is now making India much more closer than what it used to be. Exactly. Internet connectivity has improved. Bharat broadband connection program. Absolutely. Yeah. Go ahead. Yeah, absolutely. I think so. The penetration is much higher, right? So the mobile phones, which used to be sort of an urban focus, is now there everywhere. And today you have everything in your mobile. You can do banking, you can do investments, you can talk. I mean, the whole lot is available.
Our vaccine certificates are on mobile. So
absolutely. I think all you need is your mobile. Where nothing else beyond that. To a great extent.
Yes, exactly. You're right. Yeah.
So I think now India slowly moving to the 5G part, and so the divide that used to be between the urban and the rural is coming down slowly, right? And the first wave of pandemic, the impact was significant on urban. There was a reverse migration back to rural.
Yeah.
And in the second, impact on rural was quite brutal. I think that was something that not many honestly expected, and that is still sort of in a recovery mode. But having said that, one thing that has really helped us out all along has been the agriculture production. Even this year, the monsoon forecast is that we will have a normal monsoon, right? I think the agriculture production to a great extent stabilizes our inflation. While we all worry about the crude oil on one side, the coal prices on the other in terms of the electricity generation and all that, we still are dependent. Around 50% of India's electricity comes from coal-based plants, right? So that's some amount of input cost-driven inflation, I think, and the oil, the palm oil impact of this, what is going on in Eastern Europe is the other worry. So definitely the input costs are going on, and the cost may or may not be passed on to the customers. So some of this will be borne by the intermediaries. So to that extent, the impact on rural is very much there, but thankfully, harvest is really helping. The MSMEs have also been brutally hit, I think, but slowly the business is reviving. Their consumption is happening. The discretionary spending, which was to an extent reduced, is now slowly coming back. People who had taken loans and all that. So that's just sort of in a way continues. I think Reserve Bank of India and the government have been prudent. I think the restructure scheme, the moratorium in the first wave, the moratorium in the first wave and the restructuring in the second wave really helped the banks and the financial services firms like
in fact, they've extended the guarantee scheme in this budget as well.
Exactly. The credit guarantee scheme is a big positive development. So there has been a lot of proactive steps taken by both the government and the Reserve Bank of India in sort of minimizing the stress, but the stress remains. It takes a little more time. And India is a domestic focused economy rather than, thanks to its huge population. So definitely it requires a little more time, and then we should be back on track is the personal view from my side on the rural front.
Yeah, thanks, Sachin. I mean, that was good, because the Bharat focus of any forum is really required, because the urban is always, and with this work from home and all that, it gets blurred, but still the demand from Bharat is completely different from India. And you think that the inflation will benefit the rural, because the agri-produce or the replacement, let's say, as you said, if sunflower goes costly, will people start using mustard or groundnut oil? I mean, in that sense, will it not help the rural? If the inflation, India, the early stage of inflation is always beneficial to the rural, or the commodity side.
Absolutely right. I mean, if the import substitution happens to domestic production, that makes a significant difference for the rural community per se. For example, the palm oil is significantly imported, right? If you can substitute palm oil, I mean, right from biscuits we eat, whatever, everything is palm oil dependent. I think if we can replace that with alternate edible oils, I think then it makes a big difference for the community which is producing it domestically.
Yeah, or alternatively, if you start cultivating those palm oil plants or in India, that will also help in reducing the dependence. Oil is one of the top 3 items that we import. So yeah, that's
absolutely. Absolutely, definitely.
Yeah, thanks. And I mean, having touched upon inflation, will not be fair to see where the investment managers are looking, because we have we have 2 investment managers on our panel today. I mean, I'm going to Ajit first. So, what is your take on this inflation and this whatever we are seeing at the geopolitical and how will it impact the crude oil price? Because we had a good 2 years. I mean, I'm being from the issuing side, so we had a wonderful time last 2 years. So yeah, over to you, Jay.
Yeah, good morning, good afternoon, everybody, and thank you for taking me as the panelist over here. Just to give you a brief profile of what's happening on the debt markets here. In the last two panels, if you heard them, they were mostly saying, outlook as such, there is nothing much. Everything has been talked about. Now, after yesterday's Mr. Powell's statement in the Fed, there is nothing much left over. The mother of all rate hikes are going to come, and most probably you may see rate hikes in 2 or 3 tranches, which will take the US yields to close to about 125, 150. And there is nothing much that we as an Indian markets can do because we will be most probably following them. We have in the last monetary policy meeting, the RBI governor did take a different stance on it and said that our focus would be more on growth and inflation. But now, after what happens in the East European country, we think the inflation is going to go up from there also, because the oil is already at 112, 118, and that should kick the inflation going further.
Will the lone dissenter be approved, right? I mean, there was a minutes out and there is one of the members who dissented. So will he be approved, right?
Yeah. So now I think by the next monetary policy, I think we will have a unanimous vote, which most probably we'll have a unanimous vote which says that we have a rate hike going forward from here. And if you broadly look at the markets from here, then the point of inflation, inflation, the number printed was looking anywhere lower, but the fluctuation was mostly coming through veggie prices. And if you exclude the veg prices from the inflation part, inflation was anyway, if you exclude the veg prices, the other part of the other bucket of the inflation is close to about 94%. And this part of the inflation was anywhere close to 640, 645. And it went up to almost 670 also. But, and if you look a bit more back, maybe we stretch it wide for about a year, you still see that inflation is close to about 640, which is actually on the top of the, RBI's gliding path. So going forward, I don't see much happening on the inflation front, because we have core which is fairly sticky and is not budging from there. And if you have any more disruption in oil prices, as other panelists have said, and crude prices both ways, we have a different situation here. We've got inflation going over the roof as we go forward into the next few months. So what we see over here is most probably our rate hikes are just around the corner. Maybe June, July is where we will take the first call we will not only call, we will see the first signs of rate hikes coming in this financial year.
Thanks, Ajit. I mean, we've got a view. I mean, you managing a portfolio for your investors. So how would you, having said these and having heard, how would you position your portfolio when the interest rates are going up or you have a certain times?
Correct.
So how would you balance that?
Actually, being only a debt portfolio, it is very difficult in these type of scenarios. But having said that, if you would have seen in the last few years, in the last 2 years of COVID, most of the companies who are especially in the MSME, SME segments have actually deleveraged. So, and as you go forward, as you look at that space, AA plus or A minus type of space, you still have very good picks over there at the higher interest rate scenario. And second way we would do that, we would run through this rate hike cycle is by laddering our portfolio, where we will be laddering it by having 1, 2, 3, 4 years maturity, and as and when it matures, we will, it will be a roll down, and then as and when it matures, we will invest again. So, and the third part is maybe target maturity funds, which will be broadly used to tide over this period.
Well, I mean, if you don't have an M2M pressure, I think your targeted maturity would be one of the best in current.
Correct. Scenario. As we don't have much of an M2M pressure, and especially when you have a high yielding debt, you still have some cushions over there. So that really helps.
Got it. Yeah. Then the same question to my other last, and I thank Rahul for patiently waiting and hearing all of us. So the same question to you, Rahul. I mean, you've been one of the fund managers on Dabur. I mean, how are you seeing? I mean, first of all on the inflation, and then how would you want to see the portfolio? Also, probably if you can touch upon broader numbers as well. Yeah.
Yeah. Sure. Hi, everyone. So I agree with Mr. Ajit in terms of rate hike by RBI, in terms of change of stance by next policy meeting, and very soon we'll see our first rate hike by August policy. The only comfort which RBI was deriving was on account of the lower inflation, and that did not factor in the geopolitical crisis that currently we are in. So the projection for the next year inflation by RBI is very aggressive, I would say. So 4.5 inflation print, the average inflation which RBI is projecting, is pretty much on the downside, and we see at least 30 to 40 basis point upside risk there. And upside risk is on account of multiple factors. One is predominantly the crude, which has gone up from as high as $84 per barrel to $110 per barrel, and the impact will be visible in the next 2-3 months. The second is on account of opening up of the economy. Since we all know that Omicron has faded away, and once next year when we all resume, now most of the IT companies, including TCS, they have said that they are now bringing back their employees and their funds. So earlier they said that okay, 75% of the employees can work from home and 25% can come to office. Now almost everyone is bringing back their employees to office. So what this brings in? This brings in the increase the renters, increase employee in the COVID period, they shifted to their hometown. So whosoever was living in the metropolitan city, they shifted to their hometown, and that's how the rural consumption kind of got some kind of support. Now there will be pressure on the housing side. There will be pressure on the fuel and power side because the food is rising, and it doesn't look like that we'll have a quick solution in the next 2-3 months. Obviously, there is one support in the form of Iranian crude, which may hit the market once there is a relaxation in the restriction, but obviously that will take at least 2 months' time. So inflation is the one area which can make RBI a bit more uncomfortable, and we might see very soon change of stance, and probably 50 basis point is what we are expecting, is our view, that our terminal rate will be around 4.50. On the Fed side, we don't expect Fed to continue with the 5 rate hike, because if you look at the swap curve, the SOFR swap curve, they have already started discounting it. So 50 basis point, 25 to 50 basis point as part of March policy is everybody have a common consensus. After that, we feel that there will be a little bit pause on the Fed side.
Yeah.
On the portfolio side, I will say target maturity fund is the area where investor can lock in and potentially can avoid mark to market rather than a dynamically managed duration portfolio. Taking a high duration is also not advisable. 3 to 4 years point in the curve looks pretty steep right now. If you look at the terminal rates, the forward rates, that looks still there is some juice which is there in the 3 to 4 year bucket. So I think if one has to shift, this is the point of the curve where one can be in. Obviously, there are risks which nobody can predict. One is the crude and another is the inflation. If RBI gets it right with regard to inflation, we might see a delayed rate hike, but that looks highly unlikely.
I mean, now that we had one good discussion on RBI and on the policy and macro, I'm going back to Ajit. I mean, what would be your views on? I mean, you also want insurance companies can be long-term players in the market. We just heard Rahul to say that there is a good spread available between 3 to 5, which means the medium to long-term you have spread. So, do you expect the curve to steepen further, or what will be your take on RBI policy? Will it flatten?
At this point of time, actually the yield curve is still very steep, and so See, generally for long term, yield curve generally don't, go for such a, big increase. We generally will see as a, result of RBI's, in any action that mostly impacts the short term yield, rates is what we have seen. And that's what, history says. Now, the point is, as we are a life insurance company, so, for us, it is very important that we have to, manage the asset durations in sync with the liability expectations. So, as opposed to a bank where it is asset to liability management, here actually first the liability, occurs, and then, the asset flows comes thereafter. So naturally we have to be mindful of more the liability duration and cannot take or time the, market that much or try to time that because or keep, sit on idle cash, in the expectation of rate to go up. That can be more suicidal. So for us, what we are trying to do is that, we are actually, our first priority is to, keep the ALM, gap as minimal as possible. Number two is that we expect yields to rise, but certainly the yields will rise more at the shorter end of the curve. And because again, we have a long-tailed liability and we have a steady cash flows which come in. Hence, at each point of the, yield curve, generally, with the renewal premiums as well as other cash flows which we generally are investing at the various layered levels which comes. That is the way we try to manage, and certainly for the guaranteed portfolios and all, the best way would be to take some hedging positions through the forwarded agreements and all which is available. Until such time the yield curve is actually still steep and the spot rates are lower, it will still make a sense basically to enter into forwarded agreements where you still get a kicker actually at this point of time.
I understand when you said your liability management. You would have had a tough last couple of years through the pandemic, and hope good times are back at your end. So Chinnan, if I can ask you, would these interest rates hike have an impact on the areas that you're operating, particularly MSME or rural, or particularly your borrowings, which, if we were to, let's say the family office members who are watching, think that this will have a significant impact on your borrowings? How long do you think your borrowing tenor are there? So generally, I mean, we being NBFC, we do not borrow for long because unlike a bank, we do not fund for longer tenor projects unless we are a housing project. So how do you see this rate hike expectations going to impact your conversation?
Thank you, Prasanna. So typically the funding to the NBFCs are not more than 5 years.
Yeah.
When it comes from banks or other large NBFCs or even from the offshore investors. But what we have seen is actually the liquidity driven interest rate movement than a structural interest rate movement. So when RBI, we all expect RBI to increase the policy rates. But really, will it really make a big difference in the short term of the curve? More or less the markets are priced in. Maybe at best 50 basis points to 1% could be the impact on the shorter side. And there are also many other considerations for RBI, right? I mean, some are political in nature, some are macro events in nature. So it's a very fine balancing act, as Ajit Banerjee said earlier. I mean, so we expect that RBI will be a little bit more cautious. They may not really do much more than the targeting inflation. I think they have also been quite focused on that all along. So if the crude, once the situation stabilizes, crude comes back to normal, right? And India has also built a significant strategic reserve, right? When the crude was low, I think the Indian government did a very smart work of building a strategic reserve. I think this is going to be useful in times like this. I think they can always use that to sort of ease it out till the global prices come normal. So we will have to wait and see how government and RBI handles the crude part. But coming back to the inflation, I think RBI will not do a steep hike. I mean, they may do a graduated hikes depending on how the economy is performing, depending on how the inflation is moving. So I would not see the way that India would not be the same as a Fed. I mean, the Fed has different challenges, India has different challenges. I think this will be more custom-made for India, is my view on the rate hikes front.
Yeah, in a way, you're right, because we saw this in last RBI policy. First time, one of the major central banks took a slightly different dovish view in comparison with other major banks when they were going hawkish and giving rate expectation hike. So we are seeing a different RBI this time. And historically, if I can go back to Dr. Subbarao days, RBI always waited for the or Dr. Rajan's days, RBI waited for the Fed to play out, and then they took a stand. At that time, we were even running a very tight BOP and Forex reserve. Now, with the given comfort, I think RBI can wait in hiking the rates. I mean, having said, because we may be on the borrowing side, so we may expect the rates to remain there where they are. I mean, let us hear from Ajit and Rahul on what is their expectation. If other day we saw the Russian central bank raising the rates by 20%. I mean, how would you play? I mean, I don't envisage or I don't wish to have such a scenario. But if there are sudden hike, let's assume RBI, Fed Bullard was talking in under 125 in a couple of meetings. So how would you play if the rates go up in such a short span of time? Will you have a hold cash plus mid to long term, or how would you? Because we see you are holding a targeted maturity. So how would you play that?
So basically, see, in India we don't have any way of hedging our portfolio or anything like that. So the only thing that can be done is maybe bleed through the entire process. The other thing is, as I told you, rollover process we will not invest anything which is coming in the closer maturity. So technically speaking, we don't have much of a room to play around here with. So new investments can be, as I told you, ladder, maybe, and especially what Rahul said about the 2 to 3 year bucket, the 2 to 4 year bucket. They've already seen a bit of a hike, or the rates have already moved up. They've already factored in a bit of a rate hike, but not as big as that would have expected in the last 2 days. But yes, they have already factored in a bit of rate hike. So I would rather stick around into that range of 2 to 3 year for some time before taking another view on the market again.
Same question to you, Rahul. I mean, if there is a sudden spike, or do you also think that if RBI does not touch the liquidity first and then try to increase the rate, because the reverse repo is already at the VRR 4%. I mean, do you think that it will have an impact? Because we have seen earlier scenarios, if the liquidity is ample, these policy rates are of less significant.
I'll just like to add one more thing here.
Yeah,
See, the
sure.
point over here in the Indian market is the moment the market starts moving up, the buyers are nowhere to be seen. So, strategy wise, you don't have much to do. Anyway, Rahul. Yeah, Rahul.
Go ahead, Rahul. You hear my?
Yeah, so I would like to add a few points.
Yeah.
Yeah, one on the long end part of the curve. Generally, if you go by theory, long end part of the curve, they are not impacted by policy decisions. Only the short end part of the curve is impacted by all this repo, reverse repo, which is basically the policy rates. But now, what has happened in the start of the January, February, when everybody was talking about inclusion of government bond indices, and RBIs and government, they are working very hard to make it Euro clear, make some changes in the budget, in the Finance Act, to tweak the taxation impact and all the market participants, they started building up their position, thinking that there will be a rally of 10 to 15 basis points. And that's how the yield were kind of stabilized around 630, 635. The time the news that came out that there is nothing of that sort, no major change has happened in the last 1.5 months in terms of the growth dynamics or the inflation projection and all. But suddenly you see the GSEC went as high as 680 to 690. So this clearly shows that there are a lot of speculation which is happening on the long end part of the curve, which RBI wants to avoid. Secondly, in terms of how long RBI can continue with this stance, The answer is they have lot more elbow room right now because of we are not fragile 5, which we were during the last time. Now we are one of the largest emerging economies, and with a good forex reserve cover. So with both this ammunition in hand, and also our inflation is totally different from what inflation is being felt by US and all. Those are mostly driven by labor wage rate and all. Our inflation is mostly driven by the vegetables, like the CPI weightage is around 42%, food and fuel. So these are the major areas, and if we are able to control crude price, and if we are able to see a good kharif, good monsoon and good kharif crop, then obviously if inflation remains within the band, flexible inflation targeting band, then obviously RBI is not going to chase Fed in terms of hiking rate. Obviously, it will be a tough task to manage the flows and inflation, everything put together. But obviously, growth it has been made amply clear by RBI that they are not going to let growth go down at any cost. So the accommodative policy should continue as long as possible, unless sustainable growth is witnessed.
Correct. Yeah. No. This point is echoed everywhere, that RBI, both government are in sync, unlike earlier days where there was some divergence. So, which means that there is some information, would have been exchanged, and people would have based their decision on that. One of the critical information or critical market action which everybody was looking for, slightly digressing into equity side, is the LIC IPO, which is going to be the mother of all, and people are expecting anywhere between 65 to 1 lakh crores. And now it is, anybody's guess, given scenario, it will happen this year or it will go to next. So in that, the question to you is, if there is a shortfall in the revenue, and if it's going to remain, you think that RBI will be able to maintain the rates, or you think that government will be able to spend and the related GDP growth? Because the private capex are not happening. The traditional private sector, or very few, are doing the capex, and telecom 5G investment might come. But given the scenario, will it impact government's ability to spend and in turn increase the GDP? And also your views on GDP. Probably I'll go back to every members after this. What would be their views on GDP? But starting with Ajit, yeah.
So obviously, if LIC IPO gets deferred, which is highly likely looking at the current scenario, the entire government balance might go for a toss. But we still have some kind of buffer which was not taken into consideration at the time of preparation of the budget. One major impact was the switch of 1.1 trillion transaction that happened. So the budget number did not take into account the impact of the same. So that was made clear to the press post-budget. The second thing is that the robustness in the GST collection, the robustness in the direct tax revenue collection. So market participants were expecting that there will be some surplus cash, which either will lead to the cancellation of auction, or that surplus cash will be carried forward for the next year. So the aggressive, the fiscal deficit number which RBI gave as part of the budget numbers, so that will come down from 6.9 to probably 6.7. So obviously some, and as rightly said by Mr. Ajit at the start, that RBI has cleaned up its entire off-balance sheet financing this year. Now, in terms of borrowing through national small savings schemes or through funding through FCI, that buffer is still there, even though they have cleaned it out. But that will be only resorted to as a last resort. But if you even keep that aside, robustness in the tax revenue, the switch transaction that government has done, and that kind of will provide some kind of offset to the delayed in LIC IPO. Coming back to the question of GDP, in terms of growth projection for the next year, there is nothing, no major impact, I would say, which we are one of the largest growing economies in the emerging market space. So that itself will going to provide some kind of upward bias in terms of total net government borrowing program for the next year. So whatever be the number which has been envisaged, 13 trillion for the next year, we feel that that is also on the higher side. And if the higher nominal growth happens, that can easily come down to 10 to 11 trillion of net borrowing number for the next year.
Thanks on those macro numbers, Rahul. I'm going back to Mr. Ajit. You echo these sentiments. Will RBI be able to manage the government borrowings? And if there is a as a post-script communication with the borrowings going to be lower due to the switch this year. So on the cash budget, you think RBI will be able to manage without disrupting the rates in large? And
I presume it is to me.
Yeah, yes, Mr. Ajit Banerjee. Yeah, there are two edges.
Okay. So actually, I think we have seen that while we may say that the cancellation of 2 auctions which government did in the month of February was to calm down the yield curve and all, which suddenly went for a sporadic rate hike.
Which touched 7 and came down. Yeah, it helped actually.
Correct. So actually, it was not only to target or bring the target rate down, but I think it was made because it also I guess bears. It is essentially we can say that it also demonstrates the fact that government is sitting high on cash balances. So that is something, the reason which, by virtue of which it could afford to actually take that call. And as we understand that in the month of March, there is possibly not going to be any further borrowing which is going to happen, which means that it is pretty much comfortable, at this point of time for not going for any enhanced borrowing. What other point also we need to see that, which RBI governor has always been consistently maintaining that he will ensure a orderly evolution of the yield curve. Of course, at that point of time, I think he didn't envisage that this war will happen. But at the same time, he had also mentioned a point that he will not, be willing to rock the boat when it is near the shore. That's the word which he used, I think, in last but one policy. So I think keeping that in mind, where the growth is required, and each and every country has its own computation of the inflation index and all. So naturally, we are slightly better position, but at the same time, I think there are certain assumptions under which the RBI made those, forecast. But if those basic assumptions go wrong, then certainly they have to recalibrate their forecasting. I was reading one article which says that if the oil prices remain throughout the year, hypothetically, say between 100 to 110 or 120, it might impact our GDP by 1.2% downside. So I think this is a broad calculation which I was hearing actually one forecast which was saying. So if that happens, then definitely both the government as well as the RBI will definitely sit together, and there's a good amount of convergence which is there between the fiscal and monetary policy. So I'm sure with that with that approach, we can certainly look forward a revised set of numbers, because there is always a way out for a revised estimate which is in play. That is what I can say at this point of time.
True. So this question is to Mr. Chidran on emerging mega trends. I mean, we are seeing, Rahul said the wage inflation is still it's on the Western phenomenon, which means the urban place, we all have seen the wage inflation, but on the rural side, it has still not happened. So on the rural or on the mid SME or on the new age companies which are not there on the, so to say, the startup companies, but on the regular companies which are, so you think their inflation is still not caught on, or it will happen, or will these companies be able to tide over if there is an inflation, and they're able to, if the macro, as Ajit just mentioned, slowdown happens because of high prices, will they be able to sustain this?
It's been difficult, right? I think the pandemic has really put a lot of organizations to a lot of difficulties. Some of them were not sure whether they need to retrench, staff or run at very low levels. So people have been trying their best to save cost as much as possible, right? And the smaller the MSME units have been the biggest hit in this aspect, as well as all your non-essential shops. For example, your groceries, your pharmacies, all your essentials have been relatively, they sort of took care of themselves. But the other segment has been hit badly. So when you even take the large ones, right? I mean, IT can work from home, but manufacturing entity cannot work from home. I mean, you will have to be on, you'll have to come to the factory to do the production. And in the automobile side, for example, which is one of the largest employers, in the country, the chip shortage is not helping. So there are a lot of other inherent challenges which are very much there. I think, but what we have seen is that India has been quite resilient, and we have also grown quite a bit now. We are not a small economy, 10, 15 years back. So I am very optimistic that we will be able to pass through more comfortably than we could have been maybe even 10 years back. So we are in a much more stronger position, right? The forex reserves are there, the government is aligned, right? And the policies are in a way supporting the growth. I believe it's just going to take a few more months or maybe till the whole situation globally stabilizes. But after that, I think we should see the growth back. I mean, hopefully the pandemic is done and dusted. I don't see another wave coming and hitting. I think the Omicron hopefully is the last one we had. Not much on the BA2 as well. So if that is sort of doesn't come back, I think we are on track, right? Even if you see the kind of the infra we have created on the pharma side, we used to be significantly dependent on China, the APIs and all that. So now slowly India is becoming a lot more self-dependent on many accounts. So we'll have to wait and watch. Honestly, I think nobody has a
answer. But the government,
but India is much more stronger. That is what I could say.
Yes, if I can add on, the PLI schemes are also helping. Every sector, major sector today have production-linked incentive schemes, and we are seeing a lot of investment flowing in. So another interesting is that the kind of capital raise, equity capital raised, and the risk capital that has come into the country, which I mean, this year will also going to be another robust year for equity. So with such a attraction, I think the macro, though there may be tailwinds with these, and there may be some headwinds due to the oil price, but stabilized policy should, stabilization across should help us. And Ajit, if I can ask one question, if your AIFs, which have now occupied a major space in the investors' portfolio, with of course the family offices have been. So would they, are they willing to look at giving long-term debt, and what would be the expectation? Of course, it may be sector-wise different, housing company may borrow at lower rate, but would there be a buy-in at these current rates or slightly elevated given scenario? Are they buying the India story and then they are willing to lend?
See, most of the AIFs and even the PMAs, part of the PMAs, I think they're still buying the last line, what you said, the India story, where, we've seen different AIFs coming out in the industry that become agri AIF, there is a defense AIF, there is a real estate AIF. Real estate AIFs have always been there in the industry. But in the last 1.5 years, you've seen defense industry AIF coming up. They housing AIF coming up. So basically, they are buying the India story, and they're willing to stick around there for the next 1.5, 2 years, maybe more than that, maybe 5 years down the horizon is as long as 5 years on that. So we've seen specific AIFs coming onto the education sectors also. So there are very interesting space as we've heard in the last panel. The AIF industry is been growing leaps and bounces. In the last 1 year, I just had a number which came in yesterday in one of those newspapers, the AIF industry has gone up by almost 38%. That is as on March 31st last year, it was 4.42 lakh crores, whereas now it is close to about 6.09 lakh crores. That is the type of growth, 38% growth, whereas the only mutual fund industry is only grown by about 22%. This is broadly what is happening on the AIF industry. It is the industry. If you have any view on debt to be in, AIF industry is the way forward for debt.
Cool. So that we are very close to the conclusion. I mean, before that, if I can do a quick poll, we have both, the supply side and the buy side. What will be the expectation on RBI and Fed? Of course, is a long shot, but at least Fed governor has made his points clear last night. But at least on the RBI side, so what would be the expectation? We can start from the Ajit from the investor side. What would be your expectation on RBI, and where are you seeing the inflation, CPI consumer to?
See, I would expect that, I think, yeah, please go.
Yeah, please
go. Yeah.
Yeah, please, Ajit.
Mr. Banerjee, you can go.
Okay. So I would expect, again, RBI to be moderate in stance, in the sense that possibly the next hike also, in August, we can expect one hike of 25 basis points, followed by another 25 basis points towards the end of the year.
50 basis? 50 basis is your call.
Yes. Yeah,
yes, Ajit, on your.
I'll give you a number of 735 to 750 is what I'm looking at 10-year, maybe 1 year down the line.
So on the policy side, should be what, 50 basis?
On the policy side, yes, 50 basis points.
Yeah,
and that too the same, as I told you in my last statement also, August will be the time when we see the first rate hikes rolling in India.
Well, Mr. Rahul, your number for this?
So my take is around 7 only, around 7,690 to 7, because I expect RBI to come up with this announcement on this inclusion of government bond indices, which is kind of an OMO. If it brings about on a consistent basis 1 lakh crore of bond purchase for the 10-year benchmark. So I'm expecting RBI, that is the only news which can provide some respite to the rising yield curve and to reduce the cost of borrowing for the next year. So that is the only reason why I expect that 10-year will not, RBI will not allow it to cross beyond 690 or 7 to the max.
Oh, that's different. On the policy side, you're saying another 50 basis?
Policy side, I've said earlier, August is the one where we might see a 25 basis point rate hike and overall 50 basis point rate hike. So terminal rate by end of the year, we can see, by next year, we can see around 450. So one rate hike and a pause, and another rate hike and a pause.
All right. So Mr. Suchindra, your number, thoughts?
Yeah, see, I think the government borrowings have to be managed by RBI. So I think it will be a very fine balancing act. I don't think they're going to let the yields go up significantly. But on the rate hike, I think it is too difficult to predict when they are going to do. It all depends on the specific macro event at that point in time. But definitely a rate hike will happen. At least they will stabilize the reverse repo immediately, right? And the repo, they will wait and watch and then take a call. So I don't see any steep increase in the policy rates, but definitely a 25 basis points to 50 basis points will happen in this financial year.
Yes, I mean that's where my thoughts are also around 50 basis, and with the lag, probably August may be the first, and then towards the end of the year. Well, we have a good consensus on that note, and yeah.
So I have one point to make. I think
sure.
we mentioned about Rahul mentioned about this inclusion in the foreign bond index. I think my personal view is government may not like to take that risk at this point of time, because that will bring in additional volatility once again in the fixed income side also. So I think that's a conscious call taken by the government not to subject fixed income market also into the foreign bond index index inclusion. The lot of compliance also has to go on. The step is there because transparency has been brought in. I think so. Possibly this might happen in next year, next calendar year or next financial year, but most unlikely to happen at this year, at this financial year is what I feel actually. I mean, this matlab
Possible.
23.
Yeah, possible. With the
2023.
geopolitics to settle, and then they may.
Just to add to that, one small point is that the FPI limits will be opened up from 1st April. I think the budget
on the VR side,
the
yes.
offshore money will definitely come on the debt side, which will leave out the pressure on the banks and other domestic investors. So that will be a big positive. I mean, if the indexes inclusion doesn't happen, I think this will sort of, in a way, cushion that to some extent.
Well, yeah, that's good. Engaging panel, I would say, and thank you all for being part of this. The consensus is there's going to be a rate hike, and the rate hike is about 50 basis the terminal at the end of next financial year. And I hope this geopolitical settles somewhere and gives the policymakers enough room. And yeah, that's been a good engaging session. I thank you all for, and thank you Templeton for arranging this panel discussion. And we hope we had communicated our thoughts. So, thank you.
Thanks a lot.
Thanks, Prasanna. Thanks to the fellow panelists. It has been nice interaction. And thanks to Franklin Templeton also. Let's look forward to remain connected. Thank you.
Sure. Thank you.
Thank you, everyone. Thank you.
Thank you. Thank you, Prasanna. Thank you, Templeton.
Thanks. Bye.
Thank you so much, Mr. Prasannan, and all the panelists for joining us for this fantastic panel discussion. It's been really very insightful. With this, we just take a short 15 minutes break. We'll start off with the next presentation at 4:15 sharp. Thank you. Request everybody to stay logged in. Thank you so much.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Rise, focus, start. Because you have dreams to dream and places to go. Do not let anything stand between you and your desire to win. Begin before anyone else and race ahead. Achieve more. Those who start early go the farthest in this marathon of life. Start early in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Your situation isn't bigger than your spirit. Your shortcomings don't define your journey. You do. So when life packs a punch, prepare to give it a knockout. Look it in the eye and embrace the challenge. Resilience defines character, and character makes legends in this marathon of life. Be resilient in life and your investments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good afternoon, everybody. Once again, welcome back. So we have a next presentation that we have on estate and succession planning strategies for family offices. Please join me in welcoming Mr. Prasanth Laharia, who's the whole-time director and owner from Merino Industries Limited. He's bringing 28 plus years of enriching leadership experience. Glad to have you, Mr. Prasanth. Over to you.
Yeah, thank you. This is one of the first times I'm addressing a VC like this. So basically, for last 3-4 years, we have been making investments, and Satyaki has been our advisors. Mr. Satyaki Bhattacharya of ICICI Securities. So from him, or through him, we have made a lot of investments. So he suggested, why don't I speak in this family office summit? So I said, okay, we'll do that. So there are two parts of this that I would like to discuss. One is what we have made what is called an IPS, or a investment policies. IPS as an investment policy statement, and how are investments and where we have invested. And we have tried to make it as per the investment policy statement. This investment policy statement is a dynamic statement that may change as per the market dynamics. It's sort of, we have also changed the investment policy taking into account the realities. So this is what I would like to show the audience. Can I present? Share your screen.
Yes, Mr. Prasan, you can certainly share your screen for the presentation.
Yeah, I'm sharing a screen.
Yeah.
I looks like I have to quit and reopen, which I will do. Okay.
Sure. There's a share screen option right at the below of the tab. I think he's logged off. I'll just check. Mr. Prasan, are you there? Okay, I believe he's dropped off. Let us wait. Okay, he's logged in back. Yes, Mr. Prasan, I hope you're able to hear us.
Yeah. Can you see this IPS?
Yes, it's an Excel sheet that's visible. Is that the one?
Yeah.
Okay.
So we made what is called our investment policy statement, which tomorrow I would recommend to all the people who are making outside investments and setting up a family office. So depending on their risk appetite, I recommend that they set up this. This is the first step of setting up a family office. After all, what is a family office? Family office is where, as a family or as an organization, we invest outside because we want to de-risk our investments. So we want to put some money outside our businesses. So that's why we make a family office. We take in experts. We may have full-time people working. If not a single day passes that I don't get like tens of proposals, invest here, 1 crore here, 50 lakhs there, this, that. So which proposal should we take up and which proposal should we take to the next step, which we should reject? So that we try to do seeing our investment policy statement. So I'll just quickly, so this is our objective: capital protection and portfolio growth. We want minimum this 12.5% pre-tax depending on risk appetite. Someone can make it 15, someone can make it 10, and so on. Then risk tolerance it's a conservative. I don't know if there's anything called nil risk, but I've written anyway. Moderate. So this is non-speculative, prudent, and growth-oriented. Okay. Mode of investment. Normally, we decide. See, on the right side is decided at part-time or investment. What do we do? What kind of investment? Typically, we don't do direct investments. Mostly, we do PMS or AIFs or mutual funds. PMS, a portfolio management service. We don't do direct investment in shares because I feel that is more speculative. And then the horizon, 5% is 0 to 6 months of 100%. This is what we have said. 6 to 12 months, minimum 10%, 13 months to 3 years, maximum 80%. Because tomorrow, if I need the money, I can't have it locked for too long. And 3 years above, maximum 20%. Means none of my investments or any proposal should be stuck in funds that are more than 20%. And this is the most interesting part. What do we allocate to debt? What do we allocate to equity? As of now, it was 60% debt, 40% equity, but now we have made it 50-50. And asset, see, and liquid fund minimum, we want 5% equity liquid funds. maximum 10%. And this are asset allocation, pure debt or fixed income, maximum is 95%. That means minimum 5% we will put in equity. Equity mutual funds, equity mutual fund should have minimum 50% equity. That's why we call them, and debt mutual funds, they must have 50% debt, major debt, and so on. Index funds, maximum 20%, AFS, maximum 20%. So I can't put more than 20% of my investable amount in index funds or in AIF BMSs, and real estate, maximum 5%. So if I'm investing 200 crores, maximum I can put in real estate or REITs or InvITs 5%. And open-ended must be 70% of the portfolio, because as you are aware, some funds are open-ended, some funds are close-ended. Close-ended, they have final close, you can't take your money out before. So it's recommended. So we recommend minimum 70% of the portfolio should be in these funds. And we try to avoid too much of segment exposure in a particular segment. So single fund house like Reliance Fund House or SBA Caps, we consider that a fund house. So a single fund, HDFC is a fund house. A maximum fund house cannot be more than 20%. And a single stock, say Reliance, can't be more than 10% of the portfolio. And a single scheme, because a fund house can have many schemes, so single scheme cannot be more than 20%. And large caps, and remember all these figures keep changing. Sometimes large caps, sometimes small caps, sometimes mid caps. So large caps, minimum 80%, mid caps and maximum 20%, small cap maximum 5% of our portfolio, and so on. And so on, this goes. What should be a redemption policy? I don't want to bore everyone with this. What should be the compliance? What restrictions? No commodity linked investment. This is what we have made. And it took us almost a couple of months to make this this investment policy statement, because we had a lot of interactions with our fund managers, with the advisors before we could freeze this. So I would say this investment policy statement, that is the first step and the most important step in making any family office and outside investments. The importance of this cannot be overestimated. So when we start a family office, we must do this the first time. And this is so. I would highly recommend everyone who's setting up a family office should make this investment policy statement. And next is just a quick look at our portfolio. What we actually have. So, for example, because of now this Ukraine-Russia war, some people may be increasing their equity exposure. People say equity is at the bottom, close to the bottom. Whether it's close or it's not close, that's a call we take. But I advise everybody, for equity, please hold it for 3-4 years at least. For minimum 3 years. Don't panic very quickly, because equity takes time to give returns. So we advise 3 years to 4 years, you should hold the share. Then we get handsome returns. So this is our different advisors. Our advisor, ICICI Securities, Kotak, Avendus, and others, some FDs. So right now, including FDs, we have a total portfolio close to 500 odd crores. And this, of course, this figure keeps changing also. Right now, the present value is showing 407 of the investments, And this doesn't include our trust. So this figure also keeps changing. And this, we get a weekly report to see where we are in our investments. Because tomorrow, if we invest money, it's very important to monitor it regularly, and monitoring it too often is also a problem. So we monitor our portfolio once a week, how we are doing compared to, and how each advisor is doing. So we try to do that. So that's pretty much so like you see, our portfolio is, we have made investments totally 125 crores, whose present value is 141, and these are the FDs. Some equity, 97 crores equity, that has become 141. 86 was debt, that became 124. And some are bank FDs. We have about 325 crores in bank FDs. So total amount is 466. We are right now buying some bonds and all that. And this is our company. These are our trusts. Then, because trust, there's a limit on what you cannot invest in. So trust is as per the law also. The law comes in the way. So this is pretty much it. So if anybody wants to ask something or anything, please let me know. Share band kar do. Does someone have questions, please?
May I request the attendees to share any questions to Mr. Prasanth?
If they have any, of course. So I hope it's all clear what we do. Like I said, the IPS, I would always recommend when someone makes a family office, make a robust IPS, don't hurry in it, and take your time and make it as per your risk appetite. Like we have 50% equity, 50% debt. Someone can have 60% equity. Someone can have 70% equity. Something is unlisted shares, some is non-unlisted, and so on. And we must make our IPS and follow that. That's the most important that I've learned in, say, 4-5 years of investing. And the entire investments of our group goes through me, and over the period, we built it up to about 500 crores also.
Okay, Mr. Prasanth, we have 2 questions come up. One question is as to what has been your overall return? That's a question from Sajan Ghosh, who's asking this question.
Can we go back to that? The overall return on equity has been about, that one. Yeah. I'll open it. The overall return, see, all these returns are annualized returns. We convert it to annualized. So the overall return is, okay. The overall return has been about 10%. 10% and equity return, 10% total annualized. So equity has been returning 22% per annum. And debt, as you assume, debt will be less. Debt has been returning 6%, 7% per annum. Recently, debt markets, equity markets, both have gone down. So this figure was better, but it's come down a little bit, hopefully. Like, we should not panic too much about these events that are happening. So if we wait, then again, I feel the returns will start coming back, because this war is should end soon. Some sort of settlement will happen, and I foresee the equity markets will come back roaring. So if someone wants invest, it's maybe contra advice, but maybe right now is a good time to invest in equities because they are, we can never touch find the bottom, but I feel they're close to the bottom, close to. So to answer your question, sir, 22% return we got in equities, but we consider ourselves to be risk averse or less risk. So if someone is willing to take more risk, the returns will be better. You could get 30%, but 22% definitely beats putting money in the bank FD. So that's the answer to the question of returns.
Thank you. We have another question to come up by Mandeep. It is on ESP absolute return funds. So, so how do you view on alternatives? That's the question.
The AIFs, you mean? The AIFs, I would say AIFs, see, like today we had a call with this Old Bridge Capital. So AIFs are otherwise, I would never advise long short because long short, the is too high. The taxation is 42% on long short funds. AIF has category 1, 2, and 3. The most common is category 3. So if we invest in normal AIFs, the taxation would be, or AIF equity, the taxation would be mostly 10% or 15% depending on the duration. So I would advise AIF as a good, the only difference that they have made in AIF compared to other, say PMS AIF, the minimum is 1 crore to enter an AIF. PMS minimum is 50 lakhs and mutual funds, the minimum may be 5,000 only. That is the, but AIFs are right now becoming more and more popular. Typically, yes. Does that answer your question, Mr. Mandeep? But what I don't recommend in AIF is the long shorts because there the taxation is very high. Almost it leads to it being uneconomic, almost 42%. So AIF, you should consider normal AIFs, don't take a long short AIF.
Okay, Mr. Prasad, we have one more question from Mr. Prateek. Is there any software you use for all the recording of transaction and for portfolio performance?
No software yet, but we are reaching that stage where we need one. So we have had demos of various softwares. All these softwares tend to be little expensive. So, but we are on the track of buying software. I would always advise that only if your investments cross, say, about 100 crores, take that software. Only then it is cost effective. Otherwise, it's not really cost effective. Because all these softwares are not cheap. They're quite expensive. Or your advisor can help you out with his software that they use. They use very expensive software, but I find the information they give is late and kind of not that great. So we must have our own software. Otherwise, it becomes difficult to keep track. So right now we don't have any, but we are evaluating to buy some software. Any other questions, please? I guess that's it.
Yes, Mr. Prasad, thank you so much.
Welcome.
I
And
think, yes, that's about the questions. Thank you so much.
if
Thanks for
anybody
answering.
has questions, they can send me an email via maybe Franklin Templeton also. So I'll be glad to answer it. And my email ID is prasanlohiya@merinoindia.com. So if anybody has any queries, please send me and I will definitely reply to you. Thank you.
Thank you so much, Mr. Prasad, for joining us. Thank you.
Thank you. Thank you.
So we will be starting with the award ceremony in next 10 minutes. I request all of you to stay logged in. Thank you.
We get you.
Good afternoon, everyone. Welcome back. So as I mentioned that we will be moving to the most exciting part of the conference. The two-day conference has really been very insightful with all the leaders joining us from different parts of the industry, sharing their journey, their challenges, their strategies, their successful journeys with all of us. And it's really been very, very insightful and exciting all the entire 2 days. So finally, we've come to the Family Office Awards 2022. I'm very, very privileged to invite our jury, Mr. Sachin Desai, who's the Vice President, Fixed Income Franklin Templeton Asset Management Private Limited. A very warm welcome to you, Sachin.
Thanks, Sharon.
Before we start off with the awards, I request you, as we announce the name of the winners, I request you, the moment you hear your name, kindly click on the icon of the hand that you see right in front of your screen. That's a hand raise option, so that we can help ask you, be able to pull you in to join us on screen to receive the award from Mr. Sachin. So with this, Sachin, I hope we are good to go to start off with the award ceremony.
Yeah, we are good to go.
Great. So, okay, the first category is for the Best Family Office Leader of the Year. And this goes to?
This is, you're talking about alternate investment?
This is for the Best Family Office Leader of the Year. Kindly refer the screen that is being shared, Sachin.
Personality of the year, basically.
No, Sachin, there's a screen that is being shared. If you can please, can you see the slide over there?
Oh, yeah, sorry. I was looking at your Excel sheet. My mistake. Yeah, so the Best Family Office Leader of the Year award goes to Mr. Amit Goenka of Hindustan Composites Limited.
Congratulations, Mr. Amit. If you're there, you can unmute.
Yeah, I have unmuted, Sharon, and I'm there.
Congratulations, Mr. Goenka.
Yeah, thanks a lot.
Thank you. With this, we move on to our next category. The Best Family Office Alternative Investing. And this goes to? The recognition goes to?
The recognition goes to Mr. Puneet Jain of Karun Carpets Private Limited, which is a Karan Thapar Group company, and Mr. Srinivas Sheshadri of Mirabilis Investment Trust. And the winner of this award is Mr. Shekhar Jadhav of Probity Advisors Private Limited.
Congratulations to all the recognition and the award winner for the Best Family Office Alternate Investing. Mr. Puneet, if you're logged in, you can unmute and share us a thank you speech over there.
Yeah, thank you so much. Thanks, Templeton, and thanks, Transformance, for the award.
Congratulations, sir.
Congratulations, Mr. Puneet. Okay, in the same category, the recognition, as announced, Mr. Srinivas Sheshadri, if you're logged in, you can also unmute and share a vote of thanks.
Yes, hi. Thank you. I'm happy to accept this award on behalf of my colleagues who have helped us reached a good journey on this.
Congratulations, sir.
Congratulations, Mr. Srinivas. Okay, and the winner is, as announced, Mr. Shekhar Jadhav. Shekhar, if you're there with us on the call, you can unmute. Or maybe you can raise your hand in case you see a hand raise option right below at your screen, in front of your screen.
Yeah, can you see me? Hi.
Yeah.
Thank you.
Hi, Mr. Jadhav. Congratulations.
Yeah, thank you. Thanks a lot, Franklin and Transformance team. This was a wonderful sessions, couple of days you had put together. Thanks a lot.
Congratulations, Shekhar. Okay, so with this, we'll move to the next category. This is for Best Family Office Equity Investing. And this goes to?
Yeah, the recognition goes to Mr. Srinivas Sheshadri of Mirabilis Investment Trust once again. And the winner is Ms. Rohini Kalyani of Kalyani Consultants Private Limited.
Okay, congratulations, Mr. Srinivas. If you've joined the call, maybe you can raise your hand so that we can help you join us on screen.
Yes, hi. Hope I'm visible. Thanks again. It's a double privilege to receive the award. It on behalf of my hardworking colleagues.
Yeah, congratulations.
Congratulations, Mr. Srinivas. Okay, the final winner is?
Ms. Rohini Kalyani of Kalyani Consultants Private Limited.
Congratulations, Rohini. If you're there on the call, maybe you can please raise your hand to join us on the screen.
Hello.
Okay. Hi, Rohini.
Congratulations, ma'am.
Thank you, sir. Hello.
Yes, Rohini, we can hear you well.
I'm acting रोहिणी मैडम के इसमें मैं उनकी behalf में ले रही हूँ उनकी PA.
Okay. Congratulations to you and your team.
Thank you so much.
Congratulations, Rohini, once again. Okay, so the next category is for the best family office fixed income investing, and this goes to?
Yeah. So recognition goes to Mr. Amit Goenka of Hindustan Composites Limited and Mr. Sanjeev Sahu of MacLeod's Pharmaceuticals Limited. And the winner in this category is Mr. Srinivas Sheshadri of Mirabilis Investment Trust.
Okay, Mr. Amit, if you're there on the call, maybe you can unmute.
Yeah, I'm unmuted. And thanks for this award once again. And
congratulations, sir.
Double privilege. Thanks a lot, Transformance team. Thanks a lot to all of them.
Congratulations. Okay, and the next recognition goes to Mr. Sanjeev Sahu.
Sanjeev Sahu, yeah.
Is Mr. Sanjeev there on the call? Maybe you can please raise your hand so that you can join us on screen. Mr. Sanjeev, if you're there on the call, you can please click on the hand raise option so that we can help you join us on the screen. Okay, I think he's not joined in. Maybe have a look at the final winner.
Yeah, so Mr. Srinivas Sheshadri. Once again.
Yeah. Thank you so much. I can't believe it. Though I'm very, very grateful to accept the award again on behalf of.
Congratulations once again. Mr. Sachin, if I could request you. Mr. Sachin, if I could request you to go one-on-one with for the winner so that they can simultaneously come and join us on screen.
So I think basically I just call out one name and then wait. Is that what you're saying?
Yes.
Okay.
Okay. So can we move on to the next category, please? That's for the best investment research professional of the year, and this goes to?
The recognition goes to Mr. Sanjeev Sahu of MacLeod's Pharmaceuticals Limited. I think he is not there because in the previous award also his name was there. So
yes,
I will just move on to the winner.
Sure.
The winner is Mr. Pankaj Chopra of India Accelerator.
Mr. Pankaj, if you're there on call with us, you can certainly raise your hand so we can help you join us on screen.
Hi, thank you so much, guys. Thank you so much, Sharon, and thank you so much, Franklin Templeton, for giving me this opportunity to be on this event. And Sharon, 3 cheers for you. You guys pulled up a great event. Thank you so much again.
Congrats, Mr. Chopra.
Thank you, Sachin. Thank you so much. Thank you.
Congratulations, Pankaj.
Thank you.
Okay, so the next category that we have is for Family Office of the Year.
Yeah.
And this
So
goes
the
to?
first recognition goes to Ms. Rohini Kalyani of Kalyani Consultants Private Limited.
Rohini, if you have, I think you're there on the call. You can unmute.
I think a colleague was there on the call. So.
Hello, yes, ma'am.
Yeah, congratulations again to your team.
Thank you. We are very happy to receive these awards, I'm accepting these awards on behalf of the Rohini Kalyani Family Office. Thank you very much, jury and Franklin Templeton.
Yeah, congratulations.
Congratulations, Rohini.
Thank you, ma'am. Thank you.
Okay, the next Family Office of the Year and
Yeah. So the second recognition goes to Mr. Shekhar Jadhav of Probity Advisors Private Limited.
Mr. Shekhar, you're there on the call. You can unmute and join us on screen.
Congratulations again, sir.
Thank you. Thanks a lot. Gladly accept this on behalf of the entire team. This is a team effort. Thank you.
Congratulations once again, Mr. Shekhar.
And the winner of this award is Ms. Anjali Dave of ACG World.
Ms. Anjali, if you can please join us on screen.
Yeah, I'm there on screen.
Yeah, congratulations, ma'am.
Thank you so much for this recognition, and I accept this on behalf of my entire team because it's a team effort. Without my team backing me, it wouldn't be possible. Thank you, Templeton, for inviting me over this event, and Transformer for arranging such a wonderful event. It was truly a memorable journey for me. Thank you so much.
Congratulations. Okay, so we move on to the next category, which is on Best Consulting Firm for the Family Offices.
Yeah. So we have a hat trick once again. It's Ms. Rohini Kalyani of Kalyani Consultants Private Limited, who gets the recognition for this category.
Yeah. Ms. Rohini, if we can again have you join the screen for receiving your recognition.
Thank you so much.
Congratulations once again to you.
Thank you, ma'am. Thank you so much.
Okay, so the next category we have is for Best Risk Manager of the Year. And this goes to?
Yeah, the recognition in this category goes to Mr. Shreyas Jain of Cello.
Mr. Shreyas, if you're there on call with us, kindly join us on screen.
Hello.
Mr. Shreyas, yeah.
Can you hear me?
Yes, Mr. Shreyas, I can hear you well.
Yeah. Thank you. Thank you very much. Thank you very much, Templeton. I'm happy to accept this award.
Congratulations.
It's a great honor for me. Thank you. Thank you very much, Sharon. Thank you very much, Sachin, and to the entire jury team. Thank you very much.
Congratulations, sir.
Congratulations, Mr. Shreyas.
Thank
you. The winner in this category is Mr. Amit Goenka of Hindustan Composites Limited.
Yeah, thanks again. Thanks once again. First of all, let me thank the whole team of Transformance for organizing such beautiful event, in fact. And this was my first experience as a panelist to discuss about various aspects of investments under the moderation of Sanjay, which really helped me, who really helped me a lot in this regard. Sharon, you are excellent. You have helped me a lot in this connection and all things. And last but not least, thanks to all the jury members who have considered me as appropriate to get these awards. And I have got all the 3 awards for which I applied. I thank a lot to the jury member.
Congratulations.
Congratulations, Mr. Amit. Thank you so much for your participation. Okay, so the next category we have is for ESG Advocate of the Year. And this goes to?
Yeah. So the winner in this category is Mr. Puneet Jain of Karun Carpets Private Limited, a Karan Thapar Group company.
Mr. Puneet, if you're there on call with us.
Yes, thank you, everyone. Thank you, Templeton and Transformance for this award. I really appreciate the same. Thank you so much.
Congrats, sir.
Congratulations once again. Okay, so the next category is the Family Office Personality of the Year. And this goes to?
Yeah, the award goes to Mr. Priyavrata Mafatlal of Mafatlal Industries Limited.
Mr. Priyavrata, if you're here, kindly join us on screen. You can click on the hand raise option that you see on the lower tab of your screen.
Hello. Hi, I thank the entire jury on behalf of Priyavrat for this award. Thank you so much. Grateful for the recognition.
Yeah, congratulations.
Thank you. Thank you, Saurabh, for joining on behalf of Mr. Priyavrata. Okay, so the best category that we have is for best technology platform for family office. And this goes to
This goes to Ms. Karishma Jain of Bulls Vision Fintech India Private Limited.
Ms. Karishma, if you're there on call with us, kindly raise your hand so that we can help you join us on screen. I think she's not there logged in on the call. It's congratulations to Ms. Karishma and her team. Can we move to the next category, please? The best startup advisor of the year. And this goes to?
It goes to Mr. Kedar Sabne of CAS, CFO as a Service Consulting.
Mr. Kedar, if you're on this call with us, kindly join us on screen. I don't think so. Mr. Kedar is logged in.
Hello.
Okay. Okay, Mr. Kedar, we can hear you. Kedar, you've gone on a mute. If you can please unmute. Mr. Kedar, you're still on a mute. May I request you to please unmute so that we can hear you? Mr. Kedar, if you can please confirm, are we audible to you? And if you can also unmute so that we can hear you. Okay, I think there is some technical glitch. But anyways, congratulations to Mr. Kedar. We would love to hear from you as well. Sachin, is it okay if we move on to the next category?
Yes, please.
Okay, so the next category is for the best family office corporate governance. And this goes to?
It goes to Mr. Kunal Palta of Hero Cycles Limited.
Mr. Kunal, if you're there on the call, kindly unmute and you can join us on the screen and unmute and give us a word of thanks. Mr. Kunal, are you there with us on the call? Okay, I think he's not logged in on the call. So Sachin, we can move on to the next category.
Okay.
Maybe have the next category, please. For the best family office corporate governance, and this goes to?
It goes to Ms. Rohini Kalyani once again of Kalyani Consultants Private Limited.
Rohini, request you to join us once again on the screen for receiving this honor.
Thank you. Thank you so much once again.
Congratulations.
Franklin, thank you. Thank you.
Okay, so the next is for the best impact investment offering, and this goes to?
It goes to Mr. Sanjeev Sahu of MacLeod's Pharmaceuticals Limited.
Mr. Sanjeev, in case you've joined the call now, you can certainly click on the hand raise option to join us on screen. I think he's not joined us on the call, Sachin.
Yeah, let's move ahead.
Okay, so with this, we come to the end of the award ceremony. Congratulations to all the winners, and a big thank you to Sachin for taking up on the jury position and sharing those evaluations. Thank you so much for all your time and efforts towards the Family Office Summit and Awards.
Yeah,
A
you're
big thank
welcome,
you.
Sharon, and congratulations to all the winners. And it was very interesting to go through all the snapshots that you had sent, because it introduced me to quite a wide ranging field that is there in the family office space, something which I was not that cognizant with before. So thanks for the opportunity as well.
Thank you so much, Sachin, for joining and helping me out doing the honors for the awardees. Thank you.
Yeah.
So yes, so with this, we come towards the end of the two-day Family Office Summit and Awards. A big thank you to Franklin Templeton, Mr. Sanjay Patni, for the immense amount of effort and contribution and the support that he's extended and helping us putting up this successfully. Thank you so much, Franklin Templeton. And to each one of you who's joined us on this call for this two-day conference, and all our speakers who've been joining us for both the days, for sharing their insights on those beautiful topics curated. Thank you so much once again. I'll look forward to all of you on the next edition. Thank you so much.